Welcome to the Financial Management Marathon for May 25 September attempt and even Jan 26 students. This marathon is going to be for approximately 7 hours, 7 or 15 minutes approximately. And obviously, none other than Ganesh Bharadwaj sir, who is handling this entire marathon. You can find the timestamps below. The faculty Ganesh Bharadwaj sir will give you an introduction about what topics is going to cover. But briefly, I'm also telling you at the beginning so that you will plan your schedule accordingly. All the chapters in the financial management except dividend decisions, and there is one more chapter. I think two chapters is not covering, sir is not covering. Rest all other predominant chapter which occupy minimum 40 marks. In fact, sir has told me it is 42 marks weightage is the minimum weightage from these topics, except FM theory, ratio analysis, dividend decisions. Except these three topics, theory, ratio analysis, dividend, rest all other topics were covered as part of this particular marathon. You can make use of this marathon, guys. I'm telling you, Ganesh Bharadwaj sir has done immense work on material. I will show you the material. I guess sir has already spoke about the material, but let me briefly show you how beautifully the material is compiled. I can undoubtedly tell you the best material on financial management ever made. That I can assure you. You see, the books, one is a concept decoder book, another one solved question bank. The concept decoder book is approximately 180 pages concepts, and the question bank is approximately 350 to 360 pages. Literally sir has sat down and literally drafted each and every answer. You can see, you will not find this kind of presentation anywhere. Literally you cannot find this kind of presentation nowhere. Such a wonderful question bank. Now immediately you might get a doubt, sir, I want to order this question bank, can I get a hard copy? Yes, you can get a hard copy. Not only that, sir, I don't want to order question bank, sir, I cannot wait up to like 1 week delivery time it will take, but I want to take a print of this. Is PDF available? Yes, PDF is also available. I will show you on our website. You can come to, there is a website, sreshtafacncma.com. Actually my voice is little gone, so it's okay, fine. I hope you are seeing already, audit marathon, tax marathon, all that. I hope so. If not, just go through that, check out them also. Even costing marathon by Ganesh sir will come in April 2nd week, probably first week or second week. Audit marathon, I know some of you are questioning, by this time I have only uploaded part 1, part 2 will also be there in the same channel. Okay, now, so paper 6a concept, very simple. Come to sreshtafacncma website, go to free resources. Inside this, already by default May 25 folder, here you see financial management new material, concept decoder PDF you can download, question bank PDF you can download. Sir, I want to order the book, sir, what can I do? Very simple. Select your books option, go to CA Intro, EVO fast track books. Okay, clear fast track books. Here you can find this material set at 849. Remember guys, you are getting a color material. It's not a black and white material, color material. Fantastic and finest quality material that you will get. You feel like studying from the material like anything. So that's how qualitative the material is going to be. Then coming to, briefly let me show you how the concept decoder is also. So this is a concept decoder which is just in 180 pages. You can see how beautifully the material was drafted. Such a wonderful concept decoder in FM. Generally on financial management, you will not find best materials. Like subjects like audit, law, taxation, you generally find best materials. But FM kind of book, financial management, rarely people do best material work. But this is such a wonderful work by Ganesh Bharadwaj sir. See the amount of work you can see here. It is reflected very clearly how wonderfully the material is made. That's it. That's from my end. Already Ganesh sir is giving you what he's exactly going to cover. Once again he'll in-depthly talk about what he's going to cover, all that. Next 7 hours, invest your time. Believe me guys, sir has even solved certain problems in the marathon itself. Witness the kind of conceptual clarity like never before. Make use of this marathon. Get successful in the upcoming May 25, September, January, whatever the exam you are planning for. And immediately those who are writing for May, all the very best. I wish you should qualify. Use this marathon resources. Do study on your end. Remember, you know, claps. Claps will work only when both the hands join. We are working hard from our end. Now it is your turn to stand up. Now it is your turn to support our work. Getting it? If both of us work together only, you can achieve the success in the exam. That's it. All the very best. Continue watching Ganesh Sir class. Okay. Bye bye.
Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So in this video, we are going to get started with your FM CA Inter Financial Management free revision batch, or also called as the marathon. Right now, trust me guys, in this particular marathon, in a span of just 7 hours, we will be seeing a coverage of more than 40 marks out of the 50 mark component in your financial management. Sir, in this particular marathon, what are all the concepts that are going to get, what are all the chapters that are going to get covered? Now guys, we are going to cover all the important chapters in your financial management. Now in your financial management, there are totally 9 chapters, right? Out of this, there are 2 theory chapters, your types of financing and scope and objectives of financial management. So literally, there are 7 practical chapters, and out of those 7 practical chapters, 5 big numerical chapters, 5 big practical chapters will be covered completely in this particular marathon. So the 2 chapters that I'm not covering is dividend decisions and ratio analysis in this marathon. But do not worry, I will tell you how to deal with that also. Now guys, now we will be covering cost of capital. Right? This chapter on an average carries a weightage of about 8 marks. Then leverage chapter, this carries a weightage of 6 marks. Conservatively, I'm saying, if not, it can be more. And capital structure, it carries a weightage of 8 marks. Right? And investment decisions and working capital, each on an average generally carries a weightage of 10 marks. So totally, if you see, we will be covering a whopping 42 mark coverage in a span of just 7 hours. So now, if you are going to revise this entire subject along with me in this marathon, trust me, in a span of just 7 hours, you are going to get a very good coverage, right? And of course, a standard question that comes in, sir, I have not touched the subject at all, right? Sir, so if I watch this marathon, is it enough? Now, as the name goes, this is a marathon or a free revision batch, right? Now, obviously, the underlying assumption is that you should have already learned the subject at least once. Not necessary that you should have attended my classes. You could have done a self-study, or you could have also learned it from some other faculty, but definitely you should have studied the subject once. Only then you will be able to revise the entire subject. So I consider this marathon as a source of revision, not as a source of preparation, because if you want to prepare, then we have this fast track courses and we also have our regular courses. Both have comprehensive coverage and all of that. But here, this is meant for revising the entire subject and for the benefit of all the students, right? Whether they have taken classes from me or elsewhere, not a problem at all. There will be a lot of self-study students also. To benefit everyone, I'm coming up with this marathon on your financial management, coming up with a coverage of 42 marks out of the 50 mark component. Clear with this, guys? So there is going to be a huge coverage here along with numerical problems wherever possible. So this is going to be a packed session where in a span of 7 hours, we are going to cover all these 5 chapters in depth. Clear with this, guys? That is one thing that I want to clarify before the start of this marathon. Now, in this marathon, sir, what is the book that you are following? Now, guys, broadly, I have 2 books. Recently, we have come up with 2 books, right? One is called as Concept Decoder Notes. This is nothing but it has all the concepts of every single chapter. And the second one is called as a solved question bank. This has only questions and solutions along with it. I will open and I will show it to you. Now, these are the 2 books that we actually use in this particular marathon. In fact, these 2 are the books which we use even for all our courses also. The fast track and the regular courses also, we use the same book only. Now guys, this is actually the Concept Decoder Notes. Trust me, a lot of efforts has gone into this particular book, and in a span of just 180 pages, if you see here, total 192 pages will be mentioned, right? But in a span of just 180 pages, removing all the cover page and everything, the other initial pages and all, in 180 pages, the entire concepts of financial management is being beautifully covered here. Now, look at this. I'm just opening and I'll show it to you one chapter. So look, it's full color. It's full on color with all the index. Everything is clearly there. Now I'll just open and show it to you the chapter called, the cost of capital. Now look at this, cost of capital. Now what has happened in this chapter? There is a chapter introduction. And before you enter into this chapter, there are certain terms and concepts which you need to definitely understand. This as a background I'm giving in every chapter, right? And then look, there are some terms and concepts. Now let us take one example, KD calculation, like with respect to the concept of cost of debentures. Now literally I have bifurcated. So KD can be redeemable or irredeemable debentures, right? What are they? What is the formula? Every single thing, the formulas are all mentioned in this violet color ink, so that the day before your exam, even if you're revising, this will all pop up and easily you can take it up. And the best part here is, guys, now that I have introduced something called as doubt busters. Now, what do you mean by doubt busters? This is generally the areas where students struggle and make mistakes. I have compiled it all together, and under the respective concept, I have created the doubt and I've solved it so that you will definitely not make this mistake, during your exams. Clear with this, guys? All those issues, for example, your flotation cost is given as a percentage, right? Now, will you apply this percentage on your face value or on your issue price, right? All these kind of clarifications I have provided in the respective segment itself. And not just that, now we were talking about KD, right? The cost of debentures, redeemable, irredeemable. This is the basic thing, right? And apart from that, if you see, there are certain other issues covered, across the entire study material. Like there's something called as amortization of debentures, self-amortized debentures. There's something called as convertible debentures, right? There's something called a zero coupon bond. Bond is also a debenture. How do you treat your short-term debts? This was one adjustment given in a question, right? And how do you go for cost of long-term bank loan? The recent exam had this cost of long-term bank loan and all. I have compiled all the concepts relating to KD in a single area so that you need not run and refer into multiple pages. It has been neatly condensed, and we have also given all the color coding along with doubt busters, and the formulas have also been mentioned in a separate color so that it will be a complete packed discussion for you, and you will be having control over the entire subject like anything, right? This is the objective, and this is the predominant thought process that has gone into creating this book. Trust me, guys, this is my dream project because I've always wanted to give a color book for a practical paper, which not many people do. Yes, there are a lot of color books in the market, but the reason why I wanted to give a color book was not just to give a coloring to a black and white book and give it. Absolutely not. There needs to be a value addition, and generally students struggle in practical papers like costing and FM and all of this. So similarly for costing also, we have the same two, concept decoder notes and solved question bank. So here there is a genuine value addition that is being made. Once you start using this book, you will know the kind of value addition that you will get. And of course, the PDF and all is available free of cost for download. So you can just download it. Absolutely not a problem at all, right? The link and all will be given in the description, right? You can also see where you can download, and you can download it. As simple as that. Clear with this, guys? So I have just taken one concept to explain what this, the concept decoder notes actually stand for. Now, the second book is actually called as the Solved Question Bank. It is actually, you can say it contains a rich variety of all the past exams, RTPs, MTPs, and also your entire study material is covered. Single source of preparation for your entire FM preparation. Similarly for costing also, we have created this. So it's one book, every solution, exam ready. Literally, that's what it stands for. Right now, in this particular question bank, now what I've done here is actually, so for the first time ever, similar questions are grouped together with a unique numbering and distinct color background. Even the question bank is a color book, right? To make your revision structured and effortless. What it is, I will show you to you because I'm discussing all these things at the initial level so that when you are actually starting to watch this marathon, the first chapter, you will know what these books stands for, and you will know how to navigate easily. That is the reason why I'm explaining all these things at the initial phase itself. Right now, for example, I will just open up here. Also, it's full color only. So I will open up and show you one chapter, cost of capital again. Now look at this. You have problem number 1. Look at the color background, slightly pinkish in color. Now there is a similar question to problem number 1, but there is only 1 or 2 minor adjustment. What I have done, I have given it question number 1A. I have given a reference 1A, and the color background is something different. It's beige color. Here with this, guys, only 2 colors. The main question will have a pinkish color and the sub question will have a beige color. Now, basically, if you cover the question number one, the top question, generally, this 1A, 1B, these type of questions can easily be covered. Now, if at all you are revising, if you are want to revise this question number 1A, you need not read it fully. Just that one or two adjustment, that is extra item, that alone you need to revise and go. That's about it. Clear with this, guys, right? So this is the thought process that has gone behind the creation of the solved question bank. Also, here also, the coloring stands for a reason, right? So similar questions are grouped together. All the similar questions I have grouped together, and a superior question is kept on the top with the main numbering, and then I have given some sub numbering like 1A, B, C and all that for the questions that are actually an extended version of the main question. So generally we have covered all the past exam RTPs and MTP questions starting from May 2024 attempt, that is ever since the new syllabus was introduced. Here with this, guys. So literally this one question covers your entire study material, your past exam RTPs, MTPs and everything, and that's about it. This is exam ready. So beyond this you need not even do any other material. Now, these are the two materials which we use in our marathon, that is the concept decoder notes and solved question bank. And of course, sir, have you solved everything? Of course, not in this marathon. So in our regular batch and in our fast track courses, we cover it fully, right? But in your marathon, as it is meant for revision, we have covered all the concepts. Every single concept in these 5 chapters are covered, and wherever possible for concepts, we take one representative numerical problem, and I have explained that as well. Clear with this, guys, right? So literally in the next 7 to 7 hours 15 minutes, approximately 7 to 7.5 hours, you will be having a complete control over these 5 chapters that will cover a whopping 42 marks, right? So I humbly request you to sincerely watch this entire marathon till the end and revise the subject along with me. And trust me, guys, this attempt is going to be a game changer in your CA journey, right? So on that note, let's get started with this beautiful subject, financial management. Now, let's start with the revision of the first chapter in discussion, which is cost of capital. Now, before we get started with the actual chapter, that is the technicalities of this chapter, first, let us set the context. Now, our subject, financial management, has 3 broad objectives. One is called as financing decisions. Then the second one is called as investment decisions. And the third one is called as dividend decisions. Now, financing decisions refers to those decisions which you take towards your fundraising activity. Now, from which source should I raise my money? Equity or debt or preference and so on, right? And if so, from which source, how much amount should I raise? All of that, the decisions relating to your fundraising is covered under the first objective called as financing decisions. Now, the second one is called as investment decisions. Having raised the money, where should I park these funds, right? So whether should I park my funds in or invest my money in machine A, or should I do it in machine B, which will give me the best results? So this decision comes under your investment decisions. And finally, having done all these decisions, the company starts the business, earns money as profits, and they pay all the outsiders. And finally, whatever is the amount, that is the earnings of the equity shareholders, out of this amount, how much should be paid as a dividend and how much should be retained as reserves and surplus? This decision comes under the third category called as dividend decisions. And in our subject, every single chapter that we study will actually be categorized under either of these 3 objectives. Now, this chapter, cost of capital, squarely fits into the category of the first objective of our subject, financing decisions. And we have seen that this chapter clearly talks only about your fundraising activities. Now, quickly, let's revise this chapter, cost of capital. Now, guys, when a company starts the business, let's say this is the balance sheet, they cannot start the business as such, so they need some money to actually fund. Only then they can start the business. So from what are the different sources of finance available? You will be having your equity share capital, right? If it's a running company, they might already be having some accumulated profits. That's called as retained earnings, right? You can also raise money from preference share capital route. You can also raise money from your debt or debentures route or bank loans. There are different sources of finance, right? Now, every single source of finance will definitely have a cost associated to it, because you will not get any money free of cost, right? The cost associated with your equity share capital is called as KE, where K stands for cost and E stands for equity. The cost associated with your retained earnings is called as KR. The cost associated with your preference share capital is called as KP, and your cost associated with your debenture is called as KD, right? Now let us say our company, right, it has raised 30 crores from equity share capital, 20 crores from retained earnings, and let us say some 40 crores from preference share capital and 10 crores from debt, right? Now, for this 30 crore, what is the cost associated is called as KE. For this 20 crore, what is the cost associated? It is called as KR. For this 40 crore, what is the cost associated is called as KP. For this 10 crore, what is the cost associated is called as KD. Now, if you add up everything, totally the company would have raised how much money? 100 crore. So for this 100 crore, the entire amount as such, right, what is the overall cost of capital? That is called as KO. So how will you do it? You will weighted average and you will find out, right? So we will just be taking up one example, right? Once we finish all the discussions, I will just take one numerical problem and clearly revise this concept also, the calculation of KO. So in this chapter, we are going to learn the costs that are associated with every single source of finance, and having computed that, finally you should calculate the weighted average cost of capital. That is nothing but the total cost of raising the entire money, in our example the 100 crore. Clear with this, guys? And one more very important understanding that we need to have in this particular chapter is cost is always expressed as a percentage, not an absolute amount. Now, why is cost expressed as a percentage? Let us say there are two students, A and B. One student scored 45 marks. The other student scored 60 marks. Now, which student is better? Now, you will think that student B is better because he scored 60 marks. But actually seeing, this student A has scored 45 out of 50 marks, whereas student B has scored 60 out of 100 marks. Now you tell me, student A has actually scored 90 percentage, right? Whereas student B has scored only 60 percentage. Now you will clearly come up with an idea, or you will clearly come up with a conclusion that yes, student A has performed better. Hence, this is always the reason why we go with percentage, because percentage is directly comparable. So now in this chapter, cost of capital, cost as they call it, is always expressed as a percentage. Clear with this, guys? Right? Now on this note, let's get started with our concept decoder notes. Let's quickly revise this particular chapter. Now first, the cost of capital is a return expected by the providers of capital, right? The first and the foremost, the most important thing here is cost of capital. The cost is nothing but the expectation of return from the providers of finance. Sir, how, sir? Let us say you are going to a bank, right? Let us say you are going to a bank and you are parking an FD, right? This is the investor. He is parking an FD with the bank, right? Let us say the rate of interest, example, is 9%. Correct? Now, 9% from the viewpoint of investor is going to be a return, correct? And the same 9% from the viewpoint of the company, in this case, the bank, is called as a cost. So in this way, we can clearly say that the expected return of an investor is equal to the cost from the viewpoint of companies generally, right? Of course, there are certain areas where this cannot be possible. What it is and all, we will be quickly recapitulating that, right? And of course, cost is always expressed as a percentage in this chapter, right? So now this is also kept as a cutoff rate or a hurdle rate or the minimum required rate of return. And in short, this particular cost of capital which we calculate is nothing but the discount rate which we studied in time value of money chapter. Time value of money chapter, as I told you earlier, I've already uploaded a separate video on time value of money. Under the basic concepts, I have already uploaded a separate video called as time value of money. Now, without time value of money, right? This entire subject of financial management cannot be actually seen. But this time value of money is not a separate chapter in your intermediate level, but still that is a very much a requirement for you to enter into the subject of financial management, because that time value of money is like an oxygen. Its presence cannot be seen, but its presence can be felt throughout the subject. Clear with this, guys? Right. Now, in this chapter, we'll be using the following terms for discount rate. I just told you, for equity, the discount rate is going to be KE, right? And debenture, the discount rate is going to be KD. Your preference, the discount rate is nothing but KP. Your retained earnings, the discount rate is KR. And the overall cost of capital, the discount rate is nothing but KO. And in time value of money chapter, we would have learned that your discount rate is nothing but the rate that equates your present value of cash inflow with your present value of cash outflow. So here what we do is we match the inflows and outflows, and the rate that matches the two is actually called as a discount rate. And in this case, that discount rate effectively is a return from the perspective of an investor, and it is the cost from the viewpoint of company. And that is what we are going to compute in this particular chapter, because discount rate is always expressed as a percentage. Here with this, guys, that's about it. Now, there are some important terms or concepts which we will be seeing throughout this chapter called as cost of capital. What are they? First, the basic things. Now, whenever a security is being issued, when I say security, it can be an equity share, it can be a preference share, it can be a debenture, or any other security issued by a company like a bond and all of that, right? Now, an issue can happen at par, it can happen at discount, or it can happen at premium. Example, the face value is 100. If I am issuing it exactly at 100, it's called as issue at par. Right? If I'm issuing it at 90, it is called as issue at a discount. And if I'm issuing it at 110, it's called as issue at a premium. Right? And similarly, at the time of redemption, of course, redemption concept does not happen in case of equity shares. But at the time of redemption, what happens? That can also happen at par, premium, or at discount. And I've given a note here. In the absence of information, always assume that the redemption is happening at par. Clear with this, guys? Yes. The next one. The next concept is about flotation cost or issue cost. What do you mean by flotation cost? Now, these are the costs associated with issue of new securities, right? Example is brokerage commission, underwriter's commission. Now, for example, when the company is raising money from the public, let's say from the equity channel route, right? Now, it comes with a cost. It comes with a cost. For example, there has to be a minimum subscription that you would have studied in law. Now, 90% should be minimum subscribed and all of that. Now, where do I get the guarantee that at least 90% will be subscribed? I will go to an underwriter. He will take an underwriting that even if the public does not even if the public does not subscribe, I will purchase your shares. You don't worry. For that underwriting, I need to pay some commission, right? So whenever I'm raising money, I need to pay to some kind of money or professional fees to merchant bankers, because they help me in this fundraising activity. There are a lot of costs associated with it, and these costs are called as flotation costs. Now, in our entire subject of financial management, we deal with cash flows. And when I'm receiving money from the public, right, the money that I'm receiving from the public, from that, out of that, I need to subtract the flotation cost, because these are treated as outflows, because I actually shell out the money from my pocket. So only the net amount that I receive is called as net proceeds by issue of any securities. Clear with this, guys? So these costs apply only to new securities and not to existing securities. And in case of flotation cost, if it is given in the question, the issue price must be taken after deducting the flotation cost. Obviously, let us say I am issuing my shares. Every share I am issuing it at 105 rupees, and per share there is a flotation cost that I incur of 2 rupees. The net proceed that I receive today, the net cash inflow that I receive today, is only going to be 103 rupees. That is what I have mentioned here. And doubt busters section, one more thing. If in the question they have given flotation cost is 1%, that's all they are mentioning. So this 1% should be calculated on what? It can either be calculated on your issue price, in our example 105 rupees, or you can apply it on face value. It is your choice. Clear with this? In the absence of information, but always write a note regarding whatever approach you have followed. So this is something that is a lacuna, that is actually an open-ended area which the institute themselves have mentioned that you can take anything. Suppose the exam they've given 1% on face value, then you should apply only on face value, or 1% on issue price, then apply only on issue price. If they have just given 1%, then you can apply on either of the two, but just write a note in this regard. Next one. Now, concept of tax saving on interest. Now, one of the components, one of the different variety of source of finance is called as your debentures, right? On your debentures, right, the amount the company needs to pay is called as interest. We all know this. Now, this interest, whenever I am paying, right, literally it has actually a tax shield or tax saving. The payment of interest to the debenture holders are allowed as an expense for the purpose of income tax. In your income tax, you know, there is a section called 3613. Right, in that section, interest is allowed as a tax deduction while computing your profit. That profit is only a base to compute your taxes. So literally, you don't end up paying any tax on the interest component that you pay. Right, what is what? We will quickly understand that with the help of an example. Right, so now this will save some tax liability for the company, and savings in the tax liability is also known as a tax shield. Right, now example I'm giving you. Example, company A and company B are similar in all aspects except that company A raised an amount from debentures. Let's say company A raised 100 crore from debenture, right? And let's say the interest on this was 30 crores. Example, the company B, what they did, exact same amount of 100 crore they raised from preference shares, on which they also pay the same 30 crore as a dividend, not as an interest. Clear with this? This is the difference. But both the companies raise the same amount on which the cost is also the same. Clear with this? Now we will see what is the impact here. Now both the company A, company B, assume they are similar in all nature, right? All aspects. They start off with the same EBIT. EBIT is your earnings before interest and tax minus interest. Company A pays what? They raise money from debenture route, so they pay an interest of 30. Whereas company B, they didn't raise any money from debentures, so they will not pay any interest. Clear with this? They will only pay dividend, right? So the earnings before tax will be how much for company A? 70. For company B, it's going to be 100. Now minus tax, let's assume the tax rate is 30%. So 30% on my EBT is going to be how much? 30% on 70 is 21, whereas 30% on 100 comes out to 30. Now you get your earnings after tax, which comes out to, for company A, it's 49, for company B, it's 70. Now, minus preference dividend, company A does not have any preference dividend because they raise money from your debentures route, whereas company B needs to pay 30 rupees of your dividend to your preference shareholders. So the net earnings available to the equity shareholders is how much? For company A, it's 49, whereas for company B, it's going to be 40 rupees. Now, how did this happen? Both the companies started off with the same EBIT, and both the companies had the same 30 rupees of the financing cost. The only difference was company A paid as an interest, but company B paid as a dividend. But what has happened? This dividend, this interest of 30 rupees, which company A had paid, was allowed as a tax deduction. It was allowed as a tax deduction, and hence the base on which I compute my income tax, that is my earnings before tax, the base on which I compute my income tax also reduced for company A, and company A ended up paying tax of 30% on 70 rupees only, whereas company B ended up paying tax on the entire 100 rupees. Or in other words, here in company A, if you see, it paid a tax of only 21 rupees, company B paid a tax of 100, so company A saved 9 rupees of taxes, and that 9 rupees saved in tax is only the increase in profit of company A. Company A reports a profit of 49 rupees, company B reports a profit of 40 rupees only. Clear with this, guys? So literally speaking, this 9 rupees of tax savings happened because the company ended up paying an interest and not a dividend. So the net amount of interest, can I say, is nothing but 30 minus 9, which is equal to 21 rupees. So because if I pay an interest of 30 rupees, Parallelly, there is a savings in tax to the extent of 9 rupees. So because of interest, there is a tax shield or tax saving. The net interest cost will only be what? It will only be 21. Or in other words, if you calculate, this 21 rupees is nothing but interest rate or interest amount into 1 minus tax rate. That is, on this 30 rupees, right, the company need not pay any tax rate of 30%. Guys, correct? No, right? So literally in this case, what is the interest amount? 30 into 1 minus 0.3 if you do. So 30 into 1 minus 0.3 is 0.7. 30 into 0.7 comes out to 21 rupees. Or in other words, effectively every year for the company, the cash outflow is not interest amount, it is interest into 1 minus t. That is the net amount the company actually pays every year, because 30 rupees they pay, parallelly they save 9 rupees. The net effective cost is only going to be interest into 1 minus t. So in our subject, we deal fully with cash flows. So every year, when you are calculating all that IRR amount, which we will be seeing, right, every single year, so the company will only take the cash flow, the net cash flow, as interest amount into 1 minus tax rate for all the calculations. Are you all understanding this? Whereas if you're doing preference dividend, there you will take the entire preference dividend value. The in-depth explanation and detailed calculations and many numerical problems, we have done it both in our fast track batch as well as in our regular batch. But still here, quickly I'm revisiting here along with the numerical example. Fine. Now, it can be clearly seen with the above example that despite having the same EBIT, the net earnings is more for company A as compared to company B, since the interest amount is tax deductible expense, whereas dividend amount is not a tax deductible expense. That's the concept of tax shield or tax savings on interest. Fine. The next one. Now, let's get started with the first source of finance, KD. Right now, based on redemption, that is repayment of capital, the maturity, the debts can be categorized into two. One is called as irredeemable debenture, the other one is called as redeemable debenture. Irredeemable debenture means what? It never gets redeemed up to perpetuity, infinite life. I have to keep on paying the interest and I need not repay back the principal. Whereas redeemable debenture, it has a finite life. The cash flows are finite. I raise the money today. Let's say after 10 years, I need to repay it back. And during the span of 10 years, I need to service my interest and all of that. Right? Now, cost of irredeemable debenture. How will you compute? Now, recall our discussion in our time value of money chapter, which we have seen. We have seen that the present value of anything, right, the present value is equal to, in case of infinite cash flows, we saw that it is annual cash flow divided by discount rate. Now in this case, the present value, we call it as net proceeds. We saw, no, right, the exact amount that I received today, right? Net proceeds is nothing but what? It is nothing but the issue price adjusted for flotation cost. So net proceeds is equal to, from the viewpoint of company, this is what I receive, what I pay every year, annual cash flow, interest into 1 minus tax. I told you, when I pay interest, parallelly there's a tax saving. That's the net amount that I actually pay divided by discount rate. The discount rate of debenture is called as KD. Guys, correct? No, right? So now, or in other words, can I say KD is equal to interest into 1 minus tax divided by net proceeds. That is exactly the formula here. We have seen this logically simple, and this derivation I did using your sum of infinite geometric progression series and all. We derived it in our classes, in our EVO fast track as well as in our regular batches, both the courses. We saw the derivation and we derived at it. It is all logical and simple. Clear with this, guys? Where KD stands for cost of debt after tax, right? And I stands for annual interest payment. NP stands for net proceeds or current market price. In case it's not given, you should take the current market price. I have it in the doubt buster segment. We will see that. And T stands for a tax rate. Clear with this, guys? So this is how you compute the cost of irredeemable debentures. Or if you want to logically, or if you want to simply understand it, you can say the numerator will have what the company pays. The denominator will have what the company receives. So what I pay upon what I receive. What I pay interest into 1 minus tax. That's my net cash flow, right? Divided by what I receive. I receive the net proceeds. If you divide the two, you will arrive at your KD. This is another easy way of understanding. As simple as that. Now let's move on to the next one. Cost of redeemable debentures. When it comes to redeemable debentures, there are two ways or two formulas to compute this. One is called as YTM method, the yield to maturity method, also known as the present value or the IRR method. Now, IRR calculation, we have in detail, we have seen it in our the time value of money discussion. Literally, I've shown all these things. We have done sums there in this regard. Now, quickly, I have just mentioned the steps here. So what you need to do, IRR is nothing but the rate that equates my present value of cash inflow with the present value of cash outflow. So what we need to do is, first we need to frame the cash flow equations. So here at the initial year 0, what I receive is net proceeds, right? So net proceeds is equal to, let's say the life is for 5 years or 10 years. So what you need to do, this is equal to I into 1 minus T, that's your first year cash flow, divided by 1 plus KE to the power 1. So you are discounting it for the first year, plus I into 1 minus T, that's your second year cash outflow, divided by 1 plus KE, this is KD to the power 2. And similarly, it goes on. And in the last year, what will you have? I into 1 minus T divided by 1 plus KD to the power 10, right? And over and above that, you will also now be repaying back your principal amount. So whatever is the redemption value, RV divided by 1 plus KD to the power 10. So this also you will do, and you will plug the figures. All the figures will be available except the KD. And what you will do, you will take two trials. One trial will give you a negative NPV, one trial will give you a positive NPV, and then you need to interpolate the two and arrive at the correct figure of your IRR, that is nothing but KD in this case. Your discount rate applicable for your debentures is called as KD, right? Anyways, do not worry. We will be doing one comprehensive numerical sum in this marathon or the free revision batch itself. So we will be seeing that. You need not have to worry. Here I have quickly mentioned the procedure to do this. Identify the cash flows, calculate the NPVs of the cash flows using two discount rates, that is guessing or using your trial and error method, and then using interpolation technique, you need to calculate your IRR, and as simple as that, right? Now there is a second method called as a shortcut method. It's also known as the formula method. Now, how do you do it? KD is equal to I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2. Now, guys, you need not mug this formula at all. Simple. Let us say the company has a debenture, right, with a face value of 100 rupees, right? And let us say they have issued it at the issue price or the net proceeds today, right? Assuming no flotation cost and all. Let us say the net proceeds today is going to be, let us say 90. They have issued it at a discount. Clear with this, right? And let us say the redemption value RV, they are going to redeem it at a premium of 110. And let us say, guys, the face value is 100 and the interest is equal to 10%, right? 10%. So 10% on the face value 100 gives you what? 10 rupees, right? Now for my KD represents what? Cost of debt, right? What is the cost I incur? And let's assume the tax rate T is equal to 30%. First cost on my debenture is what? It's going to be my interest amount. So every year I need to pay 10, right? But wait, this entire 10 is not my cost. Because I pay 10, there is actually a tax shield. So into 1 minus T, correct? Right? The T is going to be, in our example, it's going to be 1 minus 0.30. So the net cost here is only going to be 7 rupees. So 10 into 1 minus 0.3, that gives you how much? 1 minus 0.3 is 0.7. So 10 into 0.7, 7 rupees only is the effective cost, because I pay 10, but parallelly I'll be saving 3 rupees. Correct? Now, is this the only cost? No. Why? Because when I actually issued, that is when I received money from the debenture holders, I received only 90. But when I am repaying, in this case, I'm going to repay how much? 110. So literally the difference between this 20 rupees is an extra cost for me. Correct? Now, so this should also be considered in the numerator, but wait. This 20 rupee is not a cost that you incur in 1 year. It is a cost that you incur over the life of the debenture. Let us assume the life of the debenture is going to be 10 years. So in this case, what will you do? 20 rupees is the cost you incur for 10 years. Per year, what is the cost? So 20 divided by 10, 2 rupees. Or in other words, that is the second segment here. RV minus NP, that is 110 minus 90. The difference between the two is also a cost that I incur, that divide by what? Divide by n, and n in this case is going to be 10 years. Clear with this, guys? The whole divided by, now I need to take the debenture capital amount, right? The amount that I actually, the amount of debenture capital. What will I do? I have two figures. One is the amount that I actually received, right? The next amount is the amount that I'm going to pay. Which amount should I take? Simple, take a simple average of the two. So RV 110 plus NP 90 divided by 2. As simple as that, as simple as that. So now if you do this, so basically what will you get? 10 into 1 minus 0.3, that's going to be 7 rupees, plus 110 minus 90, 110 minus 90 is going to be how much? 20 rupees, right? So 20 divided by 10, that's going to be 2. The whole divided by 110 plus 90, that's going to be 200. 200 by 2 is 100. So literally speaking, 7 plus 2, that's going to be 9. 9 by 100. So the effective cost of debenture is going to be 9%. Simple calculation. It's all logical. But remember one thing, this method is called as an approximation method or a shortcut method. Now, it is not an accurate method. The most accurate method is only your IRR method. Why, sir? Because you are ignoring the concept of time value of money. So RV in our example, redemption value, is a cash flow arising at the end of 10th year, whereas NP, net proceeds, is a cash inflow that happens today in year 0. Now these two are cash flows arising at two different intervals. They are not comparable as such, but still this method goes on to subtract the two directly. Hence it ignores the concept of time value of money. Hence it is not a very correct approach. However, for procedural convenience, we can use this particular method and leave it there. Clear with this, guys? The above formula to calculate KD is used where only interest on debt is tax deductible. So fine, that I will come to it a little later. So this is how you need to compute this particular formula. Now, if you see in this case, what we did, we applied this tax shield only on the interest figure. Yes, because interest is a tax deductible expense. Now, in some rare cases, right, till now, there is no question even in the study material in this regard, but still the formula is given there. Now, there could also be a case where the difference between my redemption value and my net proceeds, in this case, 110 minus 90, this 20 can also be a tax deductible expense, no? Yes. In that case, what I will do, simple, even on this RV minus NP, on that amount also, you should multiply it with 1 minus T. Correct? Because that is also a tax deductible expense. So what you do is you can use this formula. Very simple. Both your interest as well as your RV minus NP by N, everything is tax deductible. So take this entire numerator, the whole into 1 minus T you do, because the tax shield is not just applicable on the interest, it is also applicable on the spread. That is the difference between your RV and NP, because that is also your cost. If that is the data given in the question, then take this 1 minus T common and apply it on the entire numerator. Clear with this, guys? Denominator remains to be the same, but this is never used till now in any of the numerical problems. But in case they are telling you that even this component is tax deductible, then it needs to be done. As simple as that, guys. Clear with this? Now, where I've given you all these things, I stands for interest amount, NP stands for net proceeds of the current market price, right? RV stands for redemption value, T stands for tax rate, and N stands for the life of the debenture. Now, coming to the doubt buster segment, in the absence of any specific information, students may use any of the two methods, or that is YTM or approximation. So which method to use? If the question is silent, use either of the methods. Clear with this, guys? Yes. Next one. The approximation method gives only the approximate value of KD, whereas YTM gives you the accurate value of KD. Under approximation method, in the absence of specific information, students may use any of the two formulae to calculate KD with logical assumption. So even in approximation, we saw two formulas, no? One was when only the interest component is tax deductible, right? So that is the logical, that is the generally used formula. Please use only that even in the absence of information. Suppose if the question specifically gives you that no, even RV minus NP is also tax deductible, then you can use the second formula. Clear with this, guys? The next one. Yes, the next one. Net proceeds refers to what? Issue price minus flotation cost. Now, suppose in the question issue price is not given, then what you can do, if the current market price is given, take the current market price and assume that to be issue price. Why, sir? Current market price means what? The price prevalent in the market. So today if I go to the market and raise money, that will be the price at which I can raise, correct? So hence it is fair on all aspects to assume that the current market will be equal to issue price in case issue price is not specifically given. Now, sir, if issue price is not given, take the current market price. Sir, if current market price is also not given, in that case, assume that the issue is happening at the face value. Clear with this, guys? So there is an order of preference. First preference to take it, the first preference should go to issue price. In case the issue price is not given, go refer and take your current market price. If that is also not given, then you can take your face value as equivalent to issue price. Next one. If flotation costs are not given, simply assume it to be equal to 0. Nothing can be done. Clear with this, guys, right? And that's about the entire concept of KD. As simple as that. See how quickly we can revise, provided you have learned it conceptually. Simple. This is all it is. You need not even take the pain in mugging up, right? Of course, there are a lot of issues which we saw in our classroom discussion and all. In both our fast track and our regular courses, we have seen different varieties of sums and all, right? Here, I will discuss all the concepts, right? Quickly, I will recapitulate one comprehensive sum I will do. And with that, we will be winding up this entire chapter in a very easy manner, that even if you're watching this video the day before your exam, it will be a perfect way for you to recap and cover all the important concepts of this particular chapter. Clear with this? Of course, there are a few intricate concepts, more detailed concepts. We have done it in our batch, in both our fast track and regular batch, but here on a broader sense, the predominant most important concepts are all covered here. So basically you can revise it quickly and then you can go and deep down. You can use the library of adjustments which we saw and all. With that, you can revise the entire chapter in detail, question wise, concept learning wise. You can revise it if you have properly taken notes of whatever I have given you in the lectures. Fine. Coming back here, what are the other issues in our KD? Now, one, amortization of debenture. Now we have seen that some debentures may not be. So whatever we saw right now was what? So we received money today and the entire money will be repaid after say 10 years or 15 years or 5 years, whatever it is. There is a single shot repayment. Whereas there could be scenarios where there is an amortization every year. Means what? The life of the debenture is 10 years, but I will not pay the entire amount at the end of 10th year. I will pay the entire amount, right, over the course of 10 years. Let's say I raised 100 crore rupees from debentures. Every year I need to repay how much? 10 rupees, right? So first year end I will repay 10, second year end I will repay 10, third year end I will repay 10. Every year I will repay, and at the end of 10th year also I will repay 10, and the entire amount is closed. Clear? In this case, what happens is if I pay 10 rupees, repay 10 rupees at the end of first year, the second year interest is computed only on 90 rupees because I raised 100, out of which at the end of first year I repay 10. Now only 90 rupees is used for the second year, right? So for the second year interest computation, apply it only on the opening balance 90. Now at the end of second year, I would have repaid one more 10. So in this case, the closing balance as at the end of second year will only be 80 rupees. That is 100 minus 10 minus 10, 80. So the third year interest will be computed only on this particular 80 rupees and so on. Clear with this, guys? So now in this case, what happens? Every year cash outflow, I need to compute it separately. How will you compute it? Simple. Take the opening balance of the debenture amount that you have. On that, you apply the interest amount. So interest percentage, you will arrive at the respective year's interest value into 1 minus tax rate. You will do the respective year net interest outflow. You will be getting it. Clear with this, guys? And with that, you do the simple IRR calculation. You can't use this, the shortcut method formula and all cannot be used. You need to arrive at your IRR formula only. So here what we do, cash flow divided by 1 plus cash flow at the end of year 1. So first year cash flow divided by 1 plus R the whole power n. R stands for KD here. Plus the second year cash flow divided by 1 plus KD to the power 2 and so on till the end of the life of the asset. I mean, end of the life of this particular instrument. Let's say it's 10 years. So cash flow at the end of 10th year divided by 1 plus KD to the power 10. So if you do this and arrive at the present value, you will get the value of bond. VB stands for value of the bond or debenture, Or in other words, it's nothing but your IRR calculation. IRR is a rate at which your NPV is 0. Or in other words, the present value of cash inflow is equal to present value of cash outflow. You take 2 trials, and for one trial you'll get a negative NPV, for another trial you'll get a positive NPV, interpolate the two and arrive at the KD figure. And as simple as that. The next one, cost of convertible debentures. So what do you mean by convertible debentures? These debentures can be converted into equity shares at the end of their life, right? Now, in this case, what happens? Every single thing is same as what we saw earlier. You can use the formula method or you can use the IRR method. But what happens here is calculation of redemption value. Now, in case of convertible debenture, what happens? You are giving the debenture holders an option to take equity shares at the end of the life. Let us say at the end of the life of the debenture, the equity shareholders are given an option, right? Sorry, the debenture holders are given an option, right? So for every debenture you hold, I will issue 2 equity shares, correct? Or you can take 100 rupees, that is nothing but redemption value paid in cash. Now what they will do, 2 equity shares if they get, first they will go to the market and check for every 1 equity share what is the market price. Let us say per equity share the market price is 60. So now what they will do, if they are getting 2 equity shares with every equity share having a value of 60, literally they are getting 120 rupees worth of money, correct? This is more as compared to taking cash from the company. So now what will the debenture holder exercise? In this case, will they go for getting 2 equity shares or will they go for getting back 100 rupees from the company? They will only prefer taking 2 equity shares. That's why in case of convertible debentures, the redemption value is taken as higher of the cash value, in our case 100 rupees, or value of equity shares, that's nothing but 2 equity shares into rupees 60. That's going to be how much? 120, right? In this case 120 will be the redemption value. Apply it for all your calculations, whether you are using an IRR method or you are using your shortcut method. Redemption value figure will be taken as 120 for this particular example, and as simple as that, guys. Now let's move on to the next one. Zero coupon bonds. Very simple. What do you mean by zero coupon bonds? They are also called as deep discount bonds. These bonds are issued at a discount and redeemed at par, and during the life you will not have any kind of interest payments. Now in this case, a simple present value of, your time value of money concept only. So how will you do it? Simple. The present value, B0 stands for the value of bond as a T0 today, right? Present value is equal to future value divided by 1 plus r the whole power n. This is the formula which we have seen in our time value of money area itself. Clear with this? Now in this case what happens? So present value is nothing but value of bond B0 is equal to future value is what? Redemption value that you will be giving them, divided by RV divided by 1 plus r. R is nothing but the discount rate. Discount rate for debentures or bonds in this area is going to be called as KD to the power n. Clear with this, guys? So you can substitute the figures and you will arrive at the KD. So you will have this figure, you will have this figure also, n will also be available, right? So now you will need to arrive at the KD figure. Once again, using your IRR concept only, take 2 trials and interpolation, you will arrive at the answer. Clear with this, guys? We have done detailed questions about this in both our regular and fast track batches. So that's about this area. Quick revision and we are done here. The next one, treatment of short-term debt. Always remember, short-term debt is a part of current liabilities. It's not a part of long-term sources of finance, because in this chapter I told you we are focused more on the long-term sources of finance. Hence, any short-term debt should be ignored for all our calculation purposes. It's not a part of capital employed. It should be ignored. Example is your trade, your trade payables, your creditors, and all of that. Clear with this, guys? Next, finally, cost of long-term bank loan. Now, in case of bank loans, right, you need not calculate RV, NP and all that, because there is no redemption value, no issue price and all. Whatever amount that you actually receive from the bank, you need to repay it back. The only cost associated with a bank loan is actually an interest. So directly you can say KD. D is basically D stands for debt, right? And debt could either be a debenture or a term loan also. So because loan is also one variety of debt only, right? It's a fixed income security, right? So, or there is a fixed payment security, you can say, from the perspective of the company. So here, what's going to be the cost? Interest rate into 1 minus tax. Similarly, here also interest is tax deductible. No doubt I need to pay an interest, but because I'm paying an interest, I'm going to get some tax benefit. So interest rate into 1 minus tax, if you do, that's going to be your effective cost of KD. As simple as that, guys. Yes, there is no concept or of premium or discount, right? And with this, literally, we have covered the entire concept of your cost of debt, KD. Now, let's move on to the next one, cost of preference, KP. Very simple, very simple. This is exactly the copy paste of your KD with only one difference. Instead of interest, you will be having a preference dividend, and there the annual cash flow will be interest into 1 minus tax rate. Here, there is no tax shield and all. So instead of I into 1 minus t, wherever you find I into 1 minus t, instead you will put here preference dividend, PD, as a short form. And as simple as that, everything else is same. The preference shareholders are paid dividends at a specified rate, right? And the payment of dividend to the preference shareholders are not charged as expenses but treated as an appropriation of profit. Hence, the dividend paid to the preference shareholders does not reduce the tax liability of the company. Like the debentures, the preference share capital can also be categorized as redeemable and irredeemable. So irredeemable and redeemable. What do you mean by irredeemable? So irredeemable debentures are basically, they are not repayable. It means what? So you need not repay back the capital. Lifelong, you need to keep on servicing the preference dividend. Whereas redeemable preference shares, the ones which comes with a finite life. So at the end of the life, that is, let's say 10 years, in our example, you need to repay back the original capital, and till then what you need to do, you need to pay them the dividend amount. Everything is same here. Now, cost of irredeemable debentures. So how will you arrive at it? Very simple. KP is equal to preference dividend by P0, or you can also call it as net proceeds. P0 is the present value as on date. It's also known as net proceeds. You can also rewrite this as net proceeds, no problem. The logic for this exact time value of money concept, or you can even say what the company pays, what I pay divided by what I receive. That's the logic. What the company pays every year, preference dividend. What they receive, net proceeds. Clear with this. And net proceeds is always adjusted for flotation cost, and as simple as that. In case of redeemable preference shares, what is the formula that you need to use? There are two formulas. One is called as YTM, yield to maturity model. It's also known as the present value or the IRR model. The second one is called as your shortcut method, also known as formula or approximation method. Now, in your first method, YTM model, what will you do? Of course, you need to frame a cash flow equation, and once you frame the cash flow equation, you need to take two trials, right? At one trial, you'll get a negative NPV, one trial you get a positive NPV. You need to interpolate the two and arrive at the exact amount of IRR, and IRR using the preference cash flows is called as KP, and as simple as that. In case of shortcut formula, it's pretty much simple. So what is going to be my cost involved with respect to preference share capital? Simple, it's going to be preference dividend, correct? Is that the only cost? No. Here also, the spread or the difference between my redemption value and the net proceeds can be a cost for me. Yes, let's say I have actually received 90 rupees. Net proceeds is 90, whereas when I need to redeem it at a premium of 110. Redeem it at a premium of 10 rupees, 110. Now I received 90, but I'm repaying how much? 110. So of course, the difference between the 20 rupees is a cost for me. Yes. Now this is the cost for the entire life of this particular preference shares. So I need to divide it by the life. Hence, RV minus NP by N is also a cost. So what will be the KP formula? So on the numerator, you have the total cost. What is it? Preference dividend, right? That's anyways get paid for a year, right? Plus RV minus NP. This figure is a cost for the entire life. So divided by N, the whole by RP plus NP by 2. Why RV plus NP by 2? Because I have two figures of preference share capital. Now, what I received, what I paid also, correct? Right? Which one to take? Take a simple average of the two. That's called as the approximation method. And nowhere in this method you can find the tax shield, because your preference dividend is not a tax deductible expense. We saw that at the beginning of this discussion itself, right? Where PD stands for annual preference dividend, RV stands for redemption value, NP stands for net proceeds, and N stands for the remaining life of preference shares. That's about it. Now, once again, doubt busters section. In the absence of any specific information, so students can use any of the method, that is YTM or approximation. An approximation method gives only the approximate value, whereas YTM gives you the accurate value. Always IRR gives you the correct value. And net proceeds mean issue price less flotation cost. We know that in case in the question issue price is not given, you take the current market price. If the current market price is also not given, take the face value. These are all standard assumptions. And finally, if the flotation cost is not given, assume it to be 0, and as simple as that. Now, let's move on to the next component of your next different source of finance, which is called as your equity share capital. Now, Now, with respect to equity share capital, there is one unique aspect. First, there is no contractual obligation on the part of company to pay a fixed amount as dividend, right? That is number one. And number two, there is no concept of repayment when it comes to equity share capital. Now, because of these two unique characteristics, now this component of KE, that is your cost of equity, we have different methods to arrive at your KD figure because it's a very unique source of finance unlike the other ones. Clear with this, guys, right? Now, in this case, KE, as we learned earlier, every cost is nothing but an expectation from the perspective of an investor. So KE is also an expectation from the viewpoint of the equity shareholders, and it is quite complex because there is no fixed contractual payment for equity shareholders, and moreover there is no concept of redemption as well. Hence, there is not a single method to calculate your cost of equity, but you have a variety of methods which are as follows. Now the answer of KE which you arrive under each of the methods will definitely be different. It will not be the same. Now, what are the different methods of arriving at KE? So, first one is called as dividend price approach. Then you have earnings price approach. Then you have growth approach. It's popularly called as the Gordon's model, right? The Gordon's model. Then you have a realized yield approach, and you have something called as your CAPM, your capital asset pricing model. Now, quickly, let's recapitulate what are all the different methods. The first one, dividend price model. Now, when will you use this model? When it is assumed that, when you take an assumption, or when it is given in the question that the company is going to pay a constant amount as dividend up to perpetuity. Look, I'm going to pay the same amount of dividend for the rest of the life. If this is the assumption taken, or if this is the fact given in the question, only then will you use this method called as your dividend price model. Simple. So in this case, what will be the figure? I mean, how will you compute? What will be the formula? Very simple. Your P0, or the present value of the equity share, is going to be, recall our discussion in our time value of money concept, present value of equal cash flows up to perpetuity. What is the formula? It's going to be annual cash flow, in this case dividend, divided by discount rate. In this case, the discount rate is called as KE. Clear with this, guys? Or if you cross multiply this, right, you will get KE is equal to D divided by P0. The exact logic which we saw for irredeemable debentures and irredeemable preference shares, the same logic goes on here, but this will work out only if the company pays a constant amount of dividend for the rest of its life. Are you all understanding this? Yes. Now, or you can also remember this by saying what I pay divided by what I receive. By the way, P0 is nothing but your net proceeds. Your net proceeds today, what is the amount that I receive from the public? Or in other words, it's nothing but issue price minus flotation cost. As simple as that. Clear with this, guys? So KE stands for cost of equity, D stands for expected dividend. Some people even write it as D1, but it doesn't make any sense at all. It's only your D, that is your annual dividend, and because D1 means dividend at the end of year 1. Now here we are using this model. When the dividend is constant, you take D1 or D2 or D500th year from now, it really doesn't matter. It's going to be the same because we are taking an assumption that the company pays the same dividend every year. And P0 is the market price of the equity share. They have given some X dividend. No, do not worry about that. This is basically your net proceeds, the net cash inflow the company receives. The next one, earnings price model. Now in this case, what we are doing, we use this model exactly same as the first model, your dividend price model, but here you don't discount just the dividend, you discount the entire earnings. Because here what this method says is, look, if a company earns 10 rupees, earnings per share is 10 rupees, out of this they pay 8 rupees per share and retain 2 rupees as a retained earnings. Now in the first method, we considered only 8 for our calculation, dividend per share, and we arrived, but literally speaking, the entire earning amount belongs to the equity shareholders only. So in this case, instead of dividend, you take the entire earnings per share and use that for your calculation. So if you take earnings per share for your calculation, then what will be the formula? Simple. There we saw it was D divided by P0, or D divided by net proceeds. Here instead of D, you take it as E. So earnings divided by your net proceeds, where E stands for earnings per share and P0, or basically P, or in other words N, you can call this as NP. So here NP stands for the net cash inflow the company receives today. So issue price minus flotation cost. Clear with this, guys? The same model, what I pay upon what I receive, but here I actually don't pay the entire amount. It belongs to the equity shareholders, hence it should be considered for all our calculation purposes. Clear with this, guys? And that's about the second approach of earnings price model. The next one, growth approach or Gordon's model. Now, will the earnings always be equal exactly? That is, earnings or dividend, both the cases. Will the amount be exactly the same for every year? Absolutely not. The company needs to grow. So, when will you use Gordon's model? When the company is growing at a constant rate. If it is given in the question that the rate of dividend growth remain constant, not the dividend amount, the growth rate is constant. Let's say the company grows every year, right, at the rate of 5%, which means what? First year, if they are paying 10 rupees, right, the second year dividend will be what? 10 into 1 plus G. In our case, it is going to be 10 into 1 plus 5%, or 10 into 1 plus 5%, that is 1.05. Correct? Correct, guys? Yes. So it's going to be 1.05. Clear with this, guys? Similarly, if the next year they are going to pay whatever, the next year is going to grow by 5 more percent. So from the second year cash flow, it's going to be what? 10 into 1.05. This is the first year's cash flow. I mean, this was the end of second year's cash flow. The third year, they are going to pay what? 10 into 1.05 into 1.05. That is one more 5% growth as compared to the previous year, or I will call it as 10 into 1.05 to the power 2. And it goes on like this. Clear with this, guys? So every year, the company will be paying 5% more than what they paid in the previous year, provided the growth rate is taken as 5%. Now, this is what this model says. If the company is going to pay a dividend at a constant growth rate, then you will use this particular model called as Gordon's model. Clear with this, guys? Now, in this case, how will you do all the computations? Very simple. Once again, refer back to our discussion in our time value of money concept, where I said the sum of infinite growing cash flows model is going to be cash flow at the end of the present value is equal to cash flow at the end of year 1 divided by discount rate minus growth rate. So we have seen all these things in depth in both our fast track and our regular lectures with the derivation. I showed you some of geometric progression. This is done using a concept of geometric progression and all. So now in this case, let's replace all the figures. Present value is P0, or net proceeds, you can take anything, is equal to CF1, cash flow at the end of year 1 is nothing but D1, dividend at the end of year 1, the first year's dividend, right? In this case, the first year's dividend, 10 rupees, right? Divided by discount rate, that we call it as KE, minus growth rate, we call it as KG, we call it as G. Correct? Now just cross multiply, bring the numerator there and denominator here. So KE minus G is equal to D1 divided by P0, right? Or in other words, KE is equal to, this G goes the other side, D1 divided by P0 plus G. Clear with this, guys? That's the formula here. K is equal to D1 by P0 plus G when your dividend is growing at a constant growth rate, right? So this is what I've seen mentioned here. D1 is nothing but D0, current dividend, into 1 plus growth rate, and that's nothing but the net expected dividend. We have literally done a lot of numerical problems in our lectures and all that. So please use the library of adjustments when you are revising it along with the marathon. Clear with this, guys? In case you have done a self-study or you have attended classes elsewhere, right, please know that this is the logic for arriving at your KE figure. Now, P0 stands for what? It's your current market price, basically your net proceeds. That's the P0 exact value. And G stands for constant growth rate of dividend. I have taken all these from the institute study material, hence I didn't change these, but literally during our explanations in the classroom also, I have told you this is nothing but your net proceeds only. Clear with this, guys, right? And of course, in case of newly issued equity shares, the flotation cost should be adjusted. Always remember, P0 stands for what? Net proceeds only, right? If they have given a flotation cost, you should also adjust it. If it is not given, ignore it. As simple as that. So it's not a separate formula that needs to be remembered. Next one. There is a confusion regarding D1 and D0. I've kept it in the doubt busters segment. What is it? If the words dividend expected is given, then the figure given in the question itself is D1. If the words dividend paid is given past tense, then the figure given is D0. If in the question they are if it's silent, then they have just said dividend is 5 rupees. Then sir, should I directly take it as D1 or should I take it as D0? It's your choice. You can either take it as D1 or D0, but please write a note in this regard, right? Now, in certain sums, what has happened, they have given expected dividend is 5 rupees, which means ideally it is D1 only, but still they have taken it as D0. This is one controversy that is actually there. Now, what you can do, yes, you can take it as D1, but please always write a note. So, whenever dividend comes in, please write a note and leave it there, right? That is my suggestion. The next one, yes, calculation of growth rate. There are two ways of calculating growth rate. So one is called the average method, the other one is called as the Gordon's method. So under the Gordon's method, G is equal to BR. B stands for earnings retention ratio and R stands for your rate of return on funds invested. That's nothing but your return on investment. Also at times you can also take it as return on equity. This was an in-depth discussion which we actually saw in our dividend decisions chapter, ideally in our batches and all, right? Anyways I'll be covering even in the marathon during your dividend decisions chapter. Along with that, I'll be covering the first one. It's a very simple area. Basically, we saw example D5 dividend at the end of year 5, can I say is nothing but D0 into 1 plus G to the power 5, correct? That is present value into 1 plus R to the power 5, compound interest formula, correct? Right? Or in other words, can I say D5 divided by D0 is equal to 1 plus G to the power 5, correct? Or in other words, if this 5 to the power 5 goes to the other side, that is from RHS it goes to LHS, this is nothing but D5, one second, I'll erase this. Okay, it's nothing but D5 divided by D0 whole power 1 by 5 is equal to 1 plus G. Correct, guys? Right? Or in other words, here this is nothing but D5 by D0, right? The root power 5, which means what? To the power 1 by 5, right? So this 1 plus G is that. This plus 1, if I take it the other side, it becomes minus 1 is equal to G, right? So G, the formula, this is what I have mentioned here, D5 upon Dn. So one second here. Yes, so this is what it is. This is what it is. So it is going to be, so D5 divided by D0, the whole power 1 by 5. In our example, we took the life as 5 years. So this is what we did. Minus 1, if you do, you will get this G figure. So I think this has to be dn by d0, because as per I just derived this formula for you, it has to be dn by d0, that is dividend at the end of nth year upon d0, the whole power 1 by n minus 1, you will get the G figure, right? So this is something that I derived and showed it to you. The other one, the Gordon's growth formula, is actually something that we'll be seeing in our dividend decision area. Now, the next method is called as realized yield approach. Now, this particular approach is done from the perspective of an investor, right? According to this approach, the average rate of return realized in the past few years is historically regarded as the expected rate of return in the future. It computes the cost of equity based on the past records of dividend actually realized by the equity shareholders, and this is based on the principle that the cost of the company is equal to the investor's return. So this entire method is nothing but IRR calculation done from the perspective of an investor, right? And whatever is the return for the investor is treated as the cost of the company. This method is computed from the investor's perspective and is normally followed when the shares are sold by the equity investor after a few years in the secondary market. Here K is calculated by discounting the relevant cash flows using IRR concept. Once again, we have done quite a few numerical problems in both our fast track and our regular lectures. In depth we have done it, and we have explained the learning points also. We have neatly noted it down, right? The next one, the CAPM, capital asset pricing model, right? So now this is actually a risk return trade-off model. Again, I told you the logics as well during the course of lectures. Now let me quickly recapitulate here for the benefit of everyone, even those who have not watched my lectures before, even for the sake of their benefit. Let me just explain it. Now K is equal to RF plus beta times RM minus RF. So RF stands for risk-free rate of return, risk-free rate of return. RM stands for the market rate of return, and RF here, whatever we saw, was the risk-free rate of return only, and beta coefficient is actually a statistical measure to calculate risk. What is this? RF. Let's say if I invest in FDs, right, risk-free investment, Let's say I will get a return of how much? 10%. Here with this, guys. Now, obviously, if I'm going and entering into the share market, I will be expecting more return on an average. If I'm entering into the markets, my expectation is how much? Let's say 15% in on an average. Clear with this, guys, right? Now, beta is, as I told you, it is actually a coefficient of risk measure. Now, in market, there are so many companies. Now, let's say I want to invest in one company called company A, or let's say ITC Limited, right? And the beta coefficient of ITC is 2, right? It is generally given in the question. What is beta? How to compute is a subject matter of discussion in final, CA final, AFM. I will teach you that. Right now at the intermediate level, this figure will be given. Now, how do you compute KE? Simple. When I'm investing in company, this company ITC, definitely I will definitely expect 10% plus. Now, RM minus RF, what is that? 5%. Now, the moment I enter into market, definitely from the market, definitely I will expect this extra 5% for sure. Correct? I will definitely expect this extra 5% for sure, right? I will definitely want this 5%, but I'm investing in a company that has a risk measure of 2 times, right? So I will expect 2 times the premium, market risk premium, as I call it. I will expect 2 times the 5%. In this case, what happens? My expectation of return from the investor of this equity shares invested in this company ITC will be 10%. Definitely he wants RF, plus beta times he wants the market risk premium, another 10%. So his expectation is going to be how much? 20%. An expectation of return from the perspective of the equity shareholder is going to be the cost from the perspective of the company. Cost of equity in this case is going to be 20%. Are you clear with this? This is how the computation is done, and this is the logic behind arriving at it. Clear with this, guys? Yes. So here K stands for cost of capital, RF stands for risk-free rate of return, B stands for beta, the beta coefficient, RM is the rate of return on market portfolio, and RM minus RF is called as the market risk premium. Now in your exam, if they have given market risk premium, it stands for what? The difference between the two, not RM. Clear with this, guys, right? And that's about it, this segment. The next component is KR. Very simple. KR stands for what? Your cost of reserves, and reserves belongs to whom? The equity shareholders. So literally this is also the money that belongs to equity shareholders, as it is very much part of the equity. Correct, guys? Yes. Now even on this figure there will be some expectation, even on the amount of retained earnings there will be some expectation of return from the perspective of the equity shareholders. Correct? Yes. So obviously the accumulated profits, also known as retained earnings, right, will also have a cost associated with it. Sir, then what is the cost, sir? Simple. KR is equal to KE, because this amount belongs to equity shareholders. So whatever is the expectation of return from the perspective of equity shareholders that we calculated KE, right, the same figure is only KR. Clear with this, guys? Right? Now there is something that you need to understand. Now for the purpose of KR computation, now what will you use? The same 5 methods which we saw for KE calculation, the same 5 methods can be used even for KR calculation. Clear with this, guys? So the 5 methods that we saw earlier, the same 5 methods, you can once again use it for KE calculation. But remember one thing, whenever you are computing, whenever you are using the net proceeds for all the calculation, never consider flotation cost if you are doing the computation for your KR. Reason, when I'm using KR, accumulated profit, I already have the money. I am not raising it from the public. In this case, there will not be any cost related to the issue. Hence, your issue price or flotation cost will never arise when you're doing a KR computation. Are you all able to understand this? Yes. So that is one important observation that you need to have, right? That's number one. And number two, look at this. For the calculation of KE, P0 is equal to nothing but net proceeds is issue price less flotation cost. Now, the same formulas I can use it for KR calculation, but whenever I'm using for KR calculation, I will use the current market price, right? I will use the current market price. If current market price, give the first preference to current market price, because there is nothing called as issue here, right? So that generally I told you, first preference issue price. If that is not available, current market price. If that is also not available, face value. In this case, what I'm telling you, give first preference to current market price. If that is not available, and in the question for some reason they have given issue price, then you take issue price. Clear with this, guys? However, ICA has used current market price and issue price interchangeably. For some, sir, both the data is available. What will I use? Now, ideally speaking, you should only use current market price. That's my suggestion. But institute has randomly used either of the two. So then what should I do for exam? You follow anything but write a note, and that's what I would suggest. But my logical suggestion would be better take current market price. But it's your choice in exam because institute has also interchangeably used it. Just write a note and leave it there. Clear with this, guys. Now, one more thing. In case of your retained earnings, there could be cases where in the question they can give you personal income tax of the investor, personal brokerage of the investor. Brokerage is nothing but the expense that he incurs for maintaining his demat account and all, right, for dealing in shares in the the markets. In case that is given, these two figures also need to be adjusted. How will you do? Simple. KR in this case is equal to KE. KR is always equal to KE. Yes, into 1 minus personal tax rate of the investor. Why? It's an outflow. So the net amount only he will receive. Correct? Into 1 minus your personal brokerage also, because that is also an outflow for him. Reduce all of that. Let's say he's in a tax bracket of 30%, and let's say he has a brokerage of how much? 5%. And let's say KE is 10%. Example, I'm telling you. Will he receive the entire 10%? No, no, no. What happens? 10% into 1 minus 30%. 30% tax will go. He'll only receive 70% of this. Is correct. And on top of it, he's also incurring an expense of how much? 5%. So on this net figure, once again, you'll only receive 95% because 5% goes as a cost. So this net figure, whatever it is, that will only be his net earnings. And the net earnings, or basically the return from the perspective of an investor, is equal to the cost from the perspective of company. All these things you will use only if it is given in the question, nothing as such. Clear with this, guys? So KR is always equal to KE, subject to two exceptions. Exception number one, when there is a flotation cost involved in the question, then the flotation cost should not be considered for the purpose of KR calculation, but it should be considered for the purpose of KE calculation. And number two, when there is a personal income tax or brokerage given in the question, that also needs to be adjusted. So in that case, KR is equal to KE into 1 minus personal income tax into 1 minus brokerage. And as simple as that. Clear with this, guys? And that's about this segment also. And finally, you have the weighted average cost of capital. So how do you compute the weighted average cost of capital? So this we will be doing with a numerical example. Very simple. You just need to take the respective sources of finance, right? Using that, you will arrive at the weights and arrive at the respective costs. You just multiply the two figures, you will arrive at the weighted average cost of capital. So what it is and all, we will just be seeing with the help of one numerical example. Now, let's go and take one numerical problem from our solved question bank, right? So now, we'll take a past exam question. This was once tested in September 24 attempt. So this is question number 11B. With the help of this example, it's a comprehensive sum. We will be recapitulating whatever we have studied till now. We'll be putting the figures right now and we'll be completing it, right? Now, the capital structure of T Limited as on the 1st of April 2024 is as under. So equity share capital. So the per share face value is 10 rupees. So the total value, the book value of equity share is how much? So it's going to be 50 lakh rupees, which means they've got 5 lakh shares at the rate of 10. This is the meaning, right? So the total share capital, equity share capital value is 50 lakhs. Per share, the face value is 10, which means the total number of shares is 5 lakh. Next, debenture, 10% debentures of 100 each. So the value is 40 lakhs. Simple. So the company has got 40,000 debentures at the rate of 100. That's the meaning here, right? So only then it comes up to 440 lakh rupees. Then the 12% preference share capital, you've got 10,000 shares at the rate of 100. The value is going to be it's going to be 10 lakh rupees. Fine. So now they've given the sources from which they've raised the money. Additional information. The risk-free rate of return is 10%. The beta of T Limited is 1.75 times, and the return on market portfolio is 12%. The equity shares have a current market price of 70 rupees per share. Now, clearly, guys, now these are the data required to calculate KE. Now, KE can be calculated from any of the 5 methods. Now, which method should we use? Clearly, based on the data given in the question, we can understand that the requirement of the question asks you to solve it under the CAPM model. Under CAPM model, what's the formula? K is equal to, so RF plus beta times RM minus RF. So RF is 10%, beta is 1.75, and RM is going to be 12%. With this, you can arrive at KE figure. The next one. The debentures are trading at a market price of 80 per debenture, and the debentures are redeemable after 5 years at par. So which means, is it a redeemable or an irredeemable debenture? It's a redeemable debenture. Interest rate is 10% and all. Now you can either use the YTM IRR method, or you can use the shortcut method, arrive at the KD figure. Next one, preference shares are redeemable after 5 years. Once again, this is also redeemable, but this time they are redeemable at a premium of 5%, and presently they are selling at 104 per share. That's the current market price, right? Next one, the company pays a tax rate of 30%. The cost of debenture is to be calculated on yield to maturity model, which means for KD calculation use IRR method only, right? And then KD, that is yeah, so now here they have given, yes, for this you need to use only this method. Then for KP, you can use any method. If nothing is mentioned, preferably use that formula method, right? Preferably use the formula method or the shortcut method, as we call it. It saves a lot of time in exam, right? So this is the reason why I have kept this sum, because for one KD, we will calculate under IRR method. For KP, we will calculate under shortcut method. And you have all the components of finance. And we are also going to compute the weighted average cost of capital. A very good comprehensive question to wrap up the entire discussion on your cost of capital chapter. Now look at this. The present value tables are also given 10%, 14%. Why have they given this? Clearly, they have given this for your KD calculation, that is IRR calculation. Why? Because in IRR you need to take 2 trials, correct? These are the 2 trials you need to take. So that's why I always keep telling you also, right? In this particular IRR calculation, generally in your exam they will give you the trials and all. So you need to do the interpolation and do it. What it is, we will quickly see here. You are required to calculate the weighted average cost of capital. Obviously, it's post-tax, because why post-tax? We consider the tax shields and all, no, for your debenture calculation, KD calculation, right, of T Limited, using market value weights. So now your cost of capital WACC can be calculated either using your book value weights or using market value weights. If you're using book value weights, you'll use this proportion, 50, 40, 10. Market value weights, you need to arrive at the number of shares into the market value are readily available for each of the components, right? The number of securities into market value per security, that is per debenture or preference share or equity share. If you do this, you will arrive at the market value of each of the components, use that as a weight, and also you can arrive at your cost of capital. What it is, we will be seeing it. Now first guys, now let's get started here. First one, calculation of KE. Clearly we need to use what method? We need to use the CAPM model. So what is the formula here? K is equal to RF plus beta times RM minus RF. So that's going to be, so RF was, it's given in the question 10% plus beta given in the question 1.75 plus RM minus RF. RM was 12%, RF is 10%. So it's nothing but 10% plus 1.75 times of 0.02, that is 2%. If you do it, you will arrive at what? 13.5%. Clear with this guys, right? And that's about this area. First one, KE calculation is sorted. Clear with this guys. Next, calculation of redeemable debenture. First thing that you need to do is frame the cash flow equation. First, at year 0, today, what will be the net proceeds or P0? What is the amount I will be receiving? Please read the question. Read the question. Has issue price been given in the question? No, but they have given the current market price. In the absence of any information on issue price, you can assume that the issue happened at the current market price, 80 rupees. Are you clear with this, guys? Yes. And then have they given any flotation cost? Nothing. So you need not adjust that. So the current market price is going to be your issue price. Today I'm receiving how much? 80 rupees. Now, during the course of 5 years, what will be the annual cash outflow? Every year, the company is going to pay an interest of 10%. So 10% on 100, 10 rupees, but wait, parallelly, there is a tax saving. So the net cash outflow will only be how much? I into 1 minus C. So 1 minus T, that is 10 into 1 minus 0.3, that's going to be 7 rupees. So basically, for every 10 rupees I pay, I actually pay 10, but I save 3 rupees in taxes. The net cost for me is only, the net outflow for me is only 7 rupees. And at the end of the life, that is the end of 5th year, so have they given any redemption value? Nothing. Assume that the redemption happens at par. So here the redemption happens at 100 rupees. So this is how you will first frame your cash flows. Now put it up in a cash flow equation and you need to arrive at the NPV. So for 2 different rates. Now we all know that your IRR is the rate at which your NPV is equal to 0. NPV is nothing but present value of cash inflow minus present value of cash outflow. Correct? Yes. Now, in this case, what happens? initially what happens? So I receive a cash inflow of how much? 80 rupees, right? And for each of the 5 years, 1 to 5, I actually pay them how much? 7 rupees, correct? No, right? That is nothing but, so your I into 1 minus t, and at the end of 5th year, you also end up paying 100 rupees. Clear with this, guys? So now, if I take my discount factor as 10%, first trial, right? So 80 rupees will be multiplied with 1. Why? Because it's already in present value, correct? Now, this 7 rupees, it happens over a course of 5 years, correct? So the first year cash flow should be multiplied with 0.909, second year cash flow with 0.826, third year with 0.751, fourth year with 0.683, and the fifth year amount with 0.621. And all these figures every year, if you see, I am having a cash outflow of how much? 7777. So you can take 7 common and you can add up all these things. We saw this is called as annuity table and all. So if you add up all these discount factors, right, it comes out to how much? 3.790, right? If you multiply that with 7, you will arrive at the present value of 7 rupees paid over a course of 5 years at a discount rate of 10%. Clear with this, guys? And at the end of 5th year, you pay how much? 100 rupees. That is 100 rupees paid at the end of 5th year. So arrive at the present value of that, multiply it with 0.621. That is going to be the discount factor of 10% for 5 years. Clear with this, guys? So now what you do? So this has a different sign because this is an inflow. So they have put it in negative. Ideally speaking, what you can do, you can take this as positive and take these two as negative also. Not a problem. Not a problem, because the signs, what you need to do is, the first inflow, if you're taking it as positive, the outflow should be negative, or you can also reverse it. So your inflow, you can take it in negative and put your outflows in positive. Not a problem. The final answer will not change because ideally you are matching your cash inflows with outflows. Not a problem. But in this case, what they have taken, so they have taken the inflows in negative and outflows they have taken in positive. But remember, there should be two signs. That's all you need to know, right? But that sign, you can do it in any which ways. But literally speaking, in this case, the inflow should have been in positive, outflow should have been in negative. But follow it consistently. The answer, the final answer will not change, right? Now, in this case, what happens? The present value of inflow, how much is that going to be? It's going to be, so 80 into 1, that's going to be 80, right? And of course, there is a total number of debentures also being issued here. So here, 1 second. Yes. Yes. So basically, this is not a comma, this is point. So 80 into 1 is 80.000, or basically 80. 7 into 3.790, it is going to be 26.530. Here 100 into 0.621, it's going to be 62.100. If you add up everything, so how much you get? You get 8.630. So this is the figure that you will be getting. Now guys, basically I told you here this 80 rupees is actually a cash inflow, correct? And this whatever 7 rupees paid every year, and at the end of the life you're repaying back 100. These are all cash outflows, correct? So strictly speaking, this 80 should have been in positive and these figures should have been in negative, correct? No, right? This is what I told you. So now this basically we took it from actually the institute suggested answers only, but looks like what they have done at the time of presenting, they put negative here and they put positive here, but for calculation purposes, they took 80 as an inflow, positive, and whatever they are paying during the course of the life, they took that as negative. So correctly, they have done the calculation. That's why the final answer is coming out to 8.63 in positive figure. So basically what I'm doing, 80, this comes in positive, within bracket 26.53 and 62.1 within bracket. Final answer you get is positive 8.63. Are you all clear with this, guys? Yes. So this is what ideally they have done. I am just erasing this off. It might confuse. So let me not do all these things. Basically here, what they have done is, so 80 is considered as what? The inflow, and whatever is the present value of outflow they have done. So the net present value you get is how much? Positive 8.63. So is 10% your discount rate? No. Why? Because had 10 been your discount rate, you'd have exactly got the final answer as 0. Why? Because your IRR is nothing but the rate that makes your NPV equal to 0. Now, what will you do? Take the next trial as 14%. So now in this case, what will you do, guys? So for 14 percentage, what is the discount rate? Already this 80 is in present value 1. Every year I pay 7 rupees. So now what I need to do here is I need to take the discount rates from this particular table, add up everything, you get the annuity factor that is equal to 3.432. So 7 rupees exactly every year I am paying for 5 years. So the present value of 7 rupees paid for 5 years discounted at 14 percentage, so that discount factor alone is going to be 3.432. And finally this 5 rupees, I mean at the end of 5th year, this 100 rupees that I pay, no, right? So that I need to arrive at the present value, multiply it with 0.519. So multiply it with 0.519. So now what you get here, so now basically in this case what happens is, so I need to end up paying, so one second, I think there is a small issue here as well. So here also they have just taken this in negative. Here also they have just taken it in negative. Guys, this is actually one one mistake that they have done. I wouldn't call it a mistake, but overall the net effect of this answer is going to be the same. So now let me just do this once again, the entire calculation. Let me just do this once again for you because I don't want to confuse. Now I will take this and do this separately. Now look at this. What we got was, with respect to the figures at the 10% discount rate, right? With respect to the 10% discount rate. Now what was the present value figures we got? Now here 10% I'll take 0, 1 to 5, and at the end of 5th year, right? These are the three figures that we have. So I will just take these and do this separately in order to avoid confusion. So let's deal with clarity here. So one second, just pushing it up a bit. Okay. Now actual cash flow before discounting, right? At the end of today, that is at the end of right now, present, I am receiving how much? 80 rupees. And for each of the 5 years, the net cash outflow is going to be 7. And at the end of 5th year, I am going to pay how much? I'm going to pay 100 rupees. This is what we saw. Correct, guys? Yes. Now, if you multiply it with respective discount rate, the figures are all correct. First, at the present value of 80 rupees received today is already in present value. It will be how much? Positive 80. Here, next, 7 rupees, right? 7 rupees being paid for a period of 5 years, right, will have an annuity factor of 3.790. So 7 into 3.790 comes out to 26.53. So this 26.53 should be what? In negative. The next one, 100 rupees I am paying at the end of 5th year, right? It has a discount rate of 0.621. The present value of 100 rupees paid at the end of 5th year is going to be 62.1. Since it's an outflow, I need to put it in a negative figure, 62.1. Clear with this, guys? Now let me take the calculator. Now here 80, right, minus 26.53 minus 62.1 gives you how much? Negative 8.63. Clear with this, guys? It gives negative 8.63. Whereas here for them it is giving what? Positive 8.63. Sir, why? Because they took the first figure in negative and the remaining figures in positive. That is the reason they are getting it in positive. Sir, can I do it like how you have done? Absolutely, you can definitely do it. Nothing to worry about that. Clear with this, guys? Yes, final answer, if you see, will not change. I will show it to you. Next one. If I'm taking a discount factor of 14%, all the calculations are given. So they are all correct only, but the signs alone will change. I didn't want to confuse. That's why I'm redoing this. This, by the way, whatever I'm showing it to you here right now, we have taken it exactly from our suggested answers because it's a past exam question. But yes, you can definitely do it like how I'm doing right now. They will give you the full marks. Nothing to worry about that. Okay. Now the present value of 80. So in case I'm going with a discount rate of 14%, right? So what is going to be my present value of 80? Continues to be 80. It's positive, right? Because it's already in present value. Next, 7 rupees paid for each of the 5 years discounted at 14 percentage. So 7 into 3.432 comes out to how much? 24.024. It comes out to 24.024, but this will be in negative because it's an outflow from the viewpoint of the company. Can do the calculation also. 7 into 3.432 comes out to, yes, 24.024. Next, 100 rupees paid at the end of 5th year, discounted at 14 percentage. 100 into 0.519 comes out to how much? 51.90. So it's going to be how much? Negative 51.90. So if we net off everything, 80 minus 24.024 minus 51.90 comes out to how much? 4.076. You get a negative or a positive 4.076. You get a positive figure. 80 minus 24.024 minus 51.90, you get a positive 4.076. Clear with this, guys? Now, is 14 percentage your IRR? No. Why is 14 percentage not your IRR? Had that been your IRR, you would have definitely got the NPV as 0, but you're getting a positive figure. So if I take 10%, I'm getting a negative figure. If I'm taking 14%, I'm getting a positive figure. So at the IRR, my NPV will be equal to 0. So clearly we know that my IRR lies in between this 10% and 14 percentage. Clear with this, guys? So which means what we will do, I've taught you guys earlier before. So this is something that you need to do with interpolation. So how you to do this interpolation? Simple. Take the NPV at the lower level, or take first the lower rate. What is the lower rate? 10% plus NPV at the lower level divided by NPV at the lower level minus NPV at the higher level, right, into higher rate minus lower rate. This is what we need to do. Now exactly, let me just substitute lower rate. What is it? 10 percentage. The lower rate was 10% plus NPV at the lower level. What was NPV at the lower level? It was minus 8.63. Correct? It was minus 8.63 divided by NPV at lower level minus NPV at higher level. NPV at lower level is how much? 8. It is minus 8.63 minus NPV at higher level is how much? Minus 4.076. So let me write it here. Minus 8.63 minus 4.076. Correct? This is what it is. Yes. The whole into higher rate minus lower rate. 14% minus 10%. It is going to be 4 percentage. Clear with this, guys? Now let us solve this. You will arrive at the answer. It is 10 percentage, right? Plus on the numerator you have what? Minus 8.63 divided by, now let's use this, minus 8.63 minus 4.076. You get how much? You get minus 4.544. You get minus 4.554. Sorry, minus 4.544 into 4 percentage. Now what happens? This negative and this negative in the numerator and denominator gets knocked off. Correct? So literally if you do this calculation, 8.63 divided by 4.554, right? That into 4 percentage gives you how much? That gives you, one second. So here you get what? 8 point, I think this is 8.63 plus the negative 4.076. I think in the denominator there is a mistake here. The denominator will be, okay, minus 8.63 minus 4.076. So if you subtract the two, you get how much? Basically subtraction of both gets added up. It's minus 12.706. Basically it is minus 12.706 as a calculation thing here. So 8.63 divided by 12.706, right? Multiply that with 4 percentage, you get 2.716 something, that is rounded off to 2.72. So this is nothing but 10 percentage plus 2.72 percentage gives you how much? 12.72 percentage. That is what they have also arrived here. Clear with this, guys? So basically this confusion happened because some students asked me, even in my regular batch or even in the fast track batch, sir, this is an inflow, they are putting it in negative, but the outflows they are putting it in positive. Overall, if you see, the answer will not change because it's simple mathematics, right? But the flow, the sign should definitely change. For the inflow, you should take it as positive. The outflow, you should take it as negative. Or the inflow should be taken as negative, your outflow should be taken as positive. Either which ways you do, the answer will be the same, but you can't use the same cash flows. You can't use the same signs throughout. That's about it. But for that, here it's all calculation driven. But understand one thing, in this case, what we did, you can always take inflows in positive, outflows in negative, and just to multiply with the figures. We had some issues with the calculations because since I was also not having a calculator with me, I thought the calculations will be perfect, so I just had to use my mobile phone. So sorry for that. But for that, I hope you guys are getting the calculation here. So here, minus 8.63 minus 4.76 will be minus 12.706, correct? So if you do the calculations right now, you'll get the right figure of 12.72 percentage. That's going to be your KD, right? And the logic for this interpolation, we have actually seen it in our time value of money concept itself. So using that, you can arrive at this particular figure of 12.72. Clear with this, guys? The next one, the cost of redeemable preference shares using approximation method. Now, what is that formula? Preference dividend plus RV minus NP by N, the whole by RV plus NP by 2. Just now, during the course of our discussion, I told you the logic for this. So what's my preference dividend? It's going to be a 12% preference dividend, they said. So the amount that I pay every year is going to be 12 rupees. Plus RV, the redemption value they have given in the question, it's going to be redeemed at a premium of 5%, which means 100 plus 5, it's going to be 105, minus my issue price, that is my net proceeds. They have given in the question the particular preference share is currently quoting at how much? 104. In the absence of information, take your issue price as equal to 104. So minus 104 divided by 5, the whole divided by 105 plus 104 divided by 2. That's nothing but your RV plus NP by 2. If you do this, you get your KP as 11.67%. Clear with this, guys? Now let's go on to calculate WACC. I told you WACC can be calculated using two weights. One is called as the book value weights. The other one is called as a market value weights. In this question, they have asked for the market value weights. Market value weights. What you should do? Simple. First, you compute the market value from respective sources of finance. How will you do that? Very simple. Equity share capital. How many shares are there? We saw 5 lakh shares are there, and every share is quoting at what? 70 rupees. So 5 lakh shares, right? Each quoting at 70 will be how much? It's 3 crores and 50 lakh. So the market value is going to be 3 crores and 50 lakh for equity share capital. How about debentures? So we saw earlier that how many number of debentures are there? 40,000 debentures. Each debenture is quoting at 80 rupees. So 40,000 into 80 comes to how much? 32 lakhs. How about preference shares? Preference shares, we saw that there are a total of, it's given in the question, 10,000 preference shares, and each preference share has a market value of 104. So totally, what is going to be the value? It's going to be 10 lakh and 40,000. Clear with this, guys? Yes. So now what you do, add up everything. The total market value of all the sources of finance is going to be 3 crore 92 lakh and 40,000. So what will be the weights or proportion? Here it's going to be 3.5 crores divided by 3 crore 92 lakh 40,000. It's going to be 0.8919. For debentures, it's going to be 32 lakh divided by 3 crore 92 lakh 40,000. It's going to be 0.0816. Here, it's going to be 10 lakh 40,000 divided by your 3 crore 92 lakh 40,000. Comes up to how much? 0.0265. If you add up everything, obviously it needs to be 1. Now, the respective source of finance, we already calculated the cost. KE was 13.5%. We already calculated that here, 13.5%. KD was how much? KD was 12.72%. Detailed methodology, we saw 12.72%. And your KP was how much? 11.67%. So it's going to be 11.67%. So your weighted average cost of capital is going to be the respective weights into the respective cost. So 0.8919 into 0.1350. It's nothing but 13.5%. It gives you how much? 0.1204. Here it's 0.0816 into 0.1272 gives you 0.0104, and here 0.0265 into 0.1167 gives you 0.0031. If you add up everything, it comes out to 0.1339, or in other words, overall cost of capital is going to be 13.39%. Are you clear with this, guys? As simple as that, and that's about it. So in this case, what we saw, this was a good question because equity shares, that is the KE calculation, was done using a different method, CAPM. KD calculation, we saw how to do it under IRR model. And KP calculation, we saw how to use it under the formula method. And having done everything, how do you consolidate it and arrive at your weighted average cost of capital? In this case, they are asked using the market value weights. That also we have seen clear with this, guys. And that's about this area of cost of capital. Of course, there are certain other small concepts here and there which we have seen in detail in all our numerical problems. We've done about close to 25 to 30 sums, if I remember it right, in both our fast track and our regular lectures. We have done all these questions, and each of these questions had its own learning objectives. We saw all this extra small adjustments, and through that also we learned a few concepts which I asked you to write down and all of that. Please revise all of that along with this. That will be an effective revision the day before your exam. But trust me, guys, this is all about your weighted average cost of capital. And finally, there's something called as marginal cost of capital. Very simple. The company currently has 100 crores, right? Breakup could be multiple sources of finance. Let's say the company wants to raise another 50 crores, right? 50 crores, what breakup? It could be 30 crores from equity, 15 crores from preference, 5 crores from debenture. This could be the breakup. Clear with this, guys? Now, once again, what will you do? If you're doing all the calculations only for this additional money raised, exact same calculation, but if it is done only on the extra capital raised, not the entire capital, extra capital of this 50 crores, then it is called as marginal cost of capital. Everything else is same. What you need to do, the entire weighted average cost of capital calculation you need to do, but only on this extra amount raised of 50 crores. That is called as marginal cost of capital. So marginal cost of capital may be defined as the cost of raising an additional rupee of capital and is referred to as the cost incurred in raising new funds. Clear with this, guys? Everything else is same. So you need to use the marginal weights. For this, the proportions could be different. Use that weights for calculating your weighted average cost of marginal capital. Clear with this, guys? Right? So you need to know the intended financing proportions. That is nothing but the weights. And calculation of marginal cost of capital is very similar to that of WACC, but for the fact that all the calculations here are done only for the new funds raised. Clear with this, guys? And as simple as that, this entire chapter is now over. I have given some core theory areas and all, right? This is just meant for, in case they ask some theory questions, maybe you can just quickly go through this. It runs into a few pages in your study material. This also I have consolidated and neatly condensed it and put it here quickly. What is the significance of studying this chapter? Right, risk classification under CAPM. Now just quickly go through it once, and that's about this entire segment. But predominantly here we are focused on revising all the concepts. So in this particular chapter, what we have learned is basically your respective sources of finance. We saw how to calculate KD, how to calculate KP, how to calculate KR, how to calculate KE, and then having calculated the respective cost from every single source of finance, we also saw how to compute the KO. That's called as weighted average cost of capital, right? We did one numerical problem also in this regard. That's a perfect way to wind up this particular chapter. Clear with this, guys? And that's about this chapter. So with this entire chapter of cost of capital is done. Now let's move on to the next chapter. Now let's get started with the revision of the next chapter called as leverages. Now leverages is slightly an easier and a light chapter. Now first, before we get into this chapter leverages, you need to understand what this word lever stands for. Now in your childhood, you would have played this game called as seesaw, right? Where one person will be sitting on one side and your friend will be sitting on the other side, correct? Now you guys tell me, now if I am asking you to lift someone of your same weight, now can you lift that person easily? It's very difficult. However, have you ever wondered if the two people are sitting on a seesaw, right? If your friend is sitting on the other side of the seesaw, now you will be able to easily lift him, right? And your friend, he will also be easily able to lift you. So these two people, you both will be going up and down, correct? Now, how is this possible? Because you used this seesaw as a lever. So what do you mean by a lever? Lever basically means getting the maximum results by putting minimal efforts, right? In this case, this particular seesaw acted as a lever for you, right? So put it short, chinna kallu pedda labam, like that only. Minimum efforts, maximum results. Another example is, if you see in a well, right, in rural areas, we still have this well and all that. It's very important for all this irrigation and water level. Now, if I want to draw a bucket of water from this well, what I can do, I can easily put this bucket and take it. But what generally people do is they have something called as a pulley, right? And they tie this rope with the vessel to this pulley and they do it. Why? Because it will be easy for them to draw the water than directly putting this vessel into this particular well and drawing the water. Here, this pulley acts as a lever. Minimum effort, maximum results. Clear with this, guy? This is basically a normal commonsensical way of understanding lever. Now coming to the finance part of it, leverages. In this chapter, leverages, basically what we'll be seeing is it signifies magnifying effect. Once again, by putting lesser efforts, I'm trying to get the maximum benefits. It refers to magnifying effect. What is that? All of this we'll quickly be revising right now. But before that, first, there are some important terminologies that you need to understand before the start of this chapter. And by the way, guys, generally when I do this chapter in both our revision, the fast track batch and in our, the regular batch, I take this chapter called as marginal costing, which is ideally part of your costing, paper 4 cost account, cost and management accounting. I take this chapter and I quickly give the basics of marginal costing before we enter into this chapter called as leverages, because there are some marginal costing areas involved here. So you need to have some basic level understanding of marginal costing to enter into this chapter called as leverages. Now first, in this first, there are different types of fixed cost. What are the two types of fixed cost? First one is called as a fixed operating cost. The other one is called as a fixed financial cost. Fixed operating cost is the costing area fixed cost. That is your salary, factory rent, supervisor salary, your repairs and maintenance, all of that. In case of fixed financial cost, there are only two fixed financial costs. One is your interest on debt. We saw in the previous chapter, on your debentures, you need to definitely pay a fixed interest. Similarly, on your preference, on your dividend, on your preference share capital, you need to pay a fixed dividend. So preference dividend and your interest on debt, these are the two fixed financial costs. Financial cost means what? Cost paid towards the fundraisers. The people from whom you have borrowed money, right? So any amount paid or the cost incurred towards the providers of finance is called as financial cost. And fixed financial cost means what? The amount that you need to pay for sure, the guaranteed amount. That's why we don't include equity dividend here, because there is no contractual obligation on the part of company to make this payment. Now the next one, in case they have given the question, fixed cost is equal to so much, assume that fixed cost stands for fixed operating cost. Clear with this, guys? Next, there are some marginal costing terminologies which you need to understand before you enter into this particular chapter. Now let's see what they are. First, what do you mean by variable cost? Variable cost is the cost that varies with sales. So contribution is equal to sales minus variable cost. Profit volume ratio, PV ratio, is contribution upon sales into 100. Now break-even point refers to a point of sale where my EBIT is equal to 0, or in other words, your fixed cost, right, is being fully recovered by your contribution, or in other words, your contribution exactly recovers your fixed cost. The point of sale where your contribution exactly recovers your fixed cost and leaves you with a no profit or a no loss situation, that is called as break-even point. The formula to compute break-even point in terms of units is fixed cost divided by contribution per unit, because fixed cost is the total amount recovered by way of contribution, and every unit has a contribution per unit. So if you divide the two, you'll get the number of units required so that your contribution recovers your fixed cost. That way you need to calculate this. And of course, margin of safety stands for what? The sales made beyond your break-even point, or in other words, your actual sales minus break-even sales. All these are your marginal costing area, right? Generally, as I just told you, I give a brief introduction about marginal costing before the start of the classes with respect to our leverages. Clear with this, guys? So these are some basic terminologies that we use in our leverages chapter. These are relating to marginal costing. The next one. In this chapter, generally in numerical problems, we use some ratios also. EPS stands for what? Earnings per share is equal to what? Total earnings available to equity shareholders. EFE stands for earnings for equity shareholders divided by number of equity shares. Next one, return on equity. What is the formula? Very simple. It is a return on investment formula calculated from the perspective of equity shareholders. From the perspective of equity shareholders, what is their return? Earnings available to equity shareholders, right? The whole divided by what was the amount they provided? They provided equity shareholders funds. Clear with this, guys? So what they receive upon what they pay. Simple return on investment formula. Clear with this, guys? Next one, price earnings ratio. How do you calculate price upon earnings? That's nothing but your EPS divided by your price, MPS, market price per share divided by EPS. Do not worry. All of these things we will once again be covering in ratio analysis chapter. Next, earnings price ratio, earnings by price, EPS by MPS. That's all. Total asset turnover ratio, sales divided by total assets. Return on capital employed, it's nothing but the return divided by capital employed. So it's nothing but EBIT divided by capital employed. Why EBIT? Because in the denominator you have capital employed. EBIT is the earnings available to all the providers of finance. So that's the reason why we take EBIT by capital employed, or some people even adjust for taxes. EBIT into 1 minus T. Tax is something that I don't get. It's an expense for me. So remove that. Only the net amount is available for all the providers of finance. EBIT into 1 minus T upon capital employed. That's another formula. Clear with this, guys? Yes. And then you have something called as coverage ratios. Do not worry. In the marathon itself, in the free revision batch itself, I'll be covering it along with our ratio analysis chapter. Right? And operating profit ratio is EBIT upon sales into 100. Now, before we get into the types of leverages, first you need to know how the income statement looks like. Sales minus variable cost gives you contribution, minus fixed cost gives you operating profit or EBIT. Right? Up to this is your costing area. This is your costing area, and that's where we call it as operating leverage. Right? What is leverage? How to compute that and all we'll be seeing once again here right now. Next one. From EBIT, earning before interest and tax, remove your interest, you get your EBT. Less your taxes, you get EAT. Minus preference dividend, you will be getting what? You will be getting the net earnings available to equity shareholders. I popularly call it as EFE, earnings for equity shareholders. Divided by number of equity shares, you get what? Your EPS, earnings per share. Now this area is completely relating to your fundraising activity. Hence, this is where your financial leverage calculation comes into picture. Right? And if you're talking about from top to bottom overall operations or overall operation plus financing area, that's called as a combined leverage. So in this particular chapter, there are three types of leverages. One is called an operating leverage. The other one is called as financial leverage. The third one is called as a combined leverage. Clear with this, guys? Now, operating leverage talks about the relationship between the top figure and the bottom figure in your costing area, right? That is, it talks about relationship between sales and EBIT. Look at this relationship between sales and EBIT. Financial leverage, it talks about in your financing area, what is the top figure? EBIT. What is the bottommost figure? EPS. It talks about the relationship between EBIT and EPS. Clear with this, guys? EBIT and EPS. And finally, combined leverage, it talks about the relationship between the topmost figure and the bottommost figure, that is sales at your EPS. Clear with this, guys? This is what it represents. Are you all able to follow this? Yes. Now, this is what is mentioned here, relationship between sales and EPS. And your operating leverage is a measure of business risk. Financial leverage is a measure of financial risk, and your combined leverage is a measure of your total risk. Now, what is leverage here in this context of finance? Operating leverage, financial leverage, combined leverage, and all. What is it? Now, I will walk you through with a help of an example. Now, let's take a situation. Let's say at present, the company is operating at this level. Okay. So existing situation, let's take that as the base. At present, the company is selling 2000 units, right? And the selling price per unit is 10. The variable cost per unit is 5. Yes. Now, what will be the sales value? So 2000 units into 10, 20,000 rupees. Variable cost 2000 into 5, 10,000 rupees. If subtract, you get a contribution of 10,000 rupees. Let us say the fixed cost is 5,000 rupees. So minus fixed cost overall, what will you have? Your EBIT is going to be how much? 5,000 rupees. Clear with this, guys? Yes. Now, let us say there is a situation 2 where the overall sales units is going to be 3,000. Now, units is going to be 3,000. Selling price per unit and variable cost will not change because of this. Correct? Yes. Now, in this case, what will be the sales figure? 3,000 into 10, 30,000. Variable cost, 3,000 into 5, 15,000. Right? So, sales minus variable cost, contribution is going to be 15,000 rupees. Right? And fixed cost, it remains fixed irrespective of your output level. So, here fixed cost continues to be 5,000 rupees. Correct? Now, here what's going to be your EBIT? 15,000 minus 5,000 comes out to 10,000 rupees. Clear with this, guys? Now, let's go to another situation where now at present I'm selling how many units? 2,000 units. Now, the first situation, I'm moving to another situation where the sale has dropped by 1,000 units. So now the final sales figure now is going to be what? In this scenario, 1,000 units. Now tell me, guys, what will be the sales value? 1,000 units into 10 rupees, 10,000. And variable cost is 1,000 into 5, 5,000. That gives you a contribution of 5,000 rupees minus my fixed cost. It continues to be the same 5,000 rupees. My EBIT will become 0. Now, what can you observe out of this? Now, at present, I'm selling, my sales value is how much? 20,000 rupees. Now, in situation 2, if you see the sales value is 30,000, right? Now, can I say in this situation 2, my sale has increased by 50%. How 50%? From 10,000, from 20,000, it has increased to 30,000 rupees. That is, the increase in sale is 10,000. So 10,000 upon 20,000, the sale has increased by how much? 50%. Now, what happened to the EBIT? EBIT earlier in the existing situation was 5,000. Now it has become 10,000. Or in other words, the increase in EBIT is 100%. That is, the difference is how much? 5,000. 5,000 upon 5,000 into 100 is 100%. So here, if you notice, I just increased my sales by 50%, but my EBIT increased by 100%. Are you clear with this? Or in other words, if you compare this, the percentage change in EBIT is how much? 100%. Percentage change in sale was how much? 50%. Or in other words, my EBIT has increased by 2 times the increase in my sales. Clear with this, guys? Now, capturing this relationship is called as operating leverage. In this case, operating leverage is nothing but percentage change in EBIT divided by percentage change in sales. That comes out to how much? 100% by 50%, 2 times magnifying effect. For which means, can I say, if my sales increases by 1%, my EBIT will increase by 2%. Are you clear with this? There is a magnifying impact here. Why? We will see. Do not worry. But are you able to understand the concept of leverage basically captures the magnifying effect? I told you the magnifying effect is what is called as leverage here. Small efforts, more results. That is what is getting captured here. So, sir, leverage is very good. No, sir. No. Wait. Now, look what happened in the situation 1. Now, what has happened? Existing was 20,000. Now, I reduce my sales to 10,000 rupees. Correct? Now, what has happened? My sale dropped by 50%. What happened to your EBIT? From 5,000, it became 0. Or in other words, the entire amount of EBIT is now washed away. So, there is a decrease in 100%. Guys, correct? Or in other words, here if you compute 100% minus 100% by minus 50%, there is a 2 times magnifying effect. Or in other words, for every 1% increase in your sales, your EBIT will increase by 2%, no doubt. But for every 1% decrease in sale, your EBIT will reduce by 2%. Or in other words, if a company is growing, your profit will grow multifold. But if the company is declining in sales, your profit will decline multifold. That will result in a heavy super duper loss. Yeah, with this, guys. Sir, 50% only, sir, my sale dropped, but my profit dropped by 100%. Yes. So that's why they call as leverage is a double-edged sword. It can work in both the directions. So if the company is in a growing trend, leverage will work in your favor. If the company is actually in a negative trend, obviously the leverage will work completely against you. Are you all able to understand? And that is the concept of operating leverage. So operating leverage, what is the formula? percentage change in EBIT divided by percentage change in sales. Clear with this, guys? Now, sir, why is this leverage happening? Leverage is happening purely because of the presence of fixed cost. Why? See, up to contribution, everything moves in proportion. But suddenly this fixed cost, it remains fixed irrespective of your output level. That only changes, that only breaks your proportionate movement. Sir, can you prove this? Yes. Same example I'm taking here. So 20,000 base. The other option is 30,000. The other option is 10,000. Right? Till your contribution, it was all same. 5,000, 10,000, 15,000. I'm taking the same figures. 5,000, 10,000, 15,000. Assume there is no fixed cost here, 0, 0, 0. Now what happens? In the first situation, EBIT is 5,000, right? Existing, it's going to be 10,000. Second situation, it's going to be 15,000. Now you yourself calculate and see, in the first situation, by how much has my EBIT, by how much has my sales increased? Same, it is increased by 50%. Now what has happened to your EBIT increase? From 10,000 it has increased to 15,000. 5,000 increase, 5,000 by 10,000 is going to be 50%. Proportionate movement has only happened here. There is no magnifying effect, guys. Correct? Are you all understanding? Similarly here, my sale has fallen by how much? From 20 it has fallen to 10. It's fallen by 50%. Now here also what has happened? My EBIT has fallen by 50%. So here the operating leverage is going to be one time, or in other words, there is no leverage effect only. It is literally moving in the same direction. There is no magnifying effect and all. Are you clear with this? Why? Because in this case there is no fixed cost. So always understand your leverage works only if you have a fixed cost in your calculation. Clear with this, guys? So fixed cost, is it good or bad, sir? Again, it's a double-edged sword, or in other words, generally leverage is a measure of risk that happens because of the presence of fixed cost. Fixed cost, yes, it is good for a company that is growing because you can easily recover your entire fixed cost. Whatever amount you have over and above that, it is all yours. You need not have a share of it like variable cost and all. It's fully yours. Whereas if a company is just starting up, if it is not able to achieve good sales and all, then it will not be able to recover its fixed cost only. It will result in a loss situation. So that is the reason why fixed costs, right, is actually the reason why you have leverages, and leverage is a double-edged sword. It can work both in your favor, it can also work completely against you. Are you all clear with this? Yes. So that is the concept of operating leverage. So operating leverage calculation, it is basically a relationship between your sales and EBIT. It measures a tendency of your EBIT to change disproportionately with a change in sales volume. Why disproportionate? In between you have a fixed cost. Clear with this, guys? It is the disproportionate change is caused because of operating fixed cost, which does not change with a change in the sales volume. Clear with this, guys? So this is what we have done. Now, what is the formula to calculate operating leverage? Logical formula is what? Percentage change in EBIT divided by percentage change in sales. Clear with this, guys? There is one more formula, number 2. Operating leverage is equal to contribution divided by EBIT. Now, this proof, right, mathematically we can do it. So generally I do this only in our regular and our fast track batches. Here nothing to worry about it because the the proof is not required from examination purpose. So basically what they are saying, your operating leverage is contribution divided by EBIT. Correct? Why? Now I'll give you an easy way to remember. Remember like a sandwich, right? Like a burger. Burger, on the top you have a bun. On the bottom also you have a bun. In between you have all this, the stuffings and all of that. Correct? Now, literally here, it is the top divided by bottom. That is contribution divided by EBIT. Why? Because in this case, your leverage happens purely because of the person in between. That is nothing but your fixed cost. Are you clear with this? So another formula for calculating your operating leverage is contribution upon EBIT. But always remember, all these calculations should be done only on the base data. In this case, it is 10,000 divided by 5,000. How much does it come out to? 2 times. So obviously your operating leverage is equal to 2. Clear with this, guys? It should be done only on the existing data. And guys, there is one more formula called as your degree of operating leverage. Degree of operating leverage and operating leverage are the same. Don't worry about that. Is equal to 1 divided by margin of safety expressed as a percentage. This is also one more formula which I generally derive in our regular and fast track lectures. The derivation is not required for an examination perspective. So there is a third formula that's nothing but 1 by margin of safety expressed as a percentage. So in case this margin of safety as a percentage is given in the question, directly you can use and arrive at the operating leverage. Clear with this, guys? Now, this is what it is. The relationship between break-even point, fixed cost, and operating leverage. Simple. A firm with high operating leverage obviously has a high fixed cost. Only if you have a high fixed cost, more the fixed cost, more the leverage, because that is the reason why you are having what? You are having this leverage. Clear with this? Now, obviously, when your fixed cost is more, it will take more time for you to break even. Break-even point will be higher. Clear with this, guys? Suppose a firm has a low fixed cost, it has a low operating leverage, the fixed cost will also be lower and the break-even point will also be lower. Clear with this, guys? Similarly, what happens to margin of safety? Margin of safety means what? The extra sale I have made over and above my break-even point. And of course, we saw here, your 1 by margin of safety is only what? Your degree of operating leverage, correct? So simple, if your margin of safety is more, you've sold more over and above your break-even point, which means the risk is actually lesser for you, correct? And your operating leverage will also fall. Or you can also use this formula 1 by margin of safety. If your denominator is more, obviously your final answer will be reducing. That is, your operating leverage falls. And if this margin of safety falls, it's a more risk for you. So your business risk rises and your operating leverage also rises. Clear with this, guys? Right? Now, analysis and interpretation of operating leverage. When there is no fixed cost, there is no operating leverage only. That is, operating leverage is equal to 1. At break-even point, what happens? EBIT is 0. Now you guys tell me, operating leverage is equal to, just now we saw, contribution upon EBIT. Is correct? If my denominator is 0, EBIT is 0, then what happens? Operating leverage becomes infinity. It is undefined. Clear with this, guys? You can't define leverage at this place. Clear with this? Next, when EBIT is greater than 0, that is, if it is positive, my leverage will be, operating leverage will be positive. Yes. Suppose EBIT is negative, I can have a loss situation. Yes. In that case, my operating leverage is negative. Clear with this, guys? Are you all understanding it? Yes. And remember one thing, degree of operating leverage or operating leverage can never be between 0 and 1. It can be 0 or less than 0 or greater than 1. So it can be 0 or less, or it can be 1 or more. Between 0 and 1, it cannot be. Why? Now, you tell me, your operating leverage formula is what? Contribution upon EBIT. Correct? EBIT, how do you compute? It is nothing but contribution minus fixed cost. So literally, this is nothing but contribution divided by contribution minus fixed cost. Correct? And always the denominator is what? Lesser than the numerator. Why? Numerator is contribution. Denominator is contribution minus something, that is fixed cost. Correct? So obviously, always my denominator is less than the numerator. So how can this be in point? I mean, how can this be less than 1? It will always be greater than 1, or in case of a loss situation, it will be negative. It can never be between 0 and 1. That is the explanation given here. Clear with this, guys? Mathematically and logically also, it is easy to understand and as simple as that. Clear with this, guys? Fine. And that's about your operating leverage segment. Now, financial leverage. Now, financial leverage, what does it talk about? In your financial area, the topmost figure, the starting point is EBIT and the ending point is EPS, right? And this financial leverage talks about the relationship between the two. Now, let's quickly understand this with the help of an example. Now, let's say the company currently has an EBIT of 1 lakh rupees, right? Now, three situations. One, a 10% increase in EBIT that will result in 1,10,000 of profit, right? And another situation, 10% decline in EBIT, you have a profit of 90,000. Now, let's say in all the three situations, right, the company has raised some money, right? And currently they are paying an interest of 20,000. This anyways they need to pay irrespective of the actual profit. So in all the three situations, they end up paying an interest of 20,000. Now, what will be the EBIT upon interest? Here, existing situation, 80,000. In the new situation, situation number 2, it's going to be 90,000. And in situation number 1, it's going to be 70,000. Minus tax, that is 30% on EBIT, EBT, you just computed, you will arrive at your EAT, that's your EBT minus taxes, right? Minus preference dividend. Let's say the company pays at present a dividend of 16,000 rupees, irrespective of your actual profit scenario, you need to end up paying the same amount of 16,000. Yes, in all these three situations, it continues to be 16,000. So your earnings available for equity shareholders in scenario 1 is 33,000, existing 40,000, and in your scenario 2, it's going to be 47,000, right? Now, let's say the number of equity shares is 10,000. Now, will it change based on your profitability? No, it continues to be 10,000 in all your situations. Now, what happens here? EPS, first situation 33,000 by 10,000, 3.3, existing situation 40,000 by 10,000, 4, and the new situation 47,000 by 10,000, it's going to be 4.70. Now, if you see what has happened in the first situation, right, for an increase of 10 percentage in my EBIT, that is from 1 lakh, it increased to 1 lakh 10,000. 10,000 by 1 lakh is 10 percentage. What happened to my EPS? EPS actually originally was 4, now it became 4.7. That is, what is the percentage increase? 0.7 divided by 4, 17.5 percentage increase, which means if I increased my EBIT by 10 percentage, my EPS increased by 17.5 percentage. Here with this, in other words, what is the magnifying effect? Percentage change in EPS divided by percentage change in EBIT. 17.5 percentage divided by 10 percentage, 1.75 times. What does it indicate? If your EBIT increases by 1 percentage, my EPS will increase by 1.75 percentage. That is the meaning here. Clear with this? Sir, then financial leverage is good? No, sir. Wait. The same will happen in the opposite direction also. If your EBIT falls by just 1 percentage, what will happen? Your EPS will fall by 1.75 percentage. There will be a magnifying effect on both the directions. Clear with this? Look at what has happened here. Here, my EBIT fell by 10 percentage. Now, what happened to my EPS? From 4, it became 3.3. That is, it reduced by minus 0.7. So, minus 0.7 divided by 4 is minus 17.5. Now, my EPS fell down by 17.5%. Clear with this, guys? So here also the movement happens 1.75 times. Clear with this, guys? The magnifying effect here is 1.75 times. Now you guys tell me, why is there a financial leverage? Simple. Once again, this is happening because of the presence of fixed financial cost. Fixed financial cost is basically your interest and preference dividend, because in this entire statement, if you see, all other components move in proportion. The only thing that disrupts the proportion is your interest and preference dividend. So can you prove this, sir? Yes. Suppose assume it's an all equity entity, there is no interest, no preference dividend. In that case, if you see the same calculations I'm taking, but I've just taken interest and preference dividend as 0. If you do the calculation, you will see what happened. If you see the calculation, you will see for an increase by 10 percentage of EBIT, what has happened? My EPS from 7, it became 7.70. What is the increase? 0.7 divided by 7, it increased by 10 percentage. Suppose there was a decline in my EBIT by 10 percentage. Now, instead of 7, my EPS became 6.3. That is, there was a decline by 0.7 percentage. So minus 0.7 divided by 7, there is a negative. There is a reduction by 10 percentage only. So now if you see, for a 10 percentage increase in EBIT, my EPS also increased by 10 percentage. For a 10 percentage decline in my EBIT, my EPS also declined by 10 percentage. Or in other words, in this case, 10% by 10%, there is only 1. So basically, there is no magnifying effect at all. So clearly, you can say that the magnifying effect or financial leverage happens purely because of the presence of fixed financial cost, namely your interest and preference dividend. Here with this, as simple as that. And that's the concept of your financial leverage. It talks about the relationship between EBIT and EPS, right? And then it is caused by the presence of fixed financial cost, namely interest and preference dividend. Here with this, guys. Yes. And one more thing, there is a concept called trading on equity. I will just walk you through what that is. But before that, first let's have a look at the formulas. For the general formula that you need to use is what? Percentage change in EPS divided by percentage change in EBIT. Here with this, guys. Now, what has happened? Now, there is a shortcut formula or a direct formula also. What is it? Simple, similar to what we saw there only, we need to do here. That is nothing but EBIT divided by EBIT minus fixed financial cost. There we saw the sandwich, no? So contribution divided by EBIT. In between there is fixed cost. Here also the same thing. EBIT divided by EBIT minus fixed financial cost. That is the reason that is causing the leverage. Yes. Now, what are the fixed financial costs? Two costs are there. One is interest. The other one is preference dividend. So what you need to do is here you will say this is nothing but EBIT upon EBIT minus interest minus preference dividend, correct? Right? But here for preference dividend alone you need to do divided by 1 minus t. Sir, why sir? Simple logic, go to the statement, Now you guys tell me, here your taxes come into picture, correct? Your tax comes here. Now EBIT is a figure that is before tax, correct? No? Yes. Interest is also a figure that you pay before tax, yes. But preference tax is a figure that you pay after tax. So the post-tax item, right, you need to convert it into a pre-tax item and only subtract it. And hence suppose it is a pre-tax item, what do, you multiply it with 1 minus t, convert it into post-tax, but this is already a post-tax item, so you convert it into a pre-tax. How will you do it? Preference dividend divided by 1 minus t. Now it becomes a pre-tax item that is comparable with the other two components here, EBIT and interest. So EBIT is a pre-tax item, interest is a pre-tax item. Now from this, if I want to subtract a post-tax item, first convert it into a pre-tax item and then you subtract it. So preference dividend divided by 1 minus t. Here with this, guys, right? And hence this particular formula of your financial leverage, which is being mentioned here in this area, it's going to be EBIT divided by EBIT minus interest minus preference dividend into 1 minus tax rate. Clear with this, guys? Suppose a company has not issued preference shares, very simple, then it is going to be only your interest, correct? So it's going to be EBIT divided by EBIT minus interest. EBIT minus interest is nothing but your EBT. Clear with this, guys? That is what has been mentioned. Yes, that's about it. Now what has happened? Sometimes institute, they use formula 3. Formula 3 is what? EBIT minus EBIT upon EBIT minus interest. There is no preference dividend, correct? Right? Now they use this formula 3 even when preference shares are issued. So they're ignoring preference shares? Yes, they are doing like this, right? Therefore, when preference shares are issued, students can either follow formula 2 or formula 3. But very strictly speaking, when preference shares are there, you need to follow only formula 2, no? Because you need to consider that also. But institute, left, right and center, they are using either of the two formulas. So yes, that's the reason I have mentioned this under the doubt busters. Logically speaking, formula 2 is only correct when preference shares are issued. Clear with this, guys? When there is no fixed financial cost, there is no financial leverage. That is, financial leverage is equal to 1. When EBIT level is equal to fixed financial cost, what will happen in this case? When EBIT is equal to fixed financial cost, which means your EBIT has exactly recorded your fixed financial cost, your earnings for equity shareholders will be 0, or in other words, EPS will be 0, denominator will be 0. Correct, guys? Yes. In that case, what happens? What happens in this case is your financial leverage is undefined, or I can say this is nothing but your formula for financial leverage is what? EBIT divided by EBIT minus my fixed financial cost only. If my EBIT is equal to fixed financial cost, my denominator will be 0. So obviously you can't define it. When EBIT level is more than fixed financial cost, obviously in that case what happens? Denominator is positive, FL is positive. Suppose EBIT level is less than fixed financial cost, denominator will be negative and financial leverage is negative. Clear with this? Yes. Now there is one very important concept called as trading on equity. Now this is the reason why the magnifying effect happens on the financial leverage side. Sir, what is it, sir? Simple. Now let's take this example. Let's say the company earns a return of 25%, okay, and KD is going to be equal to 15%. KD is nothing but the cost of debt. Correct, guys? Now let me tell you what happens here. There is equity component, debt component. Correct? Yes. Now let's say the company has raised 60 crores from equity, 40 crores from debt. Totally the company has raised how much? 100 crores. Now on this entire 100 crores, every single rupee of this 100 crore, let's say the company is earning 25%. Which means what? Simple. The equity shareholders, right, on whatever they invested, they will get 25%. Correct? No? Yes. Now, however, the debt holders, that is the debenture holders, they invested 40 crores. Will they also get 25%? No, that is only a fixed contractual obligation. They will be paid only 15% on whatever amount they contributed, correct? But on this 40 crores also, the company earned 25%, correct? But on this 40 crores, they will have to pay only 15%, or in other words, on this 40 crores, the company has earned an excess of 10 crores that goes to the equity shareholders. Correct? No, guys. So the equity shareholders will earn 25% on their 60 crores plus on the 40 crores of the debt funding. The company will incur only 15% needs to be paid. So on that, but they have earned 25%, 25 minus 15, that extra 10% earned on the debt component, it goes to the equity shareholders. So obviously in this case, what happens? This is the reason why the company is gaining when the return on investment is actually more than the cost of your debt. Clear with this, guys? So here this 10% surplus is being enjoyed by the equity shareholders. Leverage works in your favor. This is the reason why you're on a positive side, on a growth side, leverage is actually working in your favor. So then is it always like this? No. Just imagine a scenario, the same thing, equity and debt, 60 crores funding from equity, 40 crores funding from debt. The total is going to be 100 crores, right? Now on this debt, I need to pay how much? 15%. Just imagine the company's actual return on investment is 10%. Means what? On every single rupee invested into the business, the company earns 10%. Now you tell me, what happens? Now, on this 40 crores invested into the business, the company would have earned only 10%, but still they will have to pay what? They will have to pay 15% the debt holders. So, but they have earned only 10, no, sir. Literally, this difference 5% on this 40 crores, what they will do is their equity shareholders will have to bear that money. So literally what the equity shareholders will be thinking is, okay, so on my 60 crores, I will be getting 10%. No, wait, 60 crores into 10% minus this 5% of deficit shortfall on this 40 crores. Now they need to bear out of their pocket. Now this is the reason why now the EPS will fall in case your return on investment is less than your cost of debt. So now what happens? The leverage works against you in a decline trend. Are you clear with this, guys? Are you clear with this? So basically, to put it short, when your return on investment is greater than cost of debt, leverage works in your favor. This concept is called as trading on equity. So basically the company is trading on equity. It's like riding on a horse. Like when you ride on a horse, you go very fast, no problem. But some crash happens, the hit will also be, the damage will also be very huge. Clear with this, guys? It's a double-edged sword. So when your ROI is greater than KD, yes, you're trading on equity, life is good. But the moment ROI is less than KD, out of your pocket, you need to pay money and all that. So in that case, the losses will be magnified. So the deficit to be borne by equity shareholders. Clear with this, guys? Right? That is what is being mentioned here under this concept called as trading on equity. It indicates the use of funds with fixed costs like debts and preference, right, along with equity capital, known as trading on equity. The basic aim of financial leverage is to increase the earnings available to equity shareholders using fixed cost fund, and the firm is known to have a positive or a financial leverage, a favorable leverage when the earnings are more than the cost of debt. This is what we saw. When ROI is greater than KD, in that case, you are benefiting. Clear with this, guys? If the earnings are equal to or less than the cost of debt, it will be a negative or an unfavorable leverage. That's why leverage is a double-edged sword, I told you. When the quantity of your fixed financial cost is relatively high in comparison to equity share capital, it is said that the firm is trading on equity. Clear with this, guys? This is what we saw right now. Fine. And this is the reason why I said it's a double-edged sword. Why? When ROI is greater than your interest, or basically your KD, it's a favorable, advantageous position. ROI is less than interest, it's going to be an unfavorable or a disadvantaged position. So is leverage good or bad? It's a double-edged sword. Clear with this, guys? That's what we are seeing here in this particular area. Now, what do you mean by combined leverage? Very simple. It is the topmost figure divided by the bottommost, or in other words, it's a relationship between the topmost sales and the bottommost EPS. So basically here the formula is what? Percentage change in EPS. bottommost divided by percentage change in sales. Clear with this, guys? Let's say my combined leverage is four times. Means what? For every 1% change in my sales, my EPS will increase by 4 times. Suppose if my sale is falling by 1%, my EPS will fall by 4 times the 1%, that is 4 times. Clear with this, guys? So it captures the movement between the topmost sales and the bottommost EPS. Simple, guys. Your combined leverage is nothing but operating leverage into financial leverage, or the formula is percentage change in EPS divided by percentage change in sales, right? And when the company has issued preference shares, very simple. Now what you do, operating leverage is what? Contribution divided by EBIT, correct? And into financial leverage is what? EBIT divided by EBIT minus interest minus preference dividend upon 1 minus tax, right? Basically, your EBIT and EBIT gets cancelled here. So the formula is contribution upon EBIT minus interest minus preference dividend into 1 minus tax. As simple as that. Suppose there is no preference dividend, very simple. It's contribution divided by EBIT minus interest, that is popularly called as EBT. As simple as that. Nothing great in this area. Clear with this, guys? And degree of combined leverage and combined leverage are actually the same, and as simple as that. And the same thing I told you, even when preference shares are there, sometimes institute ignores preference dividend and uses only the formula number 4. So ideally you can use both the formula, but my opinion, when preference shares are given, use this formula number 3 only. Clear with this, guys? And that's about this particular the formula of your combined leverage. Now let's see this here. If your operating leverage is low, financial leverage is also low, overall that company's total risk is low. Now you can't take advantage of trading on equity and all, right? This is just an opinion given by institute, that's all these things are mentioned in the institute study material. Now this particular table I have taken it from the institute study material. Now operating leverage is high, financial leverage is also high. It means the total risk is very high. It's a very risky combination. But your operating leverage is high, financial leverage is low, a moderate total risk, they are saying it's a not good combination. Whereas operating leverage is low, financial leverage is high, moderate total risk, best combination. Now, what is best combination? What is not a good combination? No one can directly tell you. It depends on a particular company. They need to decide how much risk they want. So this is very subjective. You can't conclude anything based on this. But since this was mentioned in our study material, I have retained it here. But there is no one specific statement like, okay, so if my low operating leverage, high financial leverage is good and all, nothing of that sort. Nothing of that sort, because that's the reason why institute themselves have said it's a double-edged sword, right? So on a growing side, you will benefit. On a decline side, you will definitely fall. So obviously, it magnifies both your growth as well as a downfall. So it's a double-edged sword. Clear with this, guys? So all the three leverages can be in positive or negative. Depreciation is treated always as a fixed operating cost. In case of reverse working problems where both operating leverage and financial leverage are given, yes, this is one issue. In case of reverse working, missing figure sum, right? If you start the question with operating leverage, you will get a different answer. If you start the question with financial leverage, you might get a different answer. It is absolutely fine, not a problem. Alternative solutions will be possible. Clear with this, guys? So when you guys are doing the numerical problems, this we saw even in both our fast track and regular lectures. When we solved all the questions, right, we saw that there are alternative solutions possible in certain areas, and that's about it. Now the difference between the three things: operating leverage, financial leverage, combined leverage. Operating leverage measures business risk, financial leverage measures your financial risk, your combined leverage measures your total risk. And operating leverage happens because of fixed operating cost. Financial leverage happens because of your fixed financial cost, namely interest and preference. Your combined leverage happens because of everything, that is fixed operating cost as well as your interest and preference dividend. And operating leverage, what does it measure? Costing area, bottom and top. That is, it measures your percentage change in EBIT with a percentage change in sale. How about financial leverage? In your FM area, I mean in your financial area, percentage change in EPS is related with percentage change in EBIT. And how about your combined leverage? Topmost and bottommost. Here the bottommost is what? Percentage change in EPS. Topmost is what? Percentage change in sales. Clear with this, guys? Examples I have just given in here, and as simple as that. And that's about the entire chapter of your your leverages. Clear with this, guys? In this particular chapter, we saw all the three types of leverages: your operating leverage, financial leverage, combined leverage. What are the different formulas? The reason why we are having leverages, that is because of the presence of fixed operating cost or fixed financial cost, and in case of a combined leverage, it's because of both. And we saw the formulas along with the logics as well. Now let's quickly take one numerical problem, and with that we will properly complete the revision of this particular chapter. Now let's quickly solve one numerical problem in this area. So first, a firm's details are as under: sales at the rate of 100 per unit is 24 lakhs. Variable cost is 50%, which means your PV ratio comes out to the remaining 50%. Fixed cost is 10 lakh rupees. It is borrowed 10 lakh rupees, the rate of 10%, and its equity share capital is 10 lakh rupees, which with each share having a face value of 100 rupee each. The tax rate comes out to how much? 50%. Now calculate the operating leverage, the financial leverage, combined leverage, right? And apart from that, they've asked for the return on equity. And if the sale increases by 6%, what will be the new EBIT? Simple, guys. In this chapter, there is one open secret for doing all the questions. What is it? First, put out the statement, the income statement. What is it? Sales minus variable cost gives you contribution, minus fixed cost gives you EBIT, minus interest gives you EBT, minus tax gives you EAT, minus preference dividend gives you EFE, that is earnings for equity shareholders, divided by N, that is the number of shares, gives you your the EPS, then the earnings per share. Clear with this, guys? As simple as that. First, you just prepare this particular statement, and then you will be able to automatically get the figures. Now, this is exactly the statement that you prepare. Sales minus variable cost is contribution, minus fixed cost EBIT, minus interest EBT, minus taxes EAT, minus preference dividend is EFE, divided by number of shares gives you EPS. Simple, right? Logical statement. Now first, sales, the figure is given 24 lakh, minus variable cost 50% of sales, that's going to be 12 lakhs, which means your contribution is going to be the subtotal 12 lakh rupees, minus fixed cost given in the question to 10 lakh rupees. So what's going to be your EBIT? That's going to be 2 lakh rupees. So clearly what we are doing is we are also adding one more column on the right hand side called workings. Had this not been there, what you should do, you should have given a working note reference and write 1, 2, 3, 4 working notes. It will be a waste of time. Smart way of solving these questions is this. This is what I have literally done in my entire the solved question bank. I've kept it so that the presentation will be easy for you in the exam. It will save a lot of your time. Next one. Now let's interest. They have given the question that debt amount into interest. Debt is how much? 10 lakh rupees. So 10 lakh into 10% comes out to how much? 1 lakh rupees, right? So this gives you your EBT of 1 lakh minus a tax rate of 50% comes out to how much? 50% on EBT. That's going to be 50,000. So you get an EAT of how much? 50,000 rupees. There is no preference dividend here, so nil. So that's going to be your EFE. That's going to be 50,000. And what is the number of equity shares? So the number of equity shares, the equity share capital is 10 lakh, each at the rate of 100. So just remove 2 zeros. You have a total of 10,000 equity shares. Clear with this, guys? So divided by 10,000, you get what EPS is going to be. Your EFE divided by N, it's going to be 5 rupees. Simple. Now first, operating leverage. How will you compute? Simple. Contribution divided by EBIT. So 12 lakh divided by 2 lakh. So 12 lakh divided by 2 lakh comes to 6 times. What is the meaning of that? If my sale increases by 1%, my EBIT will increase by 6%. So then it is good. No, wait. If my sale falls by 1%, my EBIT will fall by 6%. Clear with this, guys? Double-edged sword. Next one. Financial leverage. What's the formula? Simple. In this case, there is no preference and all. I can directly take EBIT divided by EBT. So 2 lakh divided by 1 lakh. How much is it? 2 times. So here, what is the meaning of 2 times? If my EBIT increases by 1%, my EPS will increase by 2%. Similarly, if it falls by 1%, my EPS will fall by 2%. That is the meaning of this. Combined leverage is what? Multiply the two. 6 lakh, 6 times into 2 times, that's going to be 12 times. What is the meaning of this? For every 1% increase or decrease in my sales, my EPS will increase and decrease by 12%. That is the meaning of this. Next one, they've asked for return on equity formula. Very simple. What is the earnings available to equity shareholders? 50,000 rupees. And what is the total amount they invested? It was 10 lakh rupees. Correct? Yes. So it's going to be how much? It's going to be how much? 50,000 divided by 10 lakh. It's into 100. It's going to be 5%. The return on equity is going to be 5%. Now, finally, guys, the next one. If the sales increase by 6 lakh, what will be the new EBIT? Now, they are asking about relationship between sales and EBIT. Now, we can do this using combined leverage formula itself. Sorry, operating leverage formula itself. Yes. Now, operating leverage, can I say, is nothing but percentage change in EBIT divided by percentage change in sales. Correct? No? Yes. Now they have mentioned sale is going to increase by 6 lakh, which means what? 6 lakh by 24 lakh. How much is this? So 6 upon 24, if you see, now look at this. Operating leverage, we already calculated. Operating leverage was how much? 6 times. Now my percentage change in EBIT divided by percentage change in sales is going to be my operating leverage of 6. Yes, and they have mentioned in the question that the sales is going to increase by 6 lakhs. So 6 by 24 is going to be a 25 percentage change. Correct? Yes, a 25 percentage change. So can I say operating leverage 6 is equal to percentage change in EBIT, which I need to compute, divided by percentage change in sales, which is 25%. Correct, guys? Yes, or in other words, percentage change in EBIT is going to be multiply the two, you get how much? Percentage change in EBIT is going to be equal to how much? 6 into 25 percentage, that is going to be 150 percentage, correct? Or 1.5 times or 150 percentage. Clear with this, guys? This is going to be the change in EBIT itself. Clear with this? Now at present, what is my EBIT? 2 lakh, right? So the change in EBIT will be how much? The change in EBIT will be 2 lakh into 150 percentage. How much is that? 3 lakh. 3 lakh is not the new EBIT. 3 lakh is the increase in EBIT. So at present, I have an EBIT of 2 lakh. The increase EBIT is going to be 3 lakh. So the new EBIT is going to be 2 plus 3. That is going to be 5 lakh rupees. Here with this, guys. This way you can calculate, or if you want, you can also prepare that statement approach. What is the new sales? The new sales they have given is it is going to increase by 6 lakh. It's going to be what? 24 plus 6, 30 lakhs. For this 30 lakhs, you can once again prepare the income statement and all. So variable cost is 50 percentage. So which means 15 lakh you will remove. So contribution is remaining 15 lakh. So minus fixed cost. How much is it? 10 lakh. So you get an EBIT of how much? 5 lakh rupees. This exact figure of 5 lakh only, we also arrived at it using the concept of operating leverage. Clear with this, guys? This way also you can do, and as simple as that. So with this, we have clearly and comprehensively covered this particular chapter called as leverages. Of course, there are a lot of numerical problems also involved here. This being a marathon, right, a revision session, we have quickly recapitulated all the concepts covered in this particular chapter along with the one numerical problem as a representative thing. So with this entire chapter of leverage is over. Now let's move on to the next chapter. Now let's get started with the revision of the next chapter called as capital structure decisions. Now, I've told you earlier that our subject has 3 objectives. What are they? Financing decisions, investment decisions, and your dividend decisions. And this chapter once again fits into the category of financing decisions, that is, decisions taken towards your fundraising activity. Now, in this chapter, we will be seeing which particular alternative source of finance is the best for us. That is, let us say I need to raise 100 crore rupees, right? Let's say I need to raise 100 crore rupees. Now, I can raise this 100 crores from maybe different sources of finance. Let us say I have first alternative, equity share capital, preference share capital, debt, right? Now, the first alternative says raise it fully from equity. There is second alternative. It says 50 crores you raise from equity, 50 crores you raise it from debt. There could be a third alternative that says maybe you raise 60 from equity, 40 from preference, nothing from debt. Or there could be a fourth alternative that says 30 crores from equity, 20 crores from preference, and the remaining 50 crores from debt. Now, in all the cases, I would have raised a total capital of 100 crores, but out of these 4 plans or alternative, which is the best plan, right? That is what we are going to see in this particular chapter, or in other words, we are going to find out which alternative source of finance or which alternative capital structure is the best for the company. By the way, capital structure means what? The composition or the mix of your overall capital, that is equity, preference, debt. So this composition is broadly called as capital structure. Now, in this chapter, for simplicity's sake, I have bifurcated this entire chapter into 4 parts. The first part deals with indifference point, EBIT, EPS, indifference point. The second part deals with break-even points. The third part deals with your EBIT, EPS, MPS analysis. And the fourth part talks about capital structure theories. And basically in capital structure theories, you have different people giving their own perspectives or theories on capital structure, right? So these are broadly the 4 segments of this particular chapter. And guys, this I have done, this approach of bifurcating this chapter into 4, this is something that I have done, right? That's why I have mentioned it clearly here. The above classification of this chapter is made from the faculty's own perspective and creative approach to enhance the understanding and to simplify the complex concepts covered, and hence this exact sequence may not be there in your ICI study material. However, whatever is mentioned here is all there in this particular chapter only in your institute study material, but it is not that in this organized manner. It is slightly in a different format. But if you learn it this way, absolutely you will have crystal clear clarity in this particular chapter. Now you guys are going to see how quickly and effectively we will be able to revise this big chapter in a very short span of time, because that is all it takes. Now, shall we get started? Yes. Now let's move to the first part of this particular chapter, that's called as EBIT, EPS, indifference point. Now, what do you mean by an indifference point? It is that point of EBIT at which the EPS of 2 different alternatives are going to be the same. Right? How do you compute? This is the formula given here. Nothing. You need not have to mug up anything. Very simple. Let's take one numerical problem, and with the help of that, we will understand. By the way, guys, what do you mean by indifference point? It is that point of EBIT at which the EPS of 2 different plants are going to be the same. What you need to do, calculate EPS of one plant and calculate the EPS of the second plant, equate the two, and the EPS point, the EBIT point at which the two are equal is called as your indifference point. What it is and all, we will be seeing it here. And once we learn this, I will also tell you, right, why indifference point is helpful for the purpose of arriving at your capital structure decision. That will also be seen here. Now, let's quickly get started with the first numerical problem here. Now, look at this question number 1. Calculate the level of EBIT at which the EPS indifference point between the following financing alternatives will occur. Alternative number 1, they are saying equity share capital 6 lakh rupees and 12% debentures of 4 lakh rupees. So what is your plan number 1? It has 6 lakh rupee worth of equity share capital and 12% debenture worth of 4 lakh rupees. What is the total capital raised here? 10 lakh rupees. Now, how about the alternative number 2? Equity share capital is 4 lakh rupees. Preference, 14% preference share capital is 2 lakh rupees, and 12% debenture is going to be 4 lakh rupees. So, equity share capital is 4 lakh. Your 14% preference is 2 lakh and 12% debenture is going to be 4 lakh. What is the total capital employed? Here it is also going to be 10 lakh rupees. Now what we need to compute? We need to compute what? We need to compute the indifference point. What do you mean by indifference point? It is that point of EBIT where the EPS of the first plan is equal to the EPS of the second plan. So assume that the tax rate is 35% and the par value of equity share is 10 rupees in each case. Now, which means what? Under plan 1, I have 6 lakh rupee worth of equity shares, equity share capital. So, how many shares are there? Equity shares, 6 lakh by 10. So, I'll be having 60,000 equity shares. Under the second plan, 4 lakh divided by 10, 40,000 equity shares. Clear with this, guys, right? So, this is what it is. Now, what we need to do? First, compute the EPS of plan number 1. How do you compute EPS of plan number 1? Simple. What do you mean by EPS? Earnings available to the equity shareholder divided by number of shares. Earnings available to equity shareholders, how would you compute? EBIT, because we need to calculate this EBIT only. So keep that as EBIT minus interest. What is interest? 12% on 4 lakh gives you 48,000. So EBIT minus interest gives you EBT. EBT into 1 minus tax rate directly gives you your earnings after tax, EAT. Correct? right? Now EAT, now in this case there is no preference dividend, so EAT itself is the entire earnings available to your equity shareholders. As simple as that, divided by the total number of equity shares. In this case is going to be 6,60,000 rupees, 60,000 shares. So basically the numerator has what? Earnings available for equity shareholders. EFE, denominator has what? Denominator has the number of equity shares. So this is ideally the calculation of EPS under the first plan. Now, how about the second plan? Once again, it's EBIT minus interest. What's interest here? 12% on 4 lakh. Comes out to how much? 48,000. Simple, right? Into your EBIT minus interest is EBT. EBT into 1 minus tax rate directly gives you what? Your EAT itself. So into 1 minus tax. Now here you have a preference dividend. How much is it? 14% on 2 lakhs comes out to how much? 28,000. So EAT minus preference dividend, if you do this, you will arrive at what? Your earnings available for equity shareholders divided by the number of shares here, N. So you get the EPS under second alternative. Clear with this, guys? Now equate the two and arrive at the EBIT figure. That EBIT figure is going to be called as your indifference point. Why? Because indifference point is nothing but that point of EBIT at which the EPS under two alternatives are the same. So EBIT minus 48,000, the whole into 1 minus 0.35 by 60,000 is equal to the second equation. EBIT minus 48,000, the whole into 1 minus 0.65. I think it's 1 minus 0.35, right? Not 0.65. It's 1 minus 0.35 minus 28,000, the whole by 40,000. Now we need to solve for this, right? So once you solve this, a normal mathematical calculation, once you solve this, you will arrive at EBIT as 1,77,231. So 1,77,231 is going to be what? Your indifference point. Clear with this, guys? Now, sir, using this indifference point, what can I do, sir? What can I do? Yes, we calculated indifference point. You told us how to calculate, but what will I do with respect to this? Very simple, very simple. Now, what you will do is, suppose in the next year, you are expecting that your EBIT will be lesser than this indifference point level, lesser than 1,77,231. Then you should go for that plan which has a lower fixed financial cost. Suppose your expected EBIT is higher than your indifference point level of EBIT. In that case, you can go for that option which has a higher fixed financial cost. In this case, the higher fixed financial cost is happening in plan number 2. It has more from your fixed financial cost sources of finance. That is, only 4 lakh is coming from equity source. The other 6 lakh is coming from what? It is coming from your the fixed financial cost, the sources of finance which has your fixed financial cost, correct? So now basically in this case, what will you do? If your expected EBIT is less than your indifference point level, go for plan number 1. That is the plan that has a lower fixed financial cost. Suppose if your expected EBIT is greater than your indifference point level, go for plan number 2 in this case. That is the option that has a higher fixed financial cost. And at the indifference point level, whether you go for option number 1 or you go for option number 2, your overall EPS will continue to remain the same. Now the question is, sir, why are you saying this? What is the logic for this? Very simple. Just now we saw in leverages chapter. So when you are in a growing phase, when your EBIT is more, then leverage will work in your favor. Leverage is nothing but use of fixed financial cost. So in a higher area, in a higher EBIT level, leverage will work in your favor. You will have trading on equity. The equity shareholders will benefit. Clear with this, guys? Suppose you are not even hitting your indifference point level. In this case, be very careful because leverage is a double-edged sword. Do not go for the options which have a higher fixed financial cost. Go for the one that has a lower fixed financial cost. Clear with this, guys? As simple as that. This is all the logic. You need not mug it up. Now, if you look at this, you will understand everything. Now, look at what it's given here. Look at what is given here. So they have given this formula. There's nothing but EBIT minus interest of the first alternative. You get EBT, the whole into 1 minus tax rate. You get your EAT minus preference dividend of the first alternative. If it is there, the whole divided by the number of equity shares under the first alternative. Equate this with EBIT minus interest under second alternative, the whole into 1 minus T. You get your EAT minus preference dividend under the second alternative, the whole divided by the number of equity shares under the second alternative. Nothing to be mugged up. arrive at the EPS under both the alternatives equated arrive at the EBIT value, and that EBIT value is called as your indifference point. Clear with this, guys? And what will you do if your expected EBIT is less than your indifference point level? Go for the plan that has a lower fixed financial cost. If your expected EBIT is greater than your indifference point level, now what happens in that case? Go for that plan with a higher fixed financial cost, because leverage will work in your favor. Suppose if your expected EBIT level is exactly equal to your indifference point level, in that case you select any plan, because that itself is an indifference point. Both the alternatives will give you the same EPS. Clear with this, guys? As simple as that. Clear with this, guys? Now if you notice, there are two alternatives, plan 1, plan 2 and all we saw. If you notice carefully here, now that each of these two plans has one advantage and one disadvantage while calculating EPS. EPS is what? Earnings for equity, right? EFE divided by number of shares, correct? Now, in order to increase the EPS figure, there are two ways of doing it. One, you increase your numerator, then also the EPS will increase, or you reduce your denominator. If you reduce your denominator, then also your EPS will increase. Correct, guys? Yes. Now, what happened in plan number 1? What has happened in plan number 1? If you see, there was a lower fixed financial cost. Correct? There was a lower fixed financial cost. Hence, the numerator will increase. Why? Because the earnings available to equity shareholders will increase. Correct, guys? Yes. Whereas in plan number 2, what has happened? The numerator actually will be lesser. Correct? Clear with this? Because in this case, what has happened? You have 14% preference shares, 12% debentures and all. Here, the advantage is not in the numerator, but you have an advantage in the denominator. Why? Because the first alternative, 60,000 equity shares were there. In the second alternative, only 40,000 equity shares are there. So per share EPS, per share earnings will be more in this case also. Clear with this, guys? Or in other words, in plan 1, the advantage is by way of an increased earnings for equity shareholders, increased numerator, whereas in plan number 2, the advantage is by way of a reduced denominator, that is a reduced number of equity shares. Clear with this, guys? That's why. So you can't always say plan 1 is good or plan 2 is good. Now, if you're operating at a point beyond your indifference point level, then plan 2 was good. Below the indifference point level, plan 1 was good. Clear with this, guys? You are able to balance it too. Sometime plan 1 is good, at some time plan 2 is good. Clear with this, guys? Now, with this backdrop, next let's go on to the next one in this segment, the final area in this segment. Now, cases where indifference point cannot be calculated. When can you not calculate the indifference point? So, first, when the number of equity shares on the both the alternatives are equal, right? So under both the alternatives, the number of equity shares is same, and the fixed financial cost of one alternative is always more than the fixed financial cost of the other alternative. In this case, what happens? One plan is always good than the other plan. There will not be a point where these two will meet. Correct? Because one plan is always good, one plan is always bad. So in that case, what will happen? You can't say beyond the indifference point you go to one particular plan, below that you go to another plan, because they will never meet. At no given point of time, the EPS under both the alternatives will be equal. Clear with this, guys? So EPS of one alternative is always greater than the EPS of other alternative. Why? The denominator is also same, number of equity shares is same, and the numerator of one plan is always greater than the numerator of the other plan. Why? Because the plan which has a lower fixed financial cost will have a higher numerator, that is nothing but higher earnings for equity shareholders. Correct? In that case, both these options will never meet, they will run parallelly, so you cannot find an indifference point. The second option is when the fixed financial cost of both the alternatives are equal. Suppose plan A has 12% debentures, right? Plan B has 12% long-term loans. Both the plans have, let us say, example, the same number of equity shares. In this case, what happens? At all given point of time, the EPS under both the alternatives will be the same. Here with this, guys. So there is no one indifference point. All points are indifference point only. Look at this. Reason EPS under both the alternatives will always be the same. Clear with this, guys? So these are the two situations when you cannot calculate an indifference point. Clear with this, guys? As simple as that. That's about it. Next one. Finally, the graphical presentation of indifference point. So we saw that. So this was, let us say, this is going to be plan number 1. This is going to be plan number 2. So obviously, what has happened? So plan number 1, this is the line. 1 second. Yes, plan number 1, this is the line. Plan number 2, this is the line. Now, what has happened? It meets at a point, right? Indifference point. It is a point where the EBIT, it is a point of EBIT where the EPS under both the alternatives are same. And below the point, what has happened? Look, this equity line, it is more than the debt line. Debt line means what? If it is having some fixed financial cost and all. So basically, below the indifference point, go for that alternative that has a lower fixed financial cost, because that will give you a highest EPS. Clear with this, guys? But after the indifference point, leverage will start working in your favor. So go for that option that gives you a higher fixed financial cost, because that will report a more EPS than the unlevered option or the other option with a relatively lower fixed financial cost. Clear with this, guys? That is the story of your EBIT EPS indifference point analysis. Clear with this, guys? With this, let's move on to the second part of this particular chapter, called as your break-even point. Now, when it comes to break-even point, basically this classification is something that I have done. There are 3 different types of break-even point. One is called as your operating break-even point. This is basically something that you will be seeing in your costing area, right? And financial break-even point is something that is a subject matter of discussion in your FM, right? And overall break-even point, once again, this I have kept it in order to give a completeness of discussion. Clear with this, guys? But ideally speaking, the focus of FM in financial management, the focus is only on financial break-even point. Operating break-even point is something that you see in costing area. Still, in order to connect the dots, I have kept it here. Quickly, now what do you mean by an operating break-even point? First, understand what it says. It refers to the point of sale at which your EBIT is 0. So how many units should I sell in order that my EBIT, my operating profit, becomes 0? Very simple. For your EBIT to become 0, your contribution should have exactly recovered your fixed cost. Clear with this, guys? Yes. So the formula here is fixed cost. I need to recover my fixed cost, right? And every unit gives me a contribution per unit. So fixed cost divided by contribution per unit gives you the number of units that you need to sell so that your contribution exactly recovers your fixed cost. We have seen this in detail in our costing area, and that's what is mentioned here. So fixed cost divided by contribution per unit. Suppose if you want the figures in value, simple, instead of contribution per unit, you substitute with PV ratio. It's going to be fixed cost divided by PV ratio. Very, very logical, and we have seen all the derivations in our costing discussions. Next, let's move on to the core of FM in this area, financial break-even point. First, understand what it says. It is the point of EBIT, not sales. It is the point of EBIT at which EPS is equal to 0. The point of EBIT at which your EPS is equal to 0 is called as your financial break-even point. How will you compute this? Very simple. Interest plus preference dividend divided by 1 minus tax rate. Sir, how do you arrive at this formula? Now, let me take an example here. Let us say the interest is 20,000 rupees. Preference dividend is 16,000 rupees, right? Tax rate is 30%. Number of equity shares is going to be 1 lakh rupees. Now, 1 lakh shares. Now, we need to calculate the financial break-even point. Now, how do you do that? First, what do you mean by a financial break-even point? The point of EBIT at which my EPS is equal to 0. First, let me draw up the statement here. So, it's EBIT minus interest gives you EBT minus tax, right? And taxes at the rate of 30% gives you EAT minus preference dividend gives you EFE divided by number of equity shares gives you EPS. Correct? Right. Now, what we need to do is we need to calculate the EBIT point, that the amount of EBIT that will exactly make my EPS 0. Now, let's start. Let's do a reverse working here. Now, first, I want my EPS to be how much? I want my EPS to be 0. Right? And what is the number of shares? It is given as 1 lakh number of shares. Correct? Yes. Now, the preference dividend is the amount given in the question. Yes, 16,000 rupees is going to be my preference dividend. 16,000 rupees is going to be my preference dividend. And what is going to be the interest? The interest is going to be 20,000 rupees, right? The interest is going to be 20,000 rupees. These are all the figures given in the question. Now, I am taking a separate green color ink to calculate the missing figures. Now, simple guys, start from the bottom, reverse work. For me to get an EPS of 0, right, my earnings available to equity shareholders should have also been 0. Guys, correct? So 0 divided by 1 lakh will only be 0. Correct? No? Yes. Now, for me to exactly earn an earnings for equity of 0, which means my earnings after tax should have also been exactly equal to 16,000. Only then I will earn 16,000, pay everything to the preference dividend, to the preference shareholders, and I'll be left with exactly 0. Suppose if I earn more, my EFE will be positive. It will have some figure, and my EPS will also be running into positive. Suppose if my EAT is less than 16,000, which means my EFE will run into negative, my EPS will also run into negative. It will not be 0. So for my EPS to be exactly 0, my earnings after tax should be exactly equal to my preference dividend. Correct, guys? Yes. Now we know that if my EBT is 100, right, I need to pay a tax of 30, and then my EAT comes out to how much? 70 rupees. Correct? No? So now, if EAT is 70, how much I should have earned as an earnings before tax, so that after paying the tax, I'm exactly left with 16,000. Very simple. So now the calculation is going to be, if 16,000 is equal to 70, how much will be 100? So now do the calculation here. So if 16,000 divided by 70, how much is going to be 100? You will get how much? You will get 22,857. You will get 22,857, which means I should have earned 22,857 rupees. So only then on this I'll pay how much? 30% taxes into 0.3. If you do, you will get actually a tax figure of 6857, right? Exactly, you will get 6857. This is nothing but 22,857 into 30%. So literally I should have earned, if my EBT itself was 16,000, after paying the taxes, I'll be left with an amount lesser than 16,000. So my EFE will run into negative. No, my EAT should be 16,000, which means I should have earned an amount that is greater than 16,000, so that I should have earned 22,857. Only then, after paying the taxes, I will be left with 16,000 rupees. That will exactly be equal to my preference dividend. I'll pay for 16,000 and I'll be left with exactly nothing. Clear with this, guys? So literally speaking here, for me to have an EFE of 0, it is not enough if I just earn the amount that is equal to preference dividend. I need to earn an amount that is equal to paying my taxes as well as my preference dividend. So in this case, how did you compute this 22,875? 22,875 was nothing but the preference dividend amount divided by 1 minus tax rate. That's why divided by 70%. No? Divided by 70 into 100 is nothing but 70%. So literally this 16,000, this is 16,000 divided by 1 minus 0.3. Correct? No? 1 minus 0.3, because this is by 70 into 100, that is nothing but 70%. So literally 70% is 0.7. So this is how you arrived at it. Clear with this, guys? So now what's going to be your EBT? So your EBT should be how much? 22,857. But this is a figure that you should earn after paying an interest of 20,000. So what should have been your EBIT? Your EBIT should have been, so add 20,000 to this, 42,857. How did you arrive at this figure? This is nothing but 22,857 plus 20,000 rupees. Clear with this, guys? Or in other words, so how much amount you should earn so that your EFE will be equal to 0? I should earn an amount that is exactly equal to my interest plus preference dividend divided by 1 minus t. Why divided by 1 minus t? Because it is not enough if I just earn an amount that is equal to your preference dividend. I should earn something more than that. Only then, after paying the taxes, I'll be left with an amount that is exactly equal to 16,000 and recover back my entire preference dividend. Are you clear with this, guys? Hence, in this case, the formula to calculate your financial break-even point, that is the EBIT level at which your EPS is 0, is nothing but interest 20,000 plus preference dividend divided by 1 minus tax rate. So 16,000 divided by 16,000 divided by 0.7 gives you how much? 22,857, right? 22,857 plus 20,000 gives you how much? 42,857. So directly, instead of doing the reverse working, if you want a formula, the formula is this. So your financial break-even point is interest plus preference dividend divided by 1 minus tax rate. Clear with this, guys? As simple as that. This is all logical. Clear with this, guys? And finally, you have something called as your overall break-even point. Overall break-even point, this is similar to your operating leverage, financial leverage, combined leverage. Overall break-even point means what? How many units should I sell so that my EPS is exactly equal to 0? So how many units should you sell? Simple. You should generate a contribution that recovers not just your operating fixed cost, but it should also recover your fixed financial cost. Correct? So simple. So operating fixed cost plus fixed financial cost is what? Interest plus preference dividend by 1 minus t. Preference dividend alone is always by 1 minus t because this is a post-tax item. So you should earn for taxes as well as for your preference dividend, hence divided by 1 minus t. So now how much should be your contribution? You should have generated a contribution that recovers your fixed operating cost as well as your fixed financial cost. That is operating fixed cost plus interest plus preference dividend by 1 minus t, the whole divided by contribution per unit. If you do, you'll get the break-even point, the overall break-even point in units, or if you want it in value, take the same numerator divided by PV ratio. Clear with this, guys? As simple as that. But all these things are not required. The most important thing in our FM discussion is only your financial break-even point. What do you mean by a financial break-even point? It is that point of EBIT at which my EPS is equal to 0. How will you calculate that? It is equal to interest plus preference dividend divided by 1 minus t. And that's about this particular area. We saw one numerical example as well here. Clear with this, guys? Very small area, and with that, the entire concept of your break-even point has been revised. So now let's move on to part C of our discussion here. It is nothing but EBIT, EPS, MPS analysis. Now, what is this analysis? What is this particular part? This is fairly a simple part once again. Now, what we are going to see here is, no, look at this. I said we have 4 plans. Example, I want to raise 100 crores. What are the options available for me? So there are so many options. Option number 1, all equity, and raise the entire amount from the equity channel only. Option number 2, 50 from equity, 50 from debt. Option number 3, 60 from equity, 40 from preference. Option number 4, 30 from equity, 20 from preference, and 50 from debt. Or there could be option 5, option 6, so many other options. Now, how will I decide which option is best for me based on certain parameters? The parameter could be either your EPS, that is earnings per share, or MPS, or market price per share, or you can also use some other metrics like return on equity and all. Now, what you need to do, very simple, guys. For each of the alternatives, what you need to do, compute the EPS. For every alternative, compute the EPS. How will you compute it? So your EBIT minus interest gives you your EBT minus tax gives you EAT minus preference dividend. EFE divided by number of shares gives you EPS. Right? Like this, you compute for all the options and go for that option that gives you the maximum EPS. Clear with this, guys? So if you are a person who will take a decision based on EPS, compute EPS of all the alternatives and go for that alternative that gives you the maximum EPS. No, sir, I am a person who takes decision based on MPS. Simple. Arrive at the MPS for each of the alternatives and go for that option that gives you the maximum MPS. Clear with this, guys? How will you arrive at MPS? Very simple. MPS is nothing but EPS into price earnings ratio. Price earnings ratio. What do you mean by price earnings ratio? It's nothing but it's a multiple, right? So price earning ratio is nothing but MPS divided by EPS. Clear with this, guys? So if you multiply this EPS with MPS by EPS, literally it gets knocked off and you arrive at the MPS figure only. Or in other words, let's say price earnings ratio is 5 times. What does it indicate? It indicates that your market price is 5 times your EPS. So if you have an EPS, multiply it with PE ratio, you will arrive at the MPS value. Clear with this, guys? Right. Now, as per EPS, let us say alternative 1 gives you the maximum EPS. You are saying alternative 1 is the best plan. Whereas under alternative number 2, right, or whereas under MPS, let us say option number 2 has the maximum MPS. Sir, no sir, option 1 is best or option 2 is best. No, there is nothing as such in our subject, financial management. This is always an open-ended subject. Of the lot, which is the best, you tell me, sir? No, you can't tell like that. From the perspective of EPS, or plan number 1 could be better. From the perspective of MPS, plan number 2 could be better. Clear with this, guys? That is the maximum you can say, and you can leave it here. Clear with this, guys? So you need to do all the computations for every single plan, and then you need to go ahead. Now let's go and do one numerical problem in this regard. All this explanation I have given here literally, but predominantly. So how to do it? We will take one numerical example and we will be doing it here. Now in the doubt buster segment, I have mentioned EBIT will not change depending on the capital structure. Now if you look at this, for all the plans up to the EBIT level, the figures will not change. EBIT will be the same. Why? EBIT is nothing but your costing profit. It is not driven by the sources of finance. Clear with this, guys? So your sources of finance will only affect your figures coming after your EBIT. That's number 1. Number 2, MPS is equal to EPS into price earning ratio. I told you EPS is nothing but EFP, earnings available to equity shareholders, divided by number of equity shares. Now let's go and do one numerical problem in this regard, and with that we will have a crystal clear clarity on revising this particular segment as well. Now let's take this question number 5A from page number 88 of our solved question bank. Now, suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary equity shares of 10 each, right? At present, they only have equity share capital in the capital structure that to 1 lakh shares the rate of 10 each, right? The firm wants to raise 2,50,000 rupees to finance its investments, and it's considering 3 alternative methods. Already they have how much? 1 lakh shares at the rate of 10. Over and above that, they want to now issue or raise money to the extent of 2.5 lakhs. For this 2.5 lakhs, they have 3 different alternatives. Alternative number 1, that 2.5 lakhs also will be raised through equity channel. Issue 25,000 ordinary shares at the rate of 10 each. This is one alternative. Second alternative, borrow 2,50,000 rupees at the rate of 8% interest, right? So this is through the debt route. Or third alternative, issue 2,500 preference shares at the rate of 100 each at an 8% rate of dividend. Clear with this, guys? This is what they are saying. 3 alternatives. If the firm's EBIT, right, so earnings before interest and taxes after the additional investment are 3,12,500. Now after making this additional investment of 2.5 lakhs, let's say the firm's EBIT is 3,12,500, which means 3,12,500 is the EBIT for all the 3 alternatives. That will not change. From here on only things will change, right? And the rate of tax is 50%. Find the effect on EPS under the 3 different financing alternatives. A very good sum to actually quickly recap the entire concept that we have seen till now. Right now, what happens? Option number 1 is your equity financing. Option number 2 is your debt financing, and option number 3 is your preference financing. But remember, in all the 3 alternatives, at present, already I have raised how much? 1 lakh shares at the rate of 10 each. So 10 lakh rupees is already there. This particular plan is for the additional 2.5 lakh. Clear with this, guys? Right. Now, all the 3 alternatives will start at the same operating profit level. That is from the same EBIT level. 3,12,500, 3,12,500, 3,12,500 minus interest. First alternative, all equity, no interest. Second alternative, yes, the additional amount of 2,50,000 is raised from the debt route. So 2,50,000 into 8% gives you how much? 20,000 rupees. Sorry, it gives you 20,000 rupees. Third alternative, it will not have an interest, whereas it will have a preference dividend. So now, if you subtotal it, you will get your earnings before taxes 3,12,500, 292,500, and 3,12,500. Minus taxes at the rate of 50%. So if you remove 50% here, the balance 50% will be your earnings after taxes 1,56,250, 146,250, and 156,250 again. From here, you will subtract your preference dividend. First alternative, no preference. Second alternative, also no preference. Third alternative, 2,500 shares, rate of 100 each. So 2,50,000 rupees into 8 percentage. So it's going to be 20,000 rupees by way of preference dividend. So now finally, if you arrive at the EFE, alternative number 1, 156,250. Alternative number 2, 146,250. And alternative number 3, you've got how much? You've got 136,250 rupees. Clear with this, guys. Right now, divide this divided by the number of equity shares. Under the first alternative, I already have 1 lakh shares, and now I'm going to issue how many shares? 25,000. A total of 1,25,000 shares will be outstanding in the first alternative. In the second alternative, so existing 1 lakh shares only, no fresh equity shares. Third alternative, once again, the existing equity shares only, no fresh issue, right? So what is going to be the EPS? First alternative, 250 divided by 125,000 gives you how much? 1.25. The second alternative, 1,46,250 divided by 1 lakh, simple, it's 1.4625, rounded out to 1.46. And the third alternative gives you 136,250 divided by 1 lakh is going to be 1.36. Now you tell me, from the perspective of EPS, which gives you the maximum EPS, the plan number 2 gives you the maximum number of EPS. Hence, you will go for plan number 2. Plan 2 is the best plan from the perspective of EPS. Don't say always it is the best. From the perspective of EPS, plan 2 appears to be good. Now look at this. The firm is able to maximize the EPS when it uses the debt financing. Though the rate of preference dividend is equal to the rate of interest, EPS is high in case of debt financing because the interest charges are tax deductible. We saw this, while the preference dividend are not. With increasing levels of EBIT, EPS will increase at a faster rate with a high degree of leverage. We saw that leverage works in favor in case of a growing company or a company that has a higher EBIT. So that's the reason why even we saw indifference point. We always say that if your expected EBIT is above your indifference point, go for that alternative that actually gives you a higher fixed financial cost because your leverage will work in your favor. All of these things we have seen, right? In this case, if you see, even your debt had an 8% interest, even your preference had an 8% dividend, but still, why was debt preferred? Because the effective cost of debt is not 8%. 8 into 1 minus 0.5, it's only 4% because it parallelly had a tax saving. Clear with this, guys? So that's some learning here. So this is actually we learned this in cost of capital, right? The leverage concept we learned in leverage, and the EPS calculation we are doing it in this chapter. So this is basically like the previous 3 chapters put together, right, and summarized in a single particular question. Clear with this, guys? So that's the way you need to learn this particular subject. Fine. Now that's about this question, but one more example I'm giving you here. We know that the market price per share is equal to earnings per EPS multiplied with your PE ratio. Now, if the PE ratio is same for all the 3 plans, then the plan with the highest EPS will also have the highest MPS, because if you're going to multiply the same figure with these 3 figures, obviously the figure which has the highest EPS will also have the highest MPS. Not a problem. Now, on the other hand, if the PE ratio for equity plan, let us say, is 10 times. So for the first plan, let us say is 10 times. For the debt plan, let us say it is 8 times. And for the preference plan, let us say it is 7 times. So the EPS plan wise is given in the question. Let us say it gives, the PE ratio is given plan wise, right? So how much is it? 10 times, 8 times, and 7 times. Let's say this is given in the question. Sir, can the PE change based on the plan? Yes, very much it can change, because now if you are introducing more fixed financial cost into your capital structure, obviously, generally what happens is your PE will fall. Generally the PE will fall because the market perceives risk for this particular company. Because if you're introducing more fixed financial costs into your capital structure, obviously it's a more risky entity. Hence, generally your PE falls. Now, look at this. Now, let's take the EPS, whatever we calculated above, multiply with the respective PE ratio. All equity, 10 your PE ratio is 10. Whereas in your debt, the second alternative, let's say the PE is 8, and in the third alternative, the PE is 7. So now if you multiply the two, you will arrive at the MPS. MPS for the first alternative is how much? 12.5. Second alternative, 11.68. Third alternative, 9.52. Now you tell me, from the perspective of MPS, which alternative is the best? First alternative is the best because it has the highest MPS. So, sir, now first plan is always the best? No. From the perspective of MPS, it is good. From the perspective of EPS, which is good, second plan is good. That's the maximum you can do in our subject, because You do not know from which perspective a person is seeing. Clear with this, guys? So this is what it is. Despite having a lower EPS, equity plan will be selected because it has a higher MPS. However, if a company is not able to earn a rate of return on asset higher than the interest rate or the preference dividend rate, the debt will have an adverse impact on EPS. What is this? We saw no trading on equity in previous chapter. Your ROI should definitely be greater than your KD. Only then leverage will work in your favor. In other cases, what will happen? It will completely work against you, right? So this unfavorable leverage condition will happen. This is what they have mentioned here. So this is a perfect way to wrap up this discussion on your EBIT, EPS, MPS analysis. Clear with this, guys? So if you are driven by your EPS, what you do, compute EPS for all the alternatives and go for that alternative that have the highest EPS. If you are driven by your MPS, go for that alternative that has the highest MPS, right? And go for, you just compute the MPS for all the alternatives and you go for that alternative that gives you the highest MPS. Clear with this, guys? And with this third segment of discussion is also over. Now let's move on to the next segment, popularly called as capital structure theories. Now in this segment we will be studying the relationship between cost of capital, that is KO, capital structure and the value of the firm, right? And we will also be learning the 4 popular capital structure theories. Basically, theories refers to perspectives. This was given by 4 different people. Clear with this, guys, right? So what are the 4 capital structure theories we'll be learning in this particular segment? One is called as the net income approach. The second one is called as NOI, the net operating income approach. The third one is the traditional approach. And the fourth one is called as the Modigliani-Miller approach with tax. And we will also be seeing the approach without tax. Clear with this, guys? We will be revising quickly all these 4 capital structure theories, but there is a way in which you need to learn this segment. Before this, first, you need to understand the general assumptions in this particular segment of this chapter. First, throughout this segment, there is no concept of preference shares, only in this segment. And by the way, guys, this segment, we are just learning what these 4 people have given in their theories. As simple as that, right? So whatever they have given, that is what we are going to study. Some theories could be logical, some theories could not be that logical. But here what I'm going to do is I'm just going to tell you what these guys have told. That's about it. So not everything could be logical. But whatever it is, we will be learning in detail as to what these guys have told, because all the numerical problems require you to understand what these theories says. Clear with this, guys? Fine. So now there's no preference share capital, which means there are only 2 sources of finance, namely the debt and the equity capital. And throughout, we assume a no tax culture. There is no taxes at all, except for approach with tax. Except for that, no other places we will be considering the taxes. Next one. We assume that the dividend payout ratio is 100%, which means whatever the company has earned, they will be paying it as dividend. The business risk is constant. The firm has a perpetual life, and KD will always be less than KE. Or in other words, you can say KE will always be greater than KD. Clear with this, guys? Why? Obviously, the equity shareholders are risk takers, so their expectation of return will also be more the risk, more the return. So obviously, KE will always be greater than KD. We saw that KD is more so a cheapest source of finance. Why? On top of everything, it also has a tax shield or tax advantage. That's why KD is interest into 1 minus tax rate. We saw literally you have a tax saving also. Always remember KE will be greater than KD. Right? And the firm's total financing remains constant. The degree of leverage can be changed by selling debt to purchase shares or selling shares to retire debt. Basically, what they are saying, whenever they want, they can actually change their capital structure. That is the proportion of debt and equity. Clear with this, guys? These are the general rules here. And there are some general formulas used in this area. First, the value of firm, as they call it as VF, is equal to value of equity plus the value of debt, VE plus VD. Now, what is VE? Now, guys, simple. Here, value of equity is equal to, on a per share level, equity value, the value of equity share is equal to EPS divided by KE. Now, this is nothing but based on the principles of time value of money. Now, the company is going to receive same amount of dividend, right, for the rest of its life, right? Sir, how's the same amount of dividend? We saw the assumptions here. So here, what it is going to be constant throughout. Correct? It is going to be constant throughout. And look at this here. The dividend payout is always 100%, which means what? EPS is equal to your DPS. Correct? Your earning per share is equal to DPS. So now, what is the present value of the share? Annual cash flow, which is EPS, right, equal to DPS divided by the discount rate. For equity, the discount rate is going to be KE. So here, the value of equity per share is equal to EPS by KE, or if you want to find out the total value of equity shares, it's nothing but EFP, the entire earnings available for equity shareholders, divided by the discount rate KE. Clear with this, guys? That's the logic for calculating VE. So value of equity is equal to EFP by KE. Clear with this, guys? Similarly, value of debt. So what is the debt to holders? What is the cash flow they earn? Interest amount. So interest amount divided by the discount rate. For them, the discount rate is KD. Clear with this, guys? And value of firm. Value of firm means what? Both equity plus debt. What is the amount that is available to all the sources of finance? That is EBIT. So EBIT divided by the discount rate. What is the discount rate applicable to all the sources of finance? It is overall cost of capital, KO. So value of firm in this segment can be calculated as EBIT divided by KO. Are you clear with this, guys? These are some basic understandings. We are seeing it in logics, with logics in the marathon itself. In the revision itself, we are seeing all this logics. Now, remember one thing. If I want to increase the value of the firm, I need to reduce my denominator KO. If the denominator cost reduces, obviously the value of the firm will increase. Clear with this, guys? Now KO, how do I compute? So I can say KO is equal to KDWD plus KEWE. We saw the weighted average cost of capital, the respective cost with multiplied with the respective weight. So KD stands for cost of debt, WD stands for weight of debt, KE stands for cost of equity, WE stands for weight of equity. Clear with this, guys? Now remember one thing. Generally, if you increase the proportion of debt in your capital structure, your overall cost of capital reduces. Why? Because now you are raising more money from a cheaper source of finance. Obviously, your average cost of capital will reduce. In general, I'm saying in general. Clear with this, guys? So if you start infusing more debt into your capital structure, your KO, your overall cost of capital, will reduce generally. Clear with this, guys? Have this assumption. Now, there are these four methods. There are these four capital structure theories. Now, they are broadly classified into two: capital structure relevance theory, capital structure irrelevance theory. What do you mean by relevance and irrelevance? Those theories that say that by infusing debt in your capital structure, or by coming up with the right mix of debt and equity in your capital structure, the value of firm can be increased. So the capital structure decisions, right, are relevant to increase the value of firm, right? If a particular theory says that by mixing the by mixing the right amount of debt and equity in my capital structure, if I can increase the value of firm, it is called as a relevance theory. What do you mean by irrelevance theory? Irrelevance theory basically means that no matter what you do, your value of firm will not change. Sir, debt equities are all debt, all equity, or debt equity, 60-40, 80-20, whatever it is, right? You can mix any kind of proportions. It will never impact the value of firm. The theories which says that capital structure decisions are irrelevant to arrive at the value of firm, those particular theories are called as irrelevance theory. Now, basically, there are two theories which say that capital structure decisions are irrelevant. One is your net operating income, the approach. The other one is your approach without taxes. Clear with this, guys? And the relevance theory is said by NI, the first net income approach, your traditional approach. It also says by actually mixing by arriving at the right mix of debt and equity, you can increase the value of firm, right? And finally, even the approach with tax also says that capital structure theories are relevant. Clear with this, guys? First, let's get started with one by one. You will now be able to recapitulate everything. First, guys, let's get started. NI approach. So NI approach, this particular approach is called as the net income approach. What does it say? This approach was given by David Durant in the year 1952. And according to this approach, capital structure decisions are relevant, which means what? By infusing the right mix of debt and equity, I can increase the value of firm. How can you increase the value of firm? By reducing the overall cost of capital. Reduction in KO will increase the VF, value of firm. Clear with this, guys? This theory suggests that the value of firm can be increased by reducing the KO. We just saw, because KO is nothing but the denominator. If you reduce KO, obviously VF will increase, because VF is nothing but EBIT divided by KO. Clear with this, guys? Now, sir, then how can I reduce my KO? You can reduce by KO by bringing more debt into your capital structure. KO can be decreased with a higher proportion of debt. Why, sir? Because between debt and equity, so KE is always greater than KD, or KD is a cheaper source of finance. If you start infusing more amount from a cheaper source, the proportion of the cheaper source will increase, and hence your weighted average cost of capital will reduce. Clear with this, guys? This is something that you need to understand. Under NI approach, your KE is greater than KD, but remember one thing, KE and KD will remain constant. What do you mean by this? Now look at this here. Leverage basically means weight of debt, that is percentage of debt in capital structure. What they are saying, so if you start infusing more debt in your capital structure, this method says KE figure will not change. KD figure will also not change. Do not worry about that. So KE and KD remains constant, but if you start infusing more debt in your capital structure, what will happen? Your weighted average cost of capital will slowly start coming down. Clear with this, guys? Are you all understanding it? Because if you are infusing more amount, right, from a cheaper source of finance, the average cost will obviously fall now. Correct? Clear with this, guys? This is what this method says. But because of me infusing more debt and all, KE figure will not change, KD figure will not change, but KO alone falls, and this is what the particular method of your net income approach clearly says. Clear with this, guys? Yes. Now let's go on to the second approach called as the net operating income approach. This approach was also given by David Duran in the year 1952. Now he says that as per this approach, right, the capital structure decisions are irrelevant. It is exactly opposite of NI approach. Now basically, guys, what it says is, now let's go to the graph. With the help of graph, you will understand this. It says, now this is nothing but weight of debt. As I infuse more debt in my capital structure, KD will not change. He says KD will remain constant. He goes on to say KO will also not change. KO will also not change. But what he says is KE will increase, because the logic that he gives here is, if I start infusing more debt in my capital structure, my equity shareholders are now being more risky, correct? They will not expect the same KE. KE will not be constant. They will also now start expecting more. So KE will increase. Clear with this, guys? So then how, sir? KO remains constant. He says, simple. So KO, how do you calculate? KO, how do you calculate? It is nothing but KDWD plus KEWE, correct? That is cost of debt into weight of debt plus cost of equity into weight of equity, correct? Now, if you are increasing, increasing the weight of debt, right? It's going to be an advantageous position for you, right? It's going to be an advantage. Why? Because you are going to raise more money from a cheaper source of finance, guys, correct? If weight of debt is increased, obviously weight of equity will reduce, because it balances. Weight of debt plus weight of equity has to be 100%. If I am actually raising more money from the debt route, obviously the equity component will reduce, right? So it's basically an advantage. But he says this advantage is exactly offset by an increase in the KE. Sir, one advantage is what? By way of increase in the weight of debt, this exact advantage will be offset by one more disadvantage, that is increase in KE. So the debt advantage is going to be offset by a disadvantage with increase in KE, and hence overall your KO remains constant. This is what it says. One advantage will be offset by another disadvantage. Advantage is increase amount, that is increase proportion of debt, that is the advantage. What is the disadvantage? Increase in KE. Overall, if you see, it will always balance out and KO will never get affected. And if KO is not affected, the value of firm remains constant. Clear with this, guys? Sir, is it like this, sir? In real life, is it how it happens? No, this is one proposition or theory given by this guy. As simple as that. And I'm just telling you what this guy has told. Clear with this, guys? So as per the NOI approach, what it says, so KD remains constant, KE will increase, and this is being offset exactly, and it will not impact my KO. So KO remains constant. When KO remains constant, the value of firm remains constant. Hence, capital structure decisions are irrelevant. That's what this guy says. Clear over this, guys? Yes. Other points in NOI, KE is always greater than KD. That we all know. KD will remain constant, and KO will also now remain constant. That's what this particular method says. Clear over this, guys? So in NOI approach, NOI, this method, KO remains constant because the low cost advantage of debt is exactly offset by increase in KE, right? Now, NI versus NOI, we are going to see as you infuse more debt in your capital structure, what happens? Under first NI approach, KD remains constant, KE remains constant, right? KO alone will decrease as you infuse more debt, and if KO decreases, value of firm will increase. Clear with this, guys? A clear-cut comparison between the two. Whereas what does your NOI approach says? KD remains constant, but if you start infusing more debt, KE will increase, right? And it gets exactly offset. So KO will not change. It remains constant. If KO remains constant, your value of firm also remains constant. This is a one-line summary of the previous two models that we have seen till now. As simple as that, guys. Very, very simple. Clear with this, guys. Now let's go to the traditional approach. Traditional approach actually says it's a mix of everything. Now what it says? According to this approach, capital structure decisions are relevant, right? Relevant means what? So KO will get changed. If your KO changes, your VF will be impacted. So if your KO reduces, your VF will increase. Now, what it says is, sir, always KE constant, KD constant, or KO falls. All these things are not there. It happens in three phases. It happens in three phases. Now, what does this traditional approach say? What does this traditional approach say? Now, I will give you guys this particular graph. It says for the first initial phase, as you infuse more debt, right? As you infuse more debt, it says KE will remain constant, KD will remain constant, and KO will slightly reduce. Or in other words, the phase number one is similar to the first model NI approach. Clear with this, guys? One phase up for some time, if you start infusing more debt, KE will not change, KD will also not change, and since you are infusing more debt, right, obviously your KO will fall. This is what they are saying. Now, after this phase gets over, phase gets over, the second phase will begin. Now, further beyond this phase also, if you are infusing more debt, it says KD will remain constant, right, and KE will start increasing, and what they are saying now, KO will remain constant. Or in other words, this phase 2 is exactly same as NOI. It says now KD will remain constant, KE will increase, and KO will not change. Basically, there's nothing but your NOI approach, your low tax, your low cost debt advantage is exactly getting offset by your KE figure, increase in KE, and hence it will not impact my KO. This is what this particular traditional approach says in the second phase. And even beyond the second phase, if you still want to raise more money from the debt route, what happens? It says now KE will increase, KD will increase, and hence KO will also increase. Beyond this point, what happens? KE will increase. Why? Obviously, more debt, more risk for the equity shareholders. Now, even the debt holders will feel this guy has already raised a lot of money from so many other people. Once again, he's raising money from me. So, obviously, he will charge more interest. So, the KD will also increase. So, KE is increasing, KD is increasing. Back, your K was nothing but average of the two. Obviously, that will also increase. Clear with this, guys? That happens in the third phase. Or in other words, in your traditional approach, the first phase is your NI approach, second phase is your NOI approach, third phase, all the three components will increase. Clear with this, guys? This is what this particular method says. And the optimum capital structure occurs at the point where the value of firm is highest and the cost of capital is the lowest. Clear with this, guys? So based on the figures given in the question, right, you need to apply this model and accordingly should find out the optimal capital structure. Right? So the main highlight of traditional approach, the firm should strive to reach the optimum capital structure and its total valuation through judicious use of both debt and equity in the capital structure. At the optimal capital structure, the overall cost of capital will be minimum and the value of the firm will be the maximum. And this is the graphical representation. Up to one phase, what happens? NI comes in, right? And till the second phase, what happens? NOI comes, and after that everything will increase. Clear with this, guys? That's the third phase, and that's about this particular segment. See guys, it's very simple provided you understand it conceptually, visualize things on a graph, and as simple as that. Clear with this, guys? Right? Now let's go on to the next one, approach. Now, approach has two things. One is without tax, the other one is with tax. Now, guys, approach without tax is exactly same as the NOI approach, right? He says it's a copy paste of NI approach. So then why are they giving it as an approach? He gives the same NOI approach with some justifications, right? Why this happens? What does NOI say? NOI say as you start infusing more debt in your capital structure, KD will not change, right? But KE will increase, and this is getting exactly offset, hence your KO will not change. This is all it says. But this guy is giving some propositions and all. What it is we will be seeing. He gives some justification as to how this happens, why this happens. That's called as approach without taxes. So obviously under approach without taxes, capital structure decisions are irrelevant. Why? It's nothing but a copy paste of your NOI approach, but with some justifications, and your KO does not change. Obviously your value of firm will never change in this case as well. Now, approach without taxes. So it was given by right, Modigliani Miller. These two guys, they are two guys basically from Italy, right? So it was given in the year 1958. This is similar to NOI approach, and capital structure decisions are irrelevant. VF, value of firm, and KO will always remain constant and are not affected by the increase or decrease in the component of debt, that is weight of debt, right? And approach, he presents three propositions in this analysis. What is this? Number one, value of firm is equal to EBIT by KO. You guys know this. We have seen it already. Value of firm is equal to EBIT by KO. He calls EBIT as net operating income. There is no specific logic for net operating income, net income. Sir, why the name of the approach? It has nothing to do with what they say. Do not worry about that. Clear with this, guys? This is basically your EBIT. This guy calls it as your net operating income. So VF is equal to EBIT by KO. We already know that. And the total value of the firm and KO remains constant. Therefore, the value of a levered firm is equal to value of unlevered firm. What do you mean by a levered firm? A levered firm is a firm that has a debt in its capital structure. We saw leverage. When will you have leverage? When you have a fixed financial cost in your capital structure. That's nothing but the debt component here. Clear with this, guys? So always he says value of a levered firm is exactly equal to value of unlevered firm. Why? Because KO does not change, right? In that case, what happens? Value of firm will also not change. So all the firms will have the same value. That's what approach without taxes says in this first proposition. Proposition number two, he says KE is equal to KO plus KO minus KD into debt by equity. Sir, what is this formula? Guys, once again, logical. This is something exactly same as the trading on equity concept we saw in our previous chapter, leverages. Sir, what is this, sir? Now, simple. Now, let me just take this example. So what does he say here? KE is equal to KO plus KO minus KD into debt by equity. This is the formula he gives. KO plus KO minus KD into debt upon equity. This is the formula he gives. Now, sir, how is this formula? All right, simple, guys, simple. Now, let us say the company has raised equity, debt. Company has raised 60 crores from equity, 40 crores from debt. They have raised a total of how much? 100 crore rupees, right? Now, let us say on this 100 crore, the company generates a return of, let us say, for example, the company generates a return of 15%, right? So return is nothing but EBIT divided by total capital employed. Clear with this, guys? Or in other words, EBIT divided by capital employed is nothing but VF, right? That is nothing but, this is equal to KO only, no? Guys, we saw KO is equal to EBIT by VF, or VF is equal to EBIT by KO, we saw. Or in other words, this 15% is nothing but KO only. Guys, clear with this, guys? Yes. Now, let us say debt, the KD, the cost of debt, let us say on the debt component, the company needs to pay an interest of, let us say, 12%. There is no taxes here, so interest itself is equal to KD, right? 12%, or why? I will take a simple example. I will take this as 10%. Clear with this, guys? Now, You tell me the company invested 100 crores, right? On this 100 crores, every single rupee, the company was able to earn how much? 15 percentage, right? So the company earned 15 percentage on both the 60 crore component as well as on the 40 crore component. Yes. Now you tell me the equity shareholders, how much will they earn? On their 60 crore component, they will definitely earn their 15 percentage. Yes. Now, how are the debt holders? Will they be paid 15 percentage? No. On this debt component, 40 crores, the company needs to pay only 10 percentage. Or in other words, on this debt component of 40 crores, right, there is an extra earning of 5 percentage, right? There is an extra earning of 5 percentage on this 40 crores, right? That goes to whom? This figure will go to whom? The equity shareholders only. Or in other words, guys, or in other words, how much will the equity shareholders earn? The equity shareholders will earn, right, on their 60 crores, they will earn 15 percentage, right? On top of it, on the 40 crores of debt funding, on the 40 crores of debt funding, what will they earn? On that also, they will earn 15 minus 10 percentage. Only 10 percentage gets paid to the debt holders. Extra 5 percentage comes to whom? Extra 5 percentage comes to the equity shareholders. Clear with this, guys? So this will be the total earnings available. This will be the total earnings for the equity shareholders divided by with whatever amount they invested, because we are calculating KE. KE is nothing but the expectation of return of equity shareholders. How much was the amount they invested? It is 60 crores. Clear with this, guys? Clear with this, guys? So here can I say, if you have to separately do this, this is nothing but 60 crores into 15 percentage divided by 60 crores plus 40 crores into 5 percentage divided by 60 crores. Correct? Or this 60 and 60 gets knocked off here. So can I say this is nothing but 15 percentage? Guys, correct? Plus here can I say it's nothing but 5 percentage into 40 crore divided by 60 crore. Guys, correct? This will be the earnings for the equity shareholders. That is the net return for them. Guys, correct? Or this 15 percentage is nothing but what? This is nothing but KO plus 5 percentage. How did you arrive? It was KO minus KD. Guys, into this 40 crore. What was 40 crore? It is the debt value, right? Yes, divided by what is 60 crore equity value, and this will give you the formula here. It's nothing but Ke is equal to KO plus KO minus KD into debt upon equity. This is nothing but trading on equity formula, which we actually saw in the previous chapter. Guys, all these chapters are interrelated. Clear with this, guys? As simple as that. See how logical and simple this is. Clear with this, guys? Do not mug this up. Fine. And finally, you've got the third propositions, and the third proposition says that the capital structure does not affect the overall cost of capital. KVO, we've seen this. It's a capital structure irrelevance theory, right? And the cost of capital is affected only by business risk and not by financial risk. So it says only operating leverage will affect it. Financial leverage will not impact your KVO. That's what this guy says. And the graph is exactly same as your net operating income approach. So as you infuse more debt, weight of debt in your capital structure, KD will not change, but KE will increase. That is exactly offset, and hence your KO remains to be constant. Clear with this, guys? They have given KW. W stands for weighted average cost of capital, or you can also write it as KO. Not a problem. Clear with this, guys? Are you all understanding this? Yes, as simple as that. Now what has happened? This was introduced or given in the year, I think, 1 second. Yes, this was given in the year 1958, right? So that was the time slowly taxes were all picking up. In fact, if you see even in India, the Income Tax Act came in the year 1961. Now what realized was, okay, so fine, my approach is correct, whatever I am saying, my proposition, but then I ignored taxes. Now slowly countries are actually levying taxes. So he came up with something called as approach with the tax. One small amendment he made, that was in the year 1963. So he said he incorporated taxes. Now when taxes considered, what has happened? Debt will now be a cheaper source of finance. There will be a tax shield on debt and all. Guys, clear with this? Hence, now he has come to a conclusion. Now, value of firm will not be the same, because the value of a levered firm, a firm that uses debt in its capital structure, value of levered firm will definitely be more than the value of unlevered firm. Why? Because it has some tax savings and all. Debt component has tax saving. Hence, because of that, the value of a levered firm will always be greater than the value of an unlevered firm. Sir, how, sir, is arrived at it? Value of a levered firm is equal to value of an unlevered firm plus debt amount into tax rate. This debt into tax rate is nothing but the present value of all the tax shields, all the tax shields on tax shield on your interest payment up to perpetuity. This is actually derivable. I have derived this ideally in our classroom discussion, both in the fast track as well as in our regular courses. But as actually this derivation and all is not required even in a marathon, in a revision batch. Basically, we are running short of time. Hence, I am presenting it every here neatly. But remember one thing: this debt into tax rate, it's a logical formula, right? It can be derived using what your time value of money concepts only, right? So present value of all the future tax shields received up to perpetuity, you can use that GP, geometric progression formula. In case you have attended my lectures, the notes will be there. Please revise it quickly, and that's about this area is done. Here with this, guys. Yes, so where VUL stands for value of an unlevered firm, right? D stands for debt and T stands for tax rate. Clear with this, guys? This is what popular formula used under approach with tax. Now, apart from this approach with tax, they have also given two other formulas. They are rarely used, but at times it can also come, right? In one past RTP also, I think they asked. So he has given KEG means what? So KE of a levered firm is equal to KE of an unlevered firm plus KE of an unlevered firm minus KD into debt by debt plus equity. This is one more formula given here. But guys, this ideally is nothing but the previous formula of proposition number 2. But actually, in the denominator, what they have done, instead of debt by equity, they have done debt by debt plus equity. That's all it is. Why? Now, logically, this particular formula is not correct. But mathematically, if you derive, right, so it runs into pages and you will arrive at this formula. But my suggestion, which I generally say, is do not waste your time into deriving this. Accept this formula as such and apply, because till now, literally all the formulas I have derived and showed it to you in our regular batch and fast track batch. Also, I have done even in the marathon, wherever possible, I have done it, right? This area, it runs into pages, and after I derive and show you, will only think I will rather directly read this formula. As simple as that. Rarely tested. In case they use this formula, what will you do? So KE of a levered firm is equal to KE of an unlevered firm plus KE of an unlevered firm minus KD into debt by debt plus equity. Just insert this formula to arrive at the KE of a levered firm. Clear with this, guys? And there's one more formula, KOG, that is nothing but the WACC of a levered firm is equal to KE of an unlevered firm into 1 minus tax rate into debt by debt plus equity. This they have derived from the previous formula only. So these two formulas are rarely used, but in case it is used, directly apply this formula and you are done with this area. Clear with this, guys? Now, apart from this, you have something called as an arbitrage process, right? Arbitrage process is generally an offroot of your with tax. Now, arbitrage is actually a CA final, your CA final level area, but at the intermediate level, you have a very minimum area. And I think in the study material, there are 4 sums, right? There are only 2 varieties, and under each variety, there are two sums, right? We have done all the sums in detail in both our fast track and in our regular batch. But here I will quickly explain what this arbitrage means. Arbitrage is basically, a process that happens when there are 2 markets, generally when there are 2 markets, right? So what you do is, look at this. It refers to buying an asset at a lower price and selling it at a higher price. Clear with this, guys, right? Now, as a result, equilibrium is attained in different markets. Basically, guys, this arbitrage, it actually comes along with without tax, not with tax, without taxes. In case of without taxes, what will happen? The value of a levered entity should be equal to what? Value of unlevered entity. Correct? No? The value of both the entities should be the same. Correct? Now, suppose there could be two situations. The value of a levered company is less than the value of unlevered entity. Right? Or there is a second alternative. The value of unlevered entity is less than the value of a levered entity. What will you do? In the first situation, what value is less? Levered entity has a lower value. So what is it? So you will sell the value of an unlevered entity. You will sell the unlevered entity, the shares if you are holding, sell the shares of unlevered entity and buy the one which is undervalued. Clear with this, guys? Because Ideally speaking, both should be the same, but value of a levered entity is valued less. So you buy that, clear with this, you buy that and actually you sell the shares of your unlevered entity. Suppose it happens the other way around. So unlevered entity is valued less, levered entity is valued more. What will you do? Sell the shares of sell the shares of levered entity. That is basically you should sell whichever one has a higher value and buy the one which has a lower value. Always remember, buy low, sell high, and you make a profit out of this particular transaction. So arbitrage is a process where you start from a point and you reach at the same point, but in the process you will be actually you will be getting the profit. Clear with this, guys? You start from a point and end at the same point. In the process you will be getting the same you will be getting some profit. Clear with this, guys? So there are a couple of numerical problems in this particular segment, but because we are in this marathon, I'm not discussing all that. But clearly, guys, this is something that we have seen in our regular as well as in our fast track lectures, and also the questions on this are there in our solved question bank only. So those who have not attended my classes, maybe you can also have a look at it. And with that, this is getting over. Clear with this, guys? So with this, literally, we have covered this entire chapter. So in this entire chapter, we saw 4 segments. The first segment was with respect to your EBIT EPS indifference point. We saw what that was. It is a point of EBIT at which 2 different alternatives will give the same EPS. Then we went on to see what you mean by your break-even point. The break-even point is a point of EBIT. The financial break-even point is a point of EBIT at which your EPS is equal to 0. And then the third segment was with respect to EBIT, EPS, MPS analysis. So what will you do? You compute the EPS for each of the alternatives, go for the one which has the highest EPS, or you compute your MPS for each of the alternatives, go for the one which has the highest MPS, and so on. So based on the decision criteria, compute that for each of the alternatives and go for the one that has the highest alternative. Clear? And finally, we went on to see the capital structure theories. There are 4 capital structure theories: your net income approach, your net operating income approach, your traditional approach, and your MM approach. And under MM approach, we saw the MM approach with tax, MM approach without tax. And in your MM without tax, you also had something called as an arbitrage process, which I briefly explained right now. And with this entire chapter has been revised right now. Guys, trust me, this is the power of conceptual learning. If you read it like this, if you study or prepare like this, there is no way you will find the subject difficult, because this is all it says, right? Of course, this requires some numerical, the practical solving and all that. So we have literally done all the questions in our courses and all. And in case you have not taken my lectures, not a problem. You might have done a self-study or with another faculty, whatever it is. Prepare it along with your notes this marathon, and that's about it. Clear with this, guys? Clear with this, guys? And with this, we have clearly completed this particular chapter called as capital structure theories. Now, let's move on to the next chapter. Now, let's start with the revision of the next chapter called as investment decisions. Now, this chapter, investment decisions, is also called as capital budgeting. Now, guys, as we've seen, our subject has 3 objectives: financing decisions, investment decisions, and dividend decisions. And as the name of this chapter goes, this chapter helps you achieve the second objective, that's called as investment decisions. Clear with this, guys? Yes. Now, what do you mean by investment decisions? Now, let's say there's a company with a balance sheet. Now, it would have raised money from different sources of finance, say equity share capital, preference share capital, retained earnings, your debt, and all of those things. Now, once they have raised the money, what will they do? Will they just put it in a savings account and will they sleep? Absolutely not. They will park these funds or invest this money into their non-current assets, that is long-term assets, popularly called as fixed assets. Correct? Now, in which fixed assets should the company invest? For example, should they purchase machine number 1 or machine number 2? Or let's say, should they go for an automated machine or should they go for a semi-automatic machine? Now, how will they arrive at these decisions, right? So that is what is getting covered under this chapter called as investment decisions. For example, a simple example I'll tell you, right? One of the tools of capital budgeting is NPV, net present value. We all know what NPV is. Now, how will you do NPV? Simple. You arrive at the present value of cash inflows, subtract that with the present value of cash outflows. So you will arrive at the NPV. If the NPV, the net present value, is positive, you go for that particular machine. If it is negative, do not go for it. Or if you are comparing between the two, go for that one, go for the machine which gives you the highest NPV. Clear with this, guys? Now, how will you arrive at NPV? So you need to arrive at respective year's cash flow, right? And you need to discount it with the respective rate, right? So it's going to be the cash flow of a particular year divided by 1 plus r to the power n. So if you do it, you will arrive at the present value of all the cash inflows, subtract that with the present value of cash outflow, and whatever you get, that is called as a net present value. If that is positive, you can go for that project. If it is negative, do not go for the project. Or in case you're comparing between two mutually exclusive projects, go for the one which has a higher NPV. Now, this is one of the tools. NPV is one of the tools that we will be seeing in capital budgeting. So now, in this particular chapter, in investment decisions, we are going to see how every rupee that we have raised should be optimally invested and optimally used. Clear with this, guys? So this particular chapter talks about the optimum utilization of funds. Clear with this, guys? So investment decision is concerned with the optimum utilization of funds to maximize the wealth of the organization and in turn the wealth of the shareholders. And we've seen in cost of capital chapter that every rupee raised by the company, right, it bears some cost to it, popularly called as the KO. So entire amount put together, the weighted average cost of capital, that's my cost, correct? Hence, each rupee raised needs to be invested in a very prudent manner, and this requires a proper plan for capital, and it's done through your proper capital budgeting. Clear with this, guys? So what you need to do in this particular chapter is, first, you need to identify what are all the investment avenues available, right? And for each of these investment avenues, first, you should estimate what are all the cash flows, right? Because this entire subject of financial management deals with matching of cash flows, arrive at the cash flows, and then you should select that investment whichever maximizes the return using capital budgeting tools. In this chapter, we'll be seeing what are all the tools that we have to evaluate different investment proposals. Clear with this, guys? So there are different types of capital budgeting decisions. For example, you'll be having replacement modernization decisions, expansion decisions, diversification decisions. Basically, what are these? When will you invest in assets? Maybe if you want to replace or modernize your particular machines, or if you're looking for an expansion, you'll go to a new place and maybe you'll start a new factory. In that case, also investment in fixed assets is required. Diversification, maybe I'm entering into a separate product line. Once again, in this case, also investment in long-term assets is required, right? On the basis of situations, mutually exclusive, whether I should go for machine 1 or machine 2. So what do you mean by mutually exclusive? Selection of one alternative automatically results in rejection of the other. That's what is meant by mutually exclusive decisions. Accept reject decisions, that is whether I should go for a particular project or not. And contingent decisions mean, let's say I want to start a factory in a rural area, but the government says if you want to start a factory there, you should also build the roads in that particular area. So here basically me starting the factory is contingent upon me fulfilling certain criteria prescribed by the government. In this case, when I am actually arriving at all the cash flows of this particular project of factory, I should also consider the cost of constructing my roads and all that, because only that is actually a prerequisite for me to enter into this project. It's called as contingent decisions. This is all theoretical in nature. Now, what are the steps involved in capital budgeting process? First, you need to estimate the cash flows over the entire life of the projects. Number 2, evaluate each of the alternative using different decision criteria. Decision criteria, what are they? One example of the decision criteria or the tool of capital budgeting, one example was net present value. Clear with this, guys? There's something called as IRR, there's something called as payback period, there's something called as your ARR. There's so many tools which we'll be seeing in this chapter, right? And finally, sir, NPV, sir, okay, I'm doing, but I need a discount rate to arrive at the present value of all the cash flows. No, sir, what is the discount rate? Very simple. The discount rate is nothing but your weighted average cost of capital only. So determining the minimum required rate of return, that is WACC, to be used as a discount rate. Sir, why, sir, do we use WACC as a discount rate? Simple. WACC is nothing but the cost. Weighted average cost of capital is nothing but the cost that I actually spend in raising every rupee. Here with this, guys. Now, the return that I should get out of my investment should at least be equal to my cost, correct? So in other words, can I say my cost is the minimum required rate of return, not the actual return. minimum required rate of return, correct? And hence we use KO as actually the base to calculate your discount rate, or we use KO as a discount rate to calculate all the NPV calculations in this particular chapter. So it's used as a discount rate. Clear with this, guys? Right? So this particular chapter is divided into two segments. So the third segment is already done, that is arriving at the discount rate, that is WACC. We already know that. So basically this chapter has only two segments. The first segment is, first you should calculate the cash flows for every year. There are certain rules. What are all the items you should consider? What are all the items you should ignore, and all of that. And number two, evaluate each of the alternate investment avenue using the different decision criteria. What are the different tools of capital budgeting available? How do you do that? This is what we'll be seeing in part number 2. So now the first part is estimating the cash flows. The second part is capital budgeting techniques. So now let's get started with the first part of this chapter, which is estimation of cash flows. Now, how do you estimate the cash flows? Basically, guys, in this particular chapter, right? So the capital budgeting considers only incremental cash flows, meaning what? If I go for this project because of this, if there is whatever cash inflow or outflow, only that needs to be considered. Makes sense, because you're going to take a decision. Clear with this, guys, right? So incremental cash flows from an investment likely to result due to acceptance of any project, that should only be considered. And one more important task is we are going to estimate future cash flows. So before we analyze how the cash flow is computed, the following items need some consideration. So when you are computing your cash flows, you need to have certain things in mind. Very important discussion here. The first one is about depreciation. Now, depreciation is a non-cash item. Do I actually pay depreciation? No. Clear with this. Hence, it will not affect my cash flow as such. However, we must consider the tax shield or the benefit from depreciation, as this will reduce your outflow, or in other words, it will increase your inflow. Clear with this, guys? Sir, what is this? I've given one example here. So this example I've taken only from the study material. Let's say X Limited manufactures electronic motors fitted in desert coolers. It has an annual turnover of 30 crores and cash expenses to generate this much amount of sale is going to be 25 crores. Suppose the available applicable tax rate is 30% and depreciation is 1.5 crores per annum. Now, the table below is showing the tax shield due to depreciation under two situations, which is with or without depreciation. Suppose I'm completely ignoring depreciation. What happens? Sale 30 minus COGS, my cost of goods sold is 25. I'm ending up with a profit of how much? 5 minus depreciation. I'm not subtracting here. So my profit before tax is 5 lakhs, correct? So, or 5 crores minus tax rate of 30%, 1.5. So you get how much? Profit after tax of 3.5 crores. So overall, you get a cash flow of 3.5 crores. Suppose what I'm doing, I'm charging my depreciation. So how do you do it? 30 minus 25, 5. Here I'm subtracting 1.5 crores. So what do you have? Your profit before tax is 3.5. Now on this 3.5, I'm applying 30%. So my tax amount is going to be how much? 1.05. You subtract 1.05 from 3.5. You are left with a profit after tax of how much? 2.45. Now depreciation, did I actually pay it? No, but I subtracted earlier. Hence I am adding it back once again here. So now the cash flow actually is going to be how much? 3.95. Now, if you notice, in the first situation, I completely ignored depreciation. In the second situation, the net effect was same. I subtracted earlier. Now I am adding back. But still, if you see, in the second situation, the cash flow is something more. It is more by how much? So 3.95 minus 3.5, it is more by 0.45 crores. How is it? Simple. Because I reduced my 1.5 here for the purpose of computing my EBT, that is my profit before tax. The base on which I compute my tax is only 3.5 crores, whereas the first situation I computed the tax on 5 crores. Or in other words, here in the second situation, I did not pay tax on this 1.5 crores, which is correct because it was allowed as a deduction. Clear with this, guys? So 1.5 crores on that into 0.3, if you do, you will exactly get how much? 0.45. So here, if you see, guys, in the second situation, which is the right method, what we did was there was a tax saving to the extent of 0.45. Here I paid 1.5, here I'm paying only 1.05. The difference between the two is 0.45. A reduction in your outflow will overall increase your inflow, and hence depreciation as such is not considered. However, the tax impact or the tax shield on depreciation is considered for all our calculations of this particular cash inflows. Clear with this, guys? That is the first learning here. Look at this. Being a non-cash expenditure, depreciation has been added back while calculating the cash flow. As we can see in the above table, that due to depreciation under the second scenario, a tax saving of 0.45, that's 1.5 minus 1.05 was made. This is called as tax shield, and tax shield is considered while estimating the cash flows. Here with this, guys, right? So that's about the first part of this particular discussion. Number 2, there is a concept called as opportunity cost. What do you mean by this? Opportunity cost needs to be considered for cash flow calculation. What is it? Let's say I have a piece of land. Now I am deciding whether to start a factory or not. Now, till now what I was doing, this piece of land was there. I was renting it as a car parking area. I was getting some money out of it. Suppose I'm going to start a factory. Now I need to consider all the cash flows of this particular factory, right? Investment and everything, inflow, outflow and all. Now, while at the time of considering the cash flows of, me starting a factory, now what I'm doing, because I'm going to start a factory now, what will I do? There is actually a loss of rent income that I'm going to receive. Correct? No, right? This loss of rent income is actually called as an opportunity cost because it is a benefit foregone. Now that should be considered for the purpose of arriving at the cash flows of me setting up a factory. Why? Because only because I'm setting up a factory, I'm losing this revenue. Had I not incorporated a factory here, I would have continued to receive some rental income. Since because of this decision, I'm losing out on this, it is relevant for the purpose of my decision making. Hence, opportunity costs are considered. Clear with this, guys? Next, sunk cost. What do you mean by sunk cost? Sunk cost are the costs already incurred. Whatever I've incurred in the past, now because I'm going for a particular decision or not, now it will definitely not impact my decision making. Hence, it should be excluded for the purpose of my capital budgeting analysis. Example, let us say I actually incurred some research fee, right? Let us say I incurred some research or technical fees, right? I wanted to, let us say, set up a factory in an outskirts area, right, from the city. Now, what I did, I hired a team and asked them, right, just go and see whether this place is good for the purpose of setting up a factory. They went and they came back and they reported me. Now, for this, I paid them 1 lakh rupee. Now, you tell me, I have already paid them. Whether I go for this particular project or I decide not to go for this project, now, can I save this 1 lakh? Absolutely not. It's already paid. Hence, it is irrelevant for all my calculation. That's called as a sunk cost. Clear with this, guys? The next one is your working capital. Now, working capital, there's a separate chapter called as working capital management, which we'll be seeing later on. Now, working capital, you remember that is always an investment. So, basically, what do you mean by a working capital? Investment in your non-current assets, that is current asset minus current liability. That's called as working capital. Now, it is not enough if I just invest in the non-current assets. Of course, when I'm starting my business, I also need to invest for my stocks and all that. So, there is also an investment in your working capital. Always remember, working capital will initially be treated as a cash outflow, and at the end of the life of the project, it will be treated as a cash inflow. We have done a lot of numerical problems relating to working capital in capital budgeting in our fast track as well as in our regular courses. But here, understand, I'm quickly recapitulating all those points. Revise this with your library of adjustments. It will be very easy for you, right? Now, in this case, what happens? Because I am actually investing this money right now, working capital. It is treated as a cash flow initially, but at the end of the life of the project, what happens is you receive back the working capital. Always working capital gets released at the end of the life of the project. So it will be treated as a cash inflow at the end of the life. Clear with this, guys? So here, what happens is, so it will be treated as initial working capital is an outflow, and at the end of the project, release should be treated as an inflow. As simple as that. Clear with this, guys? Next one. Additional capital investment. Now, capital investment, it is not necessary that it happens only at the beginning. Maybe after 3 years into the project, I'm requiring some extra funds. Then in this case also, whenever I'm making capital investment, it should be treated as an outflow. As simple as that. Now, moving on to the next discussion, block of asset concept and depreciation. This has something to do with your section 32. Read along with section 50 of your Income Tax Act, right? This has nothing to do with financial management, but since depreciation has a tax impact and all, tax is an outflow, and hence in this case we are studying it in FM. Clear with this, guys? Quickly I will walk you through. Now, what happens in your income tax provisions, right, what happens is generally depreciation is calculated using a concept called as block of asset model. What is it? Example: suppose A Limited acquired a new machinery for 1 lakh. The it is depreciable at 20% as per WDV method. The machine has an expected life of 5 years with a salvage value of 10,000 rupees at the end of the life. Now, the treatment of depreciation or the short-term capital loss in 50 year in two cases will be as follows. Now, what it is, we will be seeing. So the depreciation for the initial 4 years will be common. So we will just compute it. But what they are saying, the company has purchased an asset, 1 lakh rupees, depreciation rate 20% on WDV method, and 5 years is the life. At the end of the life, I'm selling it for how much? 10,000 rupees. Now, what will be the tax impact? Now, for the first 4 years, there is no problem. So 1 lakh, first year depreciation 20%, 20,000. So WDV at the end of year 1 is 80,000. So in year 2 depreciation will be 20% on 80,000. It's going to be 16,000. So the WDV at the end of year 2 is going to be 64,000. Year 3 depreciation will be calculated on 20% on 64,000. It's 12,800. So now the WDV at the end of year 3 is going to be 51,200. Now for the year 4, depreciation of 20% will be calculated on 51,200. So now it's going to be 10,240. So the WDV asset year 4 is going to be how much? 40,960. Or in other words, year 5 is when at the end of year 5 I'm selling the asset. Now opening balance at the beginning of year 5 is going to be how much? 40,960. Now what happens? Case number 1. Assume there is no other asset in the block. This is the only asset in the block. And let us say I'm selling it for how much? 10,000. You logically tell me I have an opening balance of 4960. Now I'm selling this asset. This is the only asset. Now this asset also is not there. Now you tell me, guys, will I provide for depreciation? Absolutely not. There will not be any depreciation. So your income tax provision says, how much did you sell it for? 10,000. And as per your calculation WDV, what is the cost? 40,960. The difference between the two, what is that? 30,960 rupees. That will be treated as a short-term capital loss. Clear with this, guys? And since there is a loss, there is a tax benefit on that. So 30% on 30,960. So 9288 is going to be your amount of tax benefit that you get. So this will be treated as a cash inflow. Clear with this, guys? Why inflow? Because you have a tax savings here. Clear with this, guys? Now, the same situation, suppose this is not the only asset, but there is more than one asset in your block. In this case, what will happen? Simple. So now, there are more than one assets, right? Opening WDV is how much? 40,960. I am only selling one asset for how much? 10,000. So what is the closing WDV? 30,960 rupees. There are other assets in the block. Yes, continue charging depreciation. 20% on 30,960 comes out to how much? 6192. So now this is the depreciation amount. On this depreciation, I have a tax saving at the rate of 30%. So 30% on 6192 comes out to 1858. So this will ideally be a cash inflow for me. Or in other words, this is a tax saving for me. Are you all understanding it? So now when you have a block of asset concept, you should see whether this is the only asset in the block or not. If it is the only asset in the block, in that case, your income tax provision says you can't provide for depreciation. Go to capital gains area. So if there is a gain, you will be paying tax. If there is a loss, you will be saving tax. In other case, what happens here? If the block continues to exist, continue to provide for your depreciation. Clear with this, guys? Now there is one more situation here. Suppose in the above situation, right, the sale value of the machine is 50,000. Right? And let's go for case 2. Case 2 is what? The block of the asset continues to exist. That is, there are some other assets in the block. Now you tell me, what is my opening WDV? So opening WDV is 40,960. Out of this, now I'm selling the asset for how much? 50,000 rupees. Now you tell me, if I continue to provide depreciation, I will be having a negative WDV. On that, I should provide depreciation. Can I have a negative WDV? Absolutely not. So in case where the block continues to exist, however, the sale value is greater than the WDV value, in that case, your income tax provision says, no, you go to your capital gains area and compute capital gains. Do not provide for depreciation. In this case, what happens? I've sold it for 50,000, but my cost is only 4960. What's my gain? 9040. On that, provide for 30%. So 2712 rupees is going to be the tax outflow for you as short-term capital gains. Clear with this, guys? All these are your income tax provisions, nothing related to FM, but still, since they are very much affecting your cash flows, we are just having a look at it here. Clear with this, guys? As simple as that. The next one, exclusion of financing cost principle, very important. Now, what is it? Example, I told you, recall NPV calculation. Every year cash flows divided by your discount rate, that is 1 plus r to the power n. Only then I will discount my cash flows, correct? Now, what I'm doing is I am taking my cash flow, right, divided by 1 plus r the whole power n, and r is nothing but your discount rate, correct? That is nothing but your KO, I told you. Now, while calculating KO, right, so basically what you would have done, you would have considered your KE, you have considered your KD, you have considered your KP, everything put together is only your KO, correct? No. Yes. Now, all the finance related costs are already considered in your denominator. Once again, do not consider that in your numerator cash flow calculation. That's why we say this is exclusion of financing cost principle. When the cash flows relating to long-term funds are being defined, financing costs of long-term funds, right, that is both your debt, equity, dividend, preference dividend, everything should be excluded, because the interest and dividend payments are reflected in the denominator WACC calculation. Hence, if the interest and if all the financing costs are deducted in the cash flow itself in the numerator, then what will happen is you are counting it twice. Clear with this, guys? The exclusion of financing cost principle means the interest on long-term debt is ignored, as well as the expected dividend are deemed irrelevant for my cash flow analysis. Clear with this, guys? Do not consider it in the numerator. It is all considered in your denominator. Clear with this, guys? And all your cash inflows, that is cash inflow, outflow, these are all considered after adjusting for taxes. That's why we saw the depreciation adjustment and all of that. Clear with this, guys? Why? Because the numerator KO is also calculated after adjusting for taxes. One of the components of KO is KD. KD is what we saw, I into 1 minus tax plus RV minus NP by N the whole by RV plus NP by 2. The formula and all we saw that we consider taxes. Denominator is also post-tax. Numerator will also have post-tax only. Clear with this, guys? So now finally, every year, whatever is the cash flow, it's called as cash flow after tax. That is the cash inflow. It's called as CF80. How will you arrive at it? Very simple. Sales minus variable cost gives you contribution minus fixed cost. In fixed cost, you have cash fixed cost, that is actual amount that you pay, minus depreciation. Clear with this, guys? If you subtract the two, ideally this is called as EBIT, right? But now you remember, we are not going to subtract any kind of finance related cost. So this itself is going to be your EBIT. From that you subtract your taxes, you will arrive at your EAT. Now wait, I subtracted depreciation earlier, but this actually is not an outflow. Add it back here once again to nullify the effect. You will get your CF80. Sir, why sir I subtracted and then added back? If I can ignore rather, no, because I subtracted here, the base on which I'm computing the tax is reduced, right? So this reduces my tax liability. After arriving at the tax figure, once again, I'm adding it back so that now depreciation as such is not considered. However, its presence will have a tax impact that is being properly considered. So now what you need to do is arrive at the EAT, add back the depreciation. Whatever amount that you get is called as your cash flow annual tax. And this CF80 is the figure that you consider for all your calculations in this particular chapter. Clear with this, guys? Now, let's move on to the capital budgeting tools and techniques. That's the part B of this particular chapter. This entire chapter deals in all your capital budgeting tools and techniques. Sir, I arrived at my cash flows and I also have the discount rate. Now, sir, with this, how do I evaluate where I should park my money? Which investments I should park my money? Now, look at this. There are broadly two different types of tools. One is called as a traditional or a non-discounting tools. The other one is called as your time-adjusted or your discounted cash flow models. Now, the first method, traditional or non-discounting methods, they actually ignore the concept of time value of money. Under that, you have only two things. One is called as a payback period. The other one is called as an accounting rate of return, right? On the right side of the chart, you have your present value methods, that is time adjusted methods, popularly called as your net present value, profitability index, IRR, discounted payback period, and MIRR, modified internal rate of return. Quickly, we will see what each and every one of these models will have to say. First one, let's take the traditional or non-discounting models. They ignore what concept of time value of money, right? First one, payback period. What do you mean by payback period? The time taken to recover my initial cash outflow. Simple. Let's go and look at the calculation here. With the help of an example, we will quickly revise this area. Now, example number 3. Look at this. Suppose a project costs rupees 20 lakhs. Suppose a project costs rupees 20 lakhs and yields annually a profit of 3 lakhs after a depreciation of 12.5% on SLM method, but before tax of 50%. Now, first, what will I do? They have given profit. Now, we only take cash flows. What will I do? Profit before tax, 3 lakh minus tax is going to be your 50 percentage. You will get your profit after tax. Now I had subtracted depreciation, only arrived at this PBT. Add back the depreciation. How much is depreciation? 12.5 percentage on 20 lakhs, right? That gives you how much? That gives you 2.5 lakh. Add it back, you get a CF80 of how much? 4 lakh rupees. So every year I am getting 4 lakhs. Now I invested how much? 20 lakhs. So I invested 20 lakhs. Every year I'm going to get a cash inflow of how much? 4 lakh. So how long will it take for me to recover back my entire investment? Simple, 20 lakhs divided by 4 lakhs. So you'll get 5 years. So it will take 5 years for me to recover back or pay back my entire investment. That's called as the payback period. Clear with this, guys? And in this case, we saw that the cash flows were uniform, direct formula. So what is the formula here? Cash outflow, your cash outflow divided by your initial investment divided by expected CF80 every year. Clear with this, guys? But sir, in case, sir, there is no need for me to have a same or an equal amount of cash flow every year. No, sir. In this case, what will I do? Very simple. In this case, what you can do is, there is the second way of doing it. Suppose the same company XYZ Limited is analyzing a project that requires a cash outlay of 2 lakh rupees. Investment is 2 lakh. And it is expected to generate the cash inflows as follows. At the end of year 1, it is expecting to generate 80,000. Year 2, CF80 60,000. Year 3, 60,000. Year 4, it's going to be 20,000. Right? In this case, how will you compute your payback period? Sir, when will I get back my initial investment? Simple. You need to have this particular format to calculate this. How will you do that? First, the payback period shall be computed. The payback period shall be computed by using cumulative cash flows, which is as follows. Year 1, 2, 3, 4. So arrive at the cash flows. You just put it, copy paste. At the end of year 1, how much have I generated till now? 80,000. At the end of year 2, 80,000 plus 60,000 comes out to 1,40,000. At the end of year 3, so 80 plus 60 plus 60, till now I have recovered how much? 2 lakhs. And at the end of year 4, how much is that? So 80 plus 60 plus 60 plus another 20,000, that comes out to 2,20,000. Now, if you notice, what was my initial investment? 2 lakh rupees. When did I recover it? So I recovered it at the end of year 3. Hence, 3 years is going to be your payback period. Clear with this? As simple as that, nothing great here. Now, suppose in our above example, instead of 2 lakh rupees, the initial investment was 2,05,000. Now, in this case, what will you do? You clearly know that the payback period happens after the 3rd year, but before the 4th year. How? Because if you notice, at the end of 3rd year, I would have recovered how much? 2 lakh. But I invested how much? 2,05,000. So then, sir, let me wait till the end of 4th year. At the end of 4th year, I would have recovered how much? 2,20,000. So somewhere it happens during the 4th year. It is 3 years plus some few months. How is it? How will you compute? Very simple. Very simple. So now you know that in the 4th year, right, you generate a cash flow of how much? 20,000. Right? So 20,000 is the cash flow that I generate during the entire year. But how long will it take for me to recover how much? 5,000 rupees. So it's going to be 5,000 by 20,000. How much is it? 1/4 of a year. So actually my payback period is going to be 3¼ years or 3¼ years time. Clear with this, guys? So if 20,000 rupees, right, can be recovered in 1 year. Clear with this? If this can be recovered in 1 year, how long will it take to recover by 5,000? So 5,000 into 1 by 20,000. That's why 5,000 by 20,000. You get 1/4 of a year or 0.25 years. So I will say overall my payback period is 3.25 years. Clear with this, guys? I'll get back my investment in 3.25 years. And here we assume that the cash flows, this 20,000 rupees, is evenly accruing during the course of the year. Clear with this, guys? Very, very simple. Next one. There's something called as payback reciprocal, which gets computed. How will you compute it? Simple. Average annual cash flows. Every year what you receive, average annual cash flow divided by initial investment. That is an example. Suppose a project requires an initial investment of 20,000 and it would give an annual cash flow of 4,000. The useful life would be 10 years, right? So now in this case, the payback reciprocal is how much? On an average, every year I get an inflow of 4,000. What is the initial investment? 20,000. So 4 upon 20 into 100, you get how much? 20%. So on an average, you can say that, okay, so this project is giving me a return of 20%. Not an exact figure, just for calculations. That's all. The above payback reciprocal provides a reasonable approximation to IRR method. That is, don't say this is an alternative to IRR. IRR, what is the formula to calculate? There is no formula. It should always be done using trial and error method. So now, sir, which trial to take? How will I take? Maybe first you can compute the payback reciprocal, right? You will at least have an idea. Okay, so my IRR revolves around this area. Based on that, you can take 2 trials and do the interpolation. Clear with this, guys? For that purpose, only you have this. Next one. The second method under the non-discounted technique is called as ARR. ARR stands for what? Accounting rate of return. How will you compute ARR? So this is actually an accounting way of computing. Here you don't consider the cash flows, you consider only the accounting profit. Directly, let's go to the example. There are 3 methods or versions using which you can compute your ARR. What is it? We will quickly be recapitulating with the help of this particular example number 6. Now, suppose Times Limited is going to invest in a project with a sum of 3 lakh rupees having a lifespan of 3 years, right? The salvage value of the machine is 90,000. The profit before depreciation for each year is, let us say, 1,50,000. So the profit after tax, right? And the value of investment, the beginning and the end of each year will be as follows. Now, every year, what's going to be my profit before depreciation? 1,50,000 each. Every year, depreciation is going to be how much? It's going to be 70,000. It's going to be how much? 70,000. How did you arrive at the 70,000? Initial investment, 3 lakh. Salvage value is how much? 90,000. Subtract the 2, you get 2,10,000, 2.1 lakh. Right, the life is going to be 3 years. You get how much? Every year it's going to be 70,000 rupees of depreciation, right? So now your profit before tax minus depreciation, you get what? You will get your profit after depreciation. Every year the profit after depreciation comes out to 80,000 rupees. Now what was the value of investment? It's like a WDV computation. At the beginning there was 3 lakh rupees minus depreciation. The closing value at the end of year 1 is going to be 2,30,000. That becomes the opening for the next year minus 70,000, 1,60,000. You get the closing value of second year. That becomes the opening for third year minus another 70,000, gives you how much? 90,000 is the closing value at the end of year 3. Now, how will you compute ARR in this case? This has nothing to do with your finance, but this is something to do with your accounts area. So now that's why they consider profits, not your cash flows. Now, first, you can calculate this on an annual basis. Annual basis, what will you do? Take the annual profit after depreciation, right, divided by the opening value of investment of the respective year. That is, for the first year, it's going to be 80,000 divided by 3 lakh. It's going to be how much? 26.67%. Second year, 80,000 by 2,30,000. That year's opening investment, 34.78. The next one, 80,000 divided by 1,60,000, you get 50%. So you get 3 ARRs, guys, correct? Right? So now take a simple average of the 3. So take these 3 and divide it by, add it up and divide it by 3. You get an average accounting rate of return. So this is one way of calculating your ARR. That's going to be 37.15%. There is another way of calculating ARR. Simple. What you do is take all your annual the profits, take all your annual profits, right? How much is it? 80,000, 80,000, 80,000. So take an average of your total annual profits. So 80 plus 80 plus 80 by 3, you get how much? Average annual profit, that is 80,000, divided by, take the initial investment of 3 lakh. This is the second way of calculating it. Average annual profit divided by initial investment. That's going to be 80 plus 80 plus 80, the whole by 3. In this case, it comes out to 80 only, divided by 3 lakhs. How much is it into 100? It's going to be 26.67%. This is going to be another way of calculating. Or the third method is same as the second method, but in the numerator we took average annual profit. In the denominator you take average investment. What do you mean by average investment? Opening plus closing by 2. So overall, what is the opening investment? 3 lakh. What is the closing investment? It's going to be 90,000. So 3 lakh plus 90,000 divided by 2. That's going to be coming in your denominator. So numerator continues to be the same. 80 plus 80 plus 80 by 3. Right? Denominator you will be having the average investment. Clear with this, guys? Right? So now that's what this method says. So here average investment is how much? Average investment is going to be 3 lakh plus 90,000 by 2. It's going to be 1,95,000. Numerator is going to be 80,000. 80,000 divided by 1,95,000 into 100. You get a figure of 41.03%. This is a third method of calculating your ARR. So which one should I follow in exam? You can follow any one of the 3 methods in case nothing is mentioned in the question. Clear with this, guys? Now for you to compute your average investment, there is one more formula. It is half of initial investment minus salvage value plus a full salvage value. Now nothing great here, guys. Now, this is nothing but, can I say, half of initial investment minus half of salvage value. If I'm writing this down, can I say this is half of initial investment minus half of salvage value plus one full salvage value? Correct? No? Right? So, can I say salvage value minus half of salvage value is plus half of salvage value? 1 minus half is half. So, can I rewrite this as 1 by 2 into initial investment, right, plus 1 by 2 into salvage value? How did we get this 1 by 2 into salvage value? Salvage value minus half of salvage value is equal to half of salvage value. Clear with this, guys? Or this is nothing but half of initial investment plus salvage value only. Or in other words, this is what we initially itself computed. No, this is what we originally calculated. That is nothing but opening plus closing by 2. I told you that is exactly the same formula, but they have mentioned it differently. 1 by 2 into initial investment minus salvage value that they have done, plus add salvage value. This is nothing but your opening plus closing by 2. That way also you can do it. Clear with this, guys? Now, suppose in the question they have given some additional working capital and all is required. That is also treated as a part of your investment, guys. Correct? So in the denominator, that should also be computed. So for example, suppose a sum of 45,000 is required as an additional working capital during the project. What will you do? Apart from your opening plus closing by 2 calculation, add this 45,000 also in your denominator. So earlier the average investment was 1,95,000. Now add 45,000 to this. The denominator will become 2,40,000. Based on that, you compute your ARR is going to be 33%. Here with this, guys, some basic level of calculation, but still I wanted to touch upon all these areas once again. Clear with this, guys? With this, we have completed both your the payback period as well as your your ARR. These two are the techniques that we use under the non-discounted methods. Fine. So now let's move on to the discounted techniques of capital budgeting. Now, under the discounting techniques, right? So we have certain methods like your NPV, IRR, your discounted payback period, and all of that. Now, let us revise every single one of this one by one. So now, the first one under discussion is going to be the NPV, the net present value, right? So this NPV, yes, it is actually a technique under the discounted cash flow method, right? And it is used as a method. I mean, this method uses a specific discount rate to bring all the subsequent cash inflows after the initial investment to their present value. And what is the discount rate we use? I told you it's nothing but your KO, the cost of capital, right? So KO is used because every single rupee that you're actually investing in the business should have been raised somewhere. And of course, when you raise the money, it had a cost. That cost is nothing but your KO. And KO is the minimum required rate of return, not the actual return. It is a minimum required rate of return because I should minimum at least recover my cost. So the cost is pegged as the minimum required rate of return. So that will be taken as a base to actually discount all your cash flows, right? So the net present value of the project is the amount in current value, right, of the amount the investment earns after paying the cost of capital in each method. Or in other words, your NPV is nothing but your present value of cash inflows minus present value of cash outflows. So you have inflows over the life of the asset of the project. So 1, 2, 3, 4 until n, right? Discount everything using the discount rate as your KO, right? So arrive at the present value of cash inflows. From that, subtract your initial investment. That's your present value of cash outflow. Whatever you get is your NPV. And guys, what is the decision criteria here? So if the NPV is greater than 0, you accept the proposal. If it is less than 0, you will reject the proposal. If it is exactly 0, then you can either accept or reject it. Ideally speaking, there is no point in going for the project because in today's value, you are not going to get any benefit. Clear with this, guys? So here it actually, this equal to symbol should not be there. If it's greater than 0, go for it. Less than 0, reject it. At 0, you're indifferent. You can either go or you can either accept or you can reject it, right? Now, let's quickly do one numerical problem, one simple numerical problem with respect to the concept of NPV. So literally, guys, in this marathon itself, so I am actually covering the concepts then and there, wherever possible, we'll be doing some sums just to set the context right. That's about it. Now look at this question number 3. See, I'm taking a simple sum and explaining the concept of NPV. In our classes, we have done in detail the complicated sums and all of that, which you can revise. Now, quickly. Now compute the net present value for a project with a net investment of 1 lakh rupee and the net cash flows for the year 1 is 55,000. For year 2, it is 80,000 and for year 3, it is 15,000. Further, the company's cost of capital is 10%. The PV factor for 3 years, each year is given as follows. Simple. So now what you need to do, what do you mean by NPV? It is the present value of cash inflow minus the present value of cash outflow, right? So now the first year I have year 0, today itself, I have an outflow of how much? 1 lakh rupees, right? Followed by each of the 3 years, I have an inflow 55,000, 80,000 and 15,000. Now, can I add all these things together? No. Why? It defies the concept of time value of money. That is, your cash flows arising at different time horizons or at different time period cannot be addable, are not comparable assets. So what you need to do, bring everything into the present value. How will you do that? Using your present value interest factor. Now, what will I do? So year 0 is already in present value, multiply it in 1. So the present value factor for 10 years at the rate of year 1 is 0.909, right? And year 2, 0.826, year 3 is going to be 0.751. So multiply the respective cash flow with the respective present value factors. So this is what you get if you add up everything. So minus 1 lakh plus 49,995 plus 66,080 plus 11,265. If you do it, you will arrive at the final net present value of 27,340. Here with this, guys. So if you do this, this is the present value. Now you net present value. Now you tell me, can you go for this project or not? Yes, since the NPV is greater than 0, this proposal can be accepted. Since the NPV is positive, the company should accept the project. Had it been in negative, you will definitely not go for the project. Clear with this, guys. This is a very simple question to actually explain the concept of NPV. Now, if it is being loaded with facts and all, in that case, automatically you should read the question and accordingly pick the right figures at the right time. That is the right period. And accordingly you should discount the cash flows. Clear with this, guys. And we have seen the depreciation adjustment and all of that. In case some talks about all this, that also needs to be considered here. Clear with this, guys. Since this being a marathon, I'm revising all the core areas wherever possible. Here also we are doing the numerical problems, as simple as that. Clear with this, guys. Next one. The next one is called as profitability index. It is also known as desirability factor or the present value index method. Now, profitability index, what is the formula? Simple, guys. NPV formula was what? Present value of cash inflow minus present value of cash outflow. Here, the formula is present value of cash inflow divided by present value of cash outflow. Clear with this, guys. So, present value of cash inflow divided by present value of cash outflow. Clear with this, guys. Right? So, you need to arrive at the present value and you just need to take the numerator as present value of cash inflow, denominator as present value of cash outflow. Now, what is the decision criteria? Simple. If your inflow is greater than outflow in present value terms, then it will be greater than 1, no? Right? So if it is greater than 1, obviously you will accept the proposal. If it is lesser than 1, you should reject the proposal. When will it be lesser than 1? When the denominator is more than the numerator. Denominator is what? Outflow. If your outflow is greater than inflow, ideally your NPV will be negative, right? That is a situation. So when your NPV is negative, your PI will be less than 1. When your NPV is positive, your PI will be greater than 1. So you can accept if your PI is greater than 1 because that's when your NPV will be positive. You should reject when your PI is less than 1 because that is the point when your NPV will be negative. Clear with this, guys? Yes. And suppose they are saying between two projects or between two machines, you need to choose one. Go for the one which has a highest profitability index. As simple as that. Very, very direct calculation. Clear with this, guys? Yes. Now, let's move on to the next concept of IRR. Now, IRR is a concept which we have already done, but nevertheless, I will just pick one small example, and with that particular question, we will be, covering this aspect also, the IRR also in the marathon, right? So now, this IRR basically, what is it? The rate at which the present value of cash inflow is equal to the present value of cash outflow, or in other words, it is the rate that makes my NPV as equal to 0. Or in other words, IRR represents the actual return that you get out of the project. Clear with this, guys? So then what is KO, sir? KO is not the actual return. It is a cost. It is a minimum required rate of return. It is not the actual return. Clear with this, guys? At least you should earn that much return. Are you all understanding this? But IRR represents the actual return that you get out of the project. Now, sir, I arrived at IRR. With this, what decision will I do, sir? Very simple. Compare this IRR with your KO, because IRR is the actual return. KO stands for the cost. If your IRR is greater than your KO, in that case, you will go for the project. If your IRR is less than KO, definitely you should not go for the project. Why? Because every rupee I raised, I am paying, let us say, KO is 12%. and now I'm investing it in a project, the IRR of the project comes out to 15%. Now my return is greater than my cost, I will go for it. Suppose IRR out of the investment is only 10%, so I incur a cost of 12% to raise the funds, but when I'm investing, I'm getting only 10%. Then what is it? Definitely you should not go for it. Are you clear with this? So ideally, IRR on the investment side need to be compared with the KO, and if your IRR is greater than KO, go for the proposal. If it is less than KO, definitely you should reject the proposal. Clear with this, guys? This is what you are saying here. IRR is greater than the cutoff rate of WACC, accept it. If it is less than your cutoff rate or the WACC, you need to reject it. Clear with this, guys? Now let's quickly go through one numerical problem in this regard. Now let's take this question number 11. Okay, it's on page number 135. A company proposes to install machine involving a capital cost of 3,60,000. The life of the machine is 5 years and its salvage value at the end of life is nil. The machine will produce the net operating income after depreciation of 68,000 rupees per annum, and the company's tax rate is 45%. The net present value factors for 5 years are as under. So 14%, 15%, 16%, 17%, 18% discount rate. Cumulative factor is given, which means what? Present value annuity factor table is given as follows. You are required to compute the IRR of the proposal. Now, what will you do? The first step is to calculate the CFAT for every year. Now, annual CFAT, how much is it? Now, they have given net operating income after depreciation is how much? 68,000. That is nothing but your earnings before tax, right? Minus your taxes. Taxes how much? 45%. If you subtract, you will arrive at the profit after tax. Now, what should you do? Add back the depreciation. Now, depreciation, how much is it? So 3,60,000 minus salvage value nil divided by 5 years. So now 3,60,000 divided by 5 gives you how much? 72,000 rupees. Add back the 72,000. So your annual cash flow after tax CFAT is going to be how much? 1,09,500. But this amount you will be receiving for the next 5 years. Clear with this? So equal cash flows, which means you can use your annuity factor table and all. That's the reason annuity factors are given. Now, how do you compute IRR? Now, at IRR, NPV is equal to 0, right? And what do you mean by NPV? Present value of cash inflow minus present value of cash outflow. So, which means my NPV will be how much? At present, how much is my initial outflow? It's going to be 3,60,000. That's correct, right? And what is the annual cash flow after tax? 1,09,400. So, can I say NPV is equal to 1,09,400? That is the amount I receive inflow for every year, into present value interest factor of annuity of X percentage that needs to be calculated for 5 years minus 3,60,000. That is nothing but your present value of cash outflow. Correct? So now you can take this to the other side. So you can say 3,60,000 is equal to 109,400 into present value interest factor annuity of X% 5 years, or ideally this present value annuity factor is going to be equal to 3,60,000 divided by 1,09,400. You get an answer of how much? 3.2906. Why do we do this? Because in the sum they have given on table, no, this sum they have given the values and all. Now you will see this 3.2906. Where does it lie? 3.2906. Where does it lie? It clearly lies between 15% and 16%. Correct? No, 3.29 something. So lies between 15% and 16%. So this way you can identify the correct trials for you. Clear? So because IRR, there is no formula to calculate only. You only have to do it under trial and error method. So what will I do? First, I will take a 15%, or you can also take 16%. You will take 1%, arrive at an NPV. You will either get a positive or a negative, right? Then you take another trial and arrive at the NPV. You will get once again a negative or a positive figure. So one positive, one negative figure. You do the interpolation, arrive at the correct amount of IRR. Now let's quickly do this. So now this 3.2905 lies between 15% and 16%. We can identify this. Clear, guys? Yes. So now once we do that, so let R be equal to 15%. In this case, how will you arrive at it? So 1,09,400, 15%. This is going to be the present value anti-factor into 3.35. Right, that's going to be the present value of cash inflow minus your 3,60,000 present value of cash outflow. If you do it, you get a positive This is 6490. Clear with this, guys? Now at your IRR level, your NPV should be equal to 0. So is 15% your IRR? No. Why? Had it been my IRR, this figure would have been 0. So which means what? You need to take the next trial. Take the next trial as 16%. So here it's going to be 1,09,400 into, so what is the table value here? 3.27. So multiply it with 3.27, you get the present value of cash inflow minus 3,60,000 present value of cash outflow. You get a negative figure of minus 2262. Clear with this, guys? So now what will you do? You have a positive value, you have a negative value, and exactly at IRR, your NPV will be equal to 0. So use your intraporation technique. That's nothing but your lower rate 15% plus NPV at the lower rate, that is 6490, divided by NPV at lower rate 6490 minus NPV at the higher rate, that is minus 2262. So minus of minus 2262 into the difference between higher rate and lower rate, 16 minus 15. This is actually a logical way of arriving at IRR, which we have actually seen in our time value of money techniques also. This logic we have seen there. So basically, if you arrive at it, you will get an IRR of 15.7415%. Clear with this, guys? So my IRR is going to be equal to 15.7415%. Clear with this, guys? As simple as that. It's pretty much straightforward and a direct calculation. Clear with this, guys? That's about your IRR calculation. The next one, discounted payback period method. Now, this is similar to your payback period method. What do you mean by payback period? So the time it takes for me to recover back my initial investment. But there what you do, your cash inflows, you directly take it without discounting. Here, if you consider the discounting factor and arrive at the discounted cash flows to do the computation, it is called as discounted payback period. Clear with this, guys? We will understand this with the help of an example. For example, a 30,000 rupee cash outlay for a project with an annual cash inflow of 6,000 rupees would have a payback period of how many years? I invested 30,000. Every year I get an inflow of how much? 6,000 rupees. So which means if you didn't consider your discounting factors and all, if you're just doing a normal payback period calculation, so what will be your payback period? So 30,000 divided by 6,000, it comes out to 5 years. So you'll get back your investment in a span of 5 years. Clear with this, guys? The problem with payback period is that it ignores the concept of time value of money. In order to correct this, we can use the discounted cash flows in calculating the payback period. Referring back to our example, if we discount the cash flows at 15%, let's say it's given in the question KO is 15%, then in that case, what will you do? You will arrive at the respective cash flows and multiply it with the PV factor of 15%. Now you will arrive at what? The present value cash flows. Now using this, arrive at the cumulative PV. This is what we do know earlier also. If you have an unequal cash flows, what will you do? You will arrive at a cumulative cash flow and then you will compare it. So at the end of year 1, you would have got in present value, you would have got 5220. At the end of year 2, 5220 plus 4536, you get 9756. At the end of year 3, so 9756 plus that third year's cash flow, 3948, you get 13,704, and you can just keep on accumulating till the end of the 10th year. Now if you see, when will you recover back your initial investment of 30,000? Almost at the end of 10th year or between 9th and 10th year. Clear with this, guys? So if you see, if you go with a normal payback period, it says you'll get back your investment in just 5 years. But if you do the discounted payback period, only then you will realize in today's value, literally speaking, I will recover back my investment only after 10 years. Clear with this, guys? So this is what is mentioned here. Therefore, our discounted payback period is approximately 10 years as opposed to 5 years under the simple payback period. Clear with this, guys? Yes, and that's about this concept called as discounted payback period. The next one, you have a concept called as MIRR. So modified internal rate of return. Now, what is this concept of MIRR? First, why do you need to have it? Basically, guys, IRR, the internal rate of return, it has some inherent limitations. What are those inherent limitations? We will be seeing in a few minutes from now. But before that, in order to avoid those limitations, drawbacks of IRR, you can slightly modify the IRR called as MIRR, modified internal rate of return. How do you compute the MIRR? Do not worry, we will do this with the help of a numerical example. So we will do the example, we'll do a particular problem right now. With the help of the problem, we will quickly revise the concept of MIRR. Now, let's take the question. One second. Yes. Now, let's take this question number 14. Now, an investment of 1,36,000 rupees yields the following cash inflows, that is profit before depreciation after tax. right? Determine the MIRR considering 8% as cost of capital. So what are all the cash flows the company is generating at the end of year 1, 30,000, at the end of year 2, 40,000, at the end of year 3, 60,000, at the end of year 4, 30,000, at the end of year 5, it's 20,000. They have added up the total. It's not relevant because you can't add up cash flows arising at different intervals. Now they are asking you to arrive at MIRR. Now guys, there is a way in which you need to do MIRR calculation. Now first thing that you need to do is what? They have given in the question respective years cash flows. It is given. Now what you need to do is year wise you put year 1, 2, 3, 4, 5. Respective years cash flow you put. Now what we need to do is convert all these cash flows into terminal value. Sir, what is the meaning of that? What is the life of the project? 5 years. Now 30,000 rupees is the value at the end of year 1. What will be its value at the end of year 5? You need to use the compound interest formula. So if 30,000 is the value at the end of year 1, what will be the value at the end of year 5? That is, how many years is the time gap? I'm already at the end of year 1. I'm not in year 0. I'm year 1. So which means 2, 3, 4 and 5. So you need to compound it for 4 years, correct? Using what rate? You need to use 8% as the discount rate. So now if you compound it, can I say the compounding factor will be what? 1 plus r the whole power n. R is 8% here. So it is 1.08 to the power 4. Clear? No? Why to the power 4? I am already at the end of year 1. Right? So now it will compound for 4 more years and only then I will arrive at the value at the end of year 5. Guys, correct? So here 30,000 at the end of year 1. So now multiply it with compounding factor of 8% for 4 years. It's going to be 1.08 into, right, is equal to, once you click on the calculator, one more is equal to, so you get 3 years and one more is equal to 4 years. You get what? 1.360488 something rounded off to 1.3605, right? So 30,000 into 1.3605, you'll get how much? 40,815. What is the meaning of that? 30,000 rupees received at the end of year 1 is equivalent to 40,815 rupees received at the end of year 5. Clear with this, guys? I am converting for first year cash flow into fifth year cash flow, terminal cash flow. Terminal means what? End of the project. Similarly, at the end of second year, I am receiving 40,000 rupees. Now, what will I do? Now, I will compound it for how many more years? I'm already at the end of year 2. I need to reach year 5. So what will I do? Year 3, year 4, year 5. I will compound it for 3 more years. So here 1.08 to the power 3. If you do it, you will get how much? 1.2597. So 40,000 into 1.2597 gives you 50,388. Or in other words, the value of 40,000 rupees at the end of year 2 is equivalent to 50,388 rupees received at the end of year 5. Clear with this, guys? Similarly, at the end of year 3, I'm receiving 60,000. Now, I'm already at the end of year 3. Only for 2 more years, I will have to compound it. 1.08 to the power 2. That gives you 1.664. Right? So 60,000 to 1.664 gives you how much? 69,984. Clear with this, guys? Next, fourth year, at the end of fourth year, I'm going to receive how much? 30,000. I'm already at the end of year 4. I need to arrive at the fifth year's cash flow. How will I do it? Only 1 year I need to compound into 1.08 to the power 1, which is 1.08. So 30,000 to 1.08 gives you how much? 32,400. And fifth year, at the end of fifth year, I'm receiving 20,000. It is already the value at the end of fifth year only. So multiply it with 1, you will get 20,000 rupees. Now add all the components here. 4815 plus 5388 plus 69,984 plus 32,400 plus 20,000. You get how much? You get how much? 2,13,587. What is the meaning of this? Right? The cash flows received, 30,000 received at the end of year 1, plus 40,000 received at the end of year 2, plus 60,000 received at the end of year 3, plus 30,000 received at the end of year 4, plus 20,000 received at the end of year 5. There are cash flows arising at the end of, at the end of each of the 5 years. I am converting everything into a future value, and I'm saying cash flows, these cash flows received across the 5 years is equivalent to receiving a single cash flow of 2,13,587 at the end of fifth year. Clear with this, guys? Right? So we are converting everything into a future value. So now we have this figure. This is the terminal value. This is nothing but or the future values of all the cash flows that has arisen during the course of the particular project. Here with this, guys. Now what will I do? IRR is the rate at which my present value of cash inflow is equal to present value of cash outflow. Correct. In this case, what is my outflow? 1,36,000. So 1,36,000 is equal to, can I say the present value of 2,13,587, because 2,13,587 is the value at the end of year 5. So can I say here present value is equal to future value divided by 1 plus r the whole power n? Is correct? No. Here what is the present value? It's 1,36,000. So this has to be equal to 2,13,587 divided by 1 plus r the whole power 5, and the rate that equates my present value of inflow with my present value of cash outflow is called as IRR, right? But here I converted everything into a future value and I'm doing it, hence the rate that equates it to is called as modified IRR. As simple as that. Clear with this, guys? Now in this case, what will you do? Very simple, very simple. So this is actually the equation that you will arrive at. So 1 plus r the whole power 5 is equal to 2,13,587 divided by your 1,36,000. That is, there is a cross multiplication here. So 2,13,587 divided by 1,36,000 gives you how much? So it gives you 1.57049264. It just keeps on going here, right? So 1 plus r the whole power 5 gives you 1.57049. So or 1 plus r is equal to 1.57049 to the power 1 by 5. Correct? So here to the power 5, if it goes to the other side, it becomes to the power 1 by 5. Guys, correct? Right? 1 by 5 is nothing but 0.2. Generally, this value will be given in the question. So R is equal to 9%. Clear with this, guys? Now, in this case, what we did, so we didn't take the respective year's cash flow, arrived at the present value, and we didn't take two trials and did interpolation. No. What we did, the respective year's cash flow, we converted it into a future cash flow, that is the terminal value, and the rate that equates the single figure of terminal value with my present value of outflow. That rate is called as MIRR, modified internal rate of return. Clear with this, guys? Sir, why are we doing all this? Wait, I will tell you the limitations of IRR. When we see that, we will get started. Now, when you understand the limitations of IRR, now you will understand why this MIRR calculations like this and how it overcomes those limitations. Clear with this, guys? You will get crystal clear clarity about that. Are you all able to understand this? Yes. So with this, we have actually seen how to compute MIRR and all of that. Now, let's move on to the next discussion here. Yes. The next discussion here is what? Some issues in IRR. By the way, guys, the decision rule for MIRR is same as that of IRR. That is, you arrive at the MIRR if it is greater than your cost of capital, you will go with the project. If it is less than your cost of capital, you will not go for the project. Clear with this, guys? Right? MIRR is nothing but IRR only, but it is a modified IRR. That's about it. Now, what has happened here? There are some issues in IRR. What are they? Now, let me just take an example and show you. Let's say there are two projects A and B, right? Project A has an initial outflow of 1 lakh, but at the end of year 1, you get how much? 1,50,000, right? Now they have done the calculation and said IRR is equal to 50%. They have done it. Do not worry about calculation. Here the entire stress or the focus is on the issue that we have in IRR. And NPV taking a discount rate of 10% is going to be 36,010. Project B, these are the cash flows. IRR is 25% and the NPV is going to be 68,180. Now, what has happened? Now, if you notice, if you are going based on NPV, which project will you select? Project B. Why? Because it has a higher NPV. But if you are going based on IRR, which project will you select? You will select project A. Why? It has a higher IRR. Clear with this, guys? So why is this problem arising? Basically, there is actually a conflict in rankings between IRR and NPV. This is the first issue in IRR. Sir, why is this conflict happening? First and foremost reason is NPV is an absolute figure. It is not calculated in percentage. It's an absolute bulk amount. Whereas IRR is expressed as a percentage. So here the unit of measure is different. That is the first reason. Clear with this, guys, right? And the main reason it's happening here is because look at the size of the project. Now project A has a small size, whereas project B is a huge particular, it's a large volume project. Hence, there is a difference between this percentage and the absolute amount. Clear with this, guys? Sir, which means, sir, if I have a small project, always the IRR will be high? No, nothing like that. To break that myth only, we have done one more area, they have given one more example where, if you notice here, one second, it's got stuck. Yes. So if you notice here, project A has the higher, the investment. There we saw a lower investment project, a lower value project had a higher IRR. Correct? There we saw a lower project, value project had a higher IRR. But in this case, you will be seeing, look, project A is a high value project, but that itself has a higher IRR as compared to the two. So always understand one thing. Sir, so a lower value project will have a higher IRR. Nothing of that sort. It depends on the cash flows of that particular project. It can have a different series of inflows with outflows. Based on that, the percentage could be different. But however, understand, IRR is expressed in percentage, NPV is expressed in absolute value. So because of this, there is one issue here. There could be a conflict in rankings between the two. Clear with this, guys? That is what we have explained here. Now, sir, why does this happen, sir? Why does this happen? Predominantly, this happens because of the reinvestment assumption. Sir, what do you mean by reinvestment assumption? When you are discounting, or in other words, when you are compounding. Discounting is the opposite of compounding, correct? So, what do you mean by compounding? Arriving at the future value when the present value is given. What do you mean by discounting? Future value is given, using that you arrive at the present value. Now, basically, it's like a compound interest, your cumulative FD calculation only, no? Correct? Cumulative FD, what is the underlying assumption? Will you withdraw the interest every year? No. The interest on interest gets accumulated every year. That is the concept of cumulative FD. Now, what happens? NPV assumes a reinvestment assumption at your cost of capital, WACC rate. Clear with this, guys? The NPV technique assumes that all the cash flows are reinvested at a discount rate, because NPV is done using discount rate only, whereas IRR assumes that the reinvestment happens at the IRR rate itself. Clear with this, guys? So the reinvestment, the rate at which the cash flows are getting reinvested the assumption is different for IRR as well as for NPV. NPV assumes that the reinvestment happens at the discount rate, whereas IRR assumes that the reinvestment happens at the IRR rate itself. This is the fundamental reason why there is a conflict in rankings between the two. Are you all understanding this? So this is your NPV assumes that your cash flows are reinvested at the discount rate, right? And this is a logical assumption, since the use of NPV techniques implies that all the projects which provide a higher return than the discounting factors are accepted. So because you assume the reinvestment assumption to be, the reinvestment assumption is made at the discount rate, and only that NPV value is compared with what? Your whatever is the cost that you have incurred. Guys, clear with this, guys? Because what we do is the net actual return, that you get, the IRR value, that gets compared with your KO. Guys, correct? Now NPV generally is a better method. Reason, they don't assume the reinvestment happens at a higher rate and all. No, it doesn't happen at the actual rate of return. Rather, it assumes that the reinvestment happens at the minimum required rate of return. That is not the actual return. Minimum required rate of return is nothing but your cost of capital. So the reinvestment assumption is happening at the discount rate, whereas in case of IRR, the reinvestment happens at the your IRR rate itself. Now, this is one of the major disparities between the two. The IRR, in contrast, assumes that all the cash flows are reinvested at the project's IRR. This assumption means that projects with heavy cash flows in the early years, will be favored by IRR as compared to the projects having cash flows in the later years. Why? Suppose a project is having a heavy cash flow at the beginning year itself. What happens? That amount, we will assume, if you're following IRR method, we will assume that that major amount gets reinvested for the rest of the life of the project at the IRR rate itself. And hence, a project with a higher cash flow the initial year will generally have a higher IRR. Clear with this, guys? So we will be seeing this here. The reason for disparity, conflict between NPV and IRR, it happens because of three reasons. The first one is because of scale or size disparity. Means what? The size of the project. project A could be having a 5 lakh rupee investment, project B could be having a 1 lakh rupee investment. Basically, I told you the first reason is because IRR is expressed as a percentage, NPV is expressed in absolute figures. This could be one reason. Number two, time disparity in cash flows. What is it? There could be a project where cash flows are heavy, huge cash flows are at the initial stages, and later on the cash flows are not that great. In this case, generally for these type of projects, your IRR will be much more. Reason, because you are assuming the reinvestment assumption at the IRR rate. So if there is a heavy cash flow at the, let's say, the first year or the second year, in this case what happens, you will assume that these cash flows are invested at the IRR rate for the rest of the life of the project. Hence the IRR value will be much more. Clear with this, guys? So these projects will be ranked high by IRR. However, NPV assumes a reinvestment happening only at the discount rate. Hence, NPV will not rank it at as high as compared to your IRR. This is the second reason. Clear with this, guys? And the third reason is there could be disparity in the life of proposals, unequal lives. That is what project 1 can be having for a life of 4 years, whereas project 2 can have a life of only, let's say, 3 years. In this case, there is unequal life. This is also one of the contributing factors for your disparity between NPV and IRR. So the numerical problems for all of that we have discussed in our classes. But anyways, I've kept this in our the solved question back. Also, you can have a look at it, but predominantly these three are the reasons, and the underlying common reason for all these three major reasons is your rate of reinvestment, your reinvestment assumption taken by IRR and NPV. IRR assumes reinvestment at IRR rate, your NPV assumes reinvestment at your discount rate, and this is the huge main reason for all the disparities between the two methods. Clear with this, guys? Right. And apart from that, IRR also has one more limitation. What is this limitation? Now, let us say a particular project has an initial outflow, let's say of 1 crore, right? And what happens, this is at year 0, at the end of year 1, right? It generates a cash inflow, let us say, of 50 lakh. At the end of year 2, it generates a cash inflow of 30 lakh. And at the end of year 3, let's say a further investment is required, let us say to the extent of 50 lakh rupees investment, that is outflow is required. And at the end of year 3, let us say you have an inflow of another 40 lakhs and all, right? And year 4, year 5, year 6, you have some cash flows. Basically, guys, when during the life of the project there is one more investment made, in this case what happens, there will be multiple IRR, 2 IRR. Sir, what do you mean by 2 IRR, sir? At 2 rates, your NPV will be equal to 0. Example, I'm telling you, let us say if you take your discount rate as 14%, if you take your IRR at 14%, right? Exactly at 14%, your present value of cash inflow will be equal to present value of cash outflow. Or in other words, your NPV will be equal to 0. And let us say, even at example, I'm giving you 35% also. Exactly if you take 35%, what will happen? Even at 35%, your NPV will be equal to 0. Clear with this, guys? Now, in this case, there's a huge problem. Sir, which NPV should which IRR should I take, sir? There are multiple IRR in this case. Generally, when will multiple IRR come? In case where the project cash flows signs, they reverse, right? So in case where the project cash flows change the signs or reverse during the life of the project, that is, an initial cash outflow is followed by cash inflows and subsequently followed by a major cash outflow, there can be more than 1 IRR. Definitely will it be there, sir? No, that could be more than 1 IRR. Means what? There will be at 2 rates at which NPV will be equal to 0. Sir, out of these 2 rates, which is my correct IRR, sir? That is actually a lacuna. You will be finding it very difficult. Now, to avoid all these things and also the reinvestment assumption, this is the reason why we have modified internal rate of return. Now, in case of modified internal rate of return, what we do, we convert all the year's cash flow into terminal cash flow. You only have one cash flow right now, inflow, and only have one cash outflow. Match the two, you will arrive at your MIRR. Clear with this, guys? So, and here also during the course of the life, you are actually accumulating, you are using a compound interest formula, taking your WACC, your KO as the discount rate and compounding. So even the reinvestment assumption, right, of IRR is being broken right now, because now we are reinvesting at what rate? At the KO rate only. Clear with this, guys? That's why MIRR is generally a better way, because that will actually remove all the disparities between your NPV and IRR conflict. Clear with this, guys? So, and also if you are having multiple IRR and all, this issue is also getting resolved if you are using MIRR approach, because even if the sign changes, no problem, you are converting everything into a terminal cash inflow. There is only one cash inflow, there is only one cash outflow. The rate that equates to is called as MIRR. So obviously you will not be having multiple MIRR and all that. Clear with this, guys? Now if you go and read MIRR, you will be understanding everything. Now look at this. There are several limitations attached with the concept of conventional IRR. The MIRR addresses some of the deficiencies, that is, it eliminates multiple IRR rates and it addresses the reinvestment rate issue and produces results which are consistent with the NPV method. Now you are understanding it. Yes, this method is called as a terminal value method, and how to arrive at it, we have seen everything. Using this method, all the cash flows apart from the initial investment are brought to the terminal value using the appropriate discount rate, and this results in a single stream of cash inflow in the terminal year. MIRR rate is obtained by assuming a single outflow in the 0th year, and the terminal cash inflow as mentioned above. The discount rate that equates the two is called as MIRR, which is our numerical problem. Now you're clear with this? Yes. So now let's go on to the next area, the final area. It's called as some special cases. Some special cases. So the conflict we've seen, special cases. Now, capital budgeting under capital rationing. Now, what do you mean by rationing? So ration shop, you would have seen. What do you mean by a ration shop? Rationing means what? Distributing properly, right? So even in government, we have ration shops. Why do you have a ration shop? So there are a lot of food grains. We produce food grain and it has to be properly distributed to all the citizens of our country. That's why you call it as a ration shop. It rations. So capital rationing. So what do you mean by that? Let's say I have a lot of money with me. Right now, out of this money, in which of the projects should I properly invest? Correct? This decision is called as capital rationing. Clear with this, guys? Now, let us take one numerical problem in this area, right? And with the help of this numerical problem, we will be understanding the concept of capital rationing. Now, let's take this question. It's question number, yes, it's question number 18. Now, Shiva Limited is planning its capital investment program for the next year. It has 5 projects, all of which give a positive NPV at the company's cutoff rate of 15%. The investment outflows and the present value being as follows. Project A, investment is 50,000 and the NPV is going to be 15,400. Project B, 40,000 with 18,700. So project C, 25,000 investment with 10,100 NPV. D, 30,000 rupees investment with 11,200 of your NPV. And E, 35,000 rupees with 19,300 as your NPV. Now, the company is limited to a capital spending of 1,20,000, which means what? It has a total pocket money of only a wallet balance of only 1,20,000. Now, using this 1,20,000, what they should do? They should pick the top projects and invest their money there. Clear with this, guys? Now, you are required to illustrate the returns from a package of projects. Properly, this 1,20,000 needs to be rationed between the correct projects, right? Within the capital spending limits. The projects are independent of each other and are divisible. Means what? A part of a project can also be accepted. Now, what will you do? Generally, what you will think is, okay, sir, first I will give the preference to the highest, the project that gives the highest NPV. Which gives the highest NPV? So yes, E, this is to get the first ranking. Then project B, that's to give the second highest NPV, second ranking, and so on. No, never do like this. What you need to do is, this is the investment amount. This is the NPV amount. You cannot compare this NPV assets when you are doing a capital rationing. What you need to do, calculate the NPV per rupee invested. This is as good as a return on investment formula. So what you need to do is, look at this. Each of the projects investment value is given, NPV value is given. So what is the NPV for every rupee invested? 15,400 divided by 50,000 gives you 30.308 rupees. That is, for every 1 rupee invested in project A, I'm getting how much? 0.308 rupees. Similarly, for B, for every 1 rupee invested, I get how much? 0.4675. So literally, you need to do the calculation and arrive at the NPV per rupee invested in the project, because only then it is comparable, because these are all different amounts of investment and you get different NPVs. Make it into comparable terms for the purpose of ranking. This issue happens only when you are ranking it in case of capital rationing. Clear with this, guys? Now you tell me, for 1 rupee invested, which of the project gives the maximum return, maximum NPV? It's going to be the first ranking is going to be your project E. So first I will try to invest everything in project E, correct? And then whatever balance I have, the second ranking is going to be project B. Then if I'm left with further money, I will invest in C. And if I still left with further money, I'll invest in D, and then only I will go to A. So this is going to be the order of ranking. Clear with this, guys? Now, first, let's build up the capital rationing program. So first, what will you invest in company E? What is the investment? 35,000. How much will be the NPV you get? 19,300. Now remember, what is the total amount you have, guys? You have 1,20,000 rupees with you. That's the maximum amount you can spend in all the projects put together. Yes, so now you have invested only 35,000. You still have money with you? Yes. Let's go to the second one. So second one is a second ranking project B, correct? So this is the first ranking. Second ranking project is B. How much is the investment value? 40,000. So out of this, how much will you get NPV? 18,700. As of now, you've spent how much? 75,000. Do you still have money? Yes. How much money you've got? 1,20,000 minus 75,000. You still have 45,000 rupees with you. Correct. Now go to project number C. That is the third ranking project. Can you invest fully in this project? Yes, you have 45,000. This only costs you 21,000. So, 25,000. Invest 25,000 here. What is the NPV? You get 10,100. So, till now, how much have you invested? So, 35 plus 40, 75. 75 plus 75 plus 25 gives you how much? That gives you 1 lakh rupees. Till now, you have invested 1 lakh. You have a total of how much? 1,20,000. You have a wallet balance of only 20,000 rupees. Now go to the next ranking project, which is 4. Now, if you look at it, project D has an investment value of how much? 30,000. But how much amount do you have? You have only 20,000, and they have given the projects are divisible. Proportionate investment in the project is allowed. Yes, it's given in the question, projects are divisible. In this case, what will you do? So you will invest only 20,000 rupees in project D. Then what will be the NPV you will get? Proportionate NPV. If 11,200 rupees is the NPV for a 30,000 rupee investment, what will be the NPV for a 20,000 rupee investment? You proportionate, you arrive at 7,467. Clear with this, guys? Add up all the NPV. This is going to be your total NPV. So literally, I have made sure this entire 1,20,000 rupees is being judiciously and properly invested in the right projects. And this is the best ever NPV that you can get. That is 55,567 rupees among a collection of all the projects. Clear with this, guys? Are you all able to understand this? Yes. And project A obviously should be rejected because you don't have the money for that. And even project D, only 2/3 should be accepted. That is 20,000 by 30,000. You are accepting only 2/3. Yo, this, guys, this concept is called as capital rationing. Now, understand one more thing. In this case, they have given in the question that the projects are divisible. Suppose the projects are not divisible, which means what? No doubt you will go for E, you will go for B and all that, right? Now, it's not divisible. What will you do? Very important, guys. This is where many students commit a mistake. Now, what will you do? E plus B plus C. If you invest till this, you would have invested a total of how much? 1 lakh rupees. Correct? Right. You would have invested a total of 1 lakh rupees. Now, you would have got a total NPV of how much? The sum of these three alone, 48,100. Now, this extra 20,000 rupees you have with you, can you invest in project D? No, because it has a value of how much? 30,000 rupees. Here with this, guys. So, sir, proportionate I want to invest, sir. The projects are not divisible. So, how can you do that? Here with this, guys. In this case, you need to have some little smartness here. One alternative is E plus B plus C. What was the total investment? 1 lakh. What was the total NPV? 48,000. Now, what you do, instead of this C, project C, you skip it now. Project C, you skip it now. Suppose take another alternative. What is that alternative? E plus B plus D, you try and see. Just a trial and error, that's all. So, E plus B plus D. So, look at this. E, 35, right? B, 40 plus D. How much is it? 30. What is the total investment here? So, 35 plus 40, 75 plus 30. So, 1,05,000 will be the investment. Is correct. And what is the sum total of all the NPVs here? It's 19,300. E plus B, 18,700 plus D, you get 11,200. So it's going to be 19,300 plus 11,200 plus 18,700. You get how much? 49,200 rupees. Clear with this, guys? Now, these two alternatives. Sir, why will I skip C and go for D? If you look at this, if you skip C and go for D, Overall, you are at least able to utilize 1,05,000 and you are able to generate how much? A total of 49,200 rupees of NPV. Whereas if you stick only to the top three ranking projects, what happens is you would have spent only 1 lakh, you would have got only 48,100 rupees of NPV. So among these two alternatives, if you see, the first alternative, that is the one that we did right now, skipping C and going for D, is much better. In this case, E plus B plus D is preferable as it provides a higher NPV despite D ranking lower than C. Are you clear with this, guys? So this is something that you need to know. Here you should try and see. Suppose I'm skipping the next high ranking and going for the other one. In this alternative, if it is going to give me a higher NPV, then you should go for it. Clear with this, guys? This happens only when the projects are not divisible. Clear with this, guys? And that's about the concept of capital rationing. We saw this both when your projects are divisible as well as when the projects are not divisible. Clear with this, guys? And finally, when you have projects which are having unequal lives, right? In this case, what will you do, right? So they are not comparable as such. To make them comparable, you can use either of the two methods. One is called as your replacement chain method. The other one is called as your equivalent annualized criterion method. Clear with this, guys? So what is all these two methods? Quickly, with the help of one numerical problem, we will be covering this particular area also. Now, let's go to this particular question number 19, right? Let's go to this question number 19, and with the help of this particular question, let's understand the concept of replacement chain method and your equivalent annualized criterion method. Now, first, R Private Limited is considering modernizing its production facilities, and it has two proposals under consideration. The expected cash flows associated with these projects and their NPV as per the discount rate of 12% and IRR is as follows. Now, project A, 40 lakh is the investment. It has a life of 6 years, right? And they have discounted at the rate of 12%. NPV figure is given. They themselves have done everything. What is the NPV? 6,49,094. Project B, the investment is going to be 20 lakhs, but it has a life of only 3 years. What is the NPV of project B? It's 5,15,488. And IRR, project A is given, project B is given. Now, going by NPV, which project will you prefer? You will say, sir, project A, the NPV is higher, I will go with this. But remember, these two NPVs are not comparable as such. Why? Because this is an NPV that you earn for a project with a life of 6 years, right? And with an investment of how much? 40 lakhs. Whereas project B, if you see, this is actually an amount that you earn by investing just 20 lakhs in a span of 3 years. Now, sir, these two are not comparable. How do I make them comparable? These are the two methods that we have. The first method is called as replacement chain method. What will you do? Simple, guys. Now, you have this here, project B. What is the life of project B? 3 years, right? And what is the project value? 20 lakh rupees. Now, can I say, since the life of project A is 6 years and B is 3 years, to equalize the life, we have a second opportunity of investing project B after one time investing. That is, so project B, let us take, right? Outflow is how much? 20 lakh, right? Followed by inflows for 3 years, 7 lakh, 13 lakh and 12 lakh, right? Now it has a life of 3 years, right? Make the life of project B into 6 years. How? Repeat the project once again. At the end of third year, once again you invest this 20 lakhs, right? For the next 3 years, you will be receiving 7 lakh, 13 lakh and 12 lakh respectively. Clear with this, guys? So make this life equal to the life of project A. Clear with this, guys? In this case, what will be the cash flow? Now, in this case, first year outflow is 20 lakh. I mean, year 0, it's 20 lakh. First year, 7 lakh. Second year, 13 lakh. Right? At the end of third year, you receive 12 lakh rupees and once again you're going to reinvest this how much? 20 lakh. So plus 12 minus 20 and negative 8 lakh rupees is going to be the cash outflow. Guys, clear with this. And year 4, 7 lakh. Year 5, 13 lakh. Year 6 is going to be 12 lakhs. Now the particular life of this particular project B being repeated is going to be 6 years. Is correct. And now use the discount rate for the respective cash flows for 6 years and arrive at the discounted cash flows. Now you get an NPV of how much? 8,82,300 rupees. This is actually the NPV of the extended life of project B. Clear with this, guys? So now the extended life of project B is also 6 years and the original life of project A is also 6 years only. They are comparable. Compare the 6,49,094 with the figure of 8,82,300. Now you will say, sir, project B is better, sir. Clear with this, guys, right? So now what happens here? The extended life of 6 years, the NPV of project B with an extended life of 6 years, right, is rupees 8,82,300, while NPV of project A is with a life of 6 years is only 649,094. Accordingly, project B with an extended life of 6 years appears to be more attractive. Clear with this, guys? Now you might have a doubt, sir. Suppose for project A, the life was 7 years instead of 6 years, sir. Now project B, even if I repeat, it will get only 6 years, no, sir. Then it is not comparable. Then how can I use this method? You cannot use this method in that case. That's why this method is not a widely used method. So then what will I use, sir? Use the second method that is called as equivalent annualized criterion. Clear with this, guys? A very simple and a logical method. What will you do? Now, this extended life, and all you forget. What is the NPV of project A? It is 6,49,094. What is the NPV of project B? It is 5,15,488. Guys, correct? Now, this is for a life of 6 years. This is for a life of 3 years, right? What you need to do, simple. So this is actually for the 6,49,094 is an NPV that you get over a period of 6 years, right? So divided by 6 years. This is for a period of 3 years, divided by 3 years, you will get the NPV per year. Guys, clear with this? That can be comparable now. Yes, but wait, it is not a simple division by 6 or simple division by 3. Why, sir? Because here we have arrived at the net present value, that is nothing but discounted cash flows and all. We have considered the time value of money. So in the denominator also consider the time value of money. What is the time value of money? So simple. Instead of 6 years, you take the present value annuity factor of 6 years. Here, instead of 3 years, you take the present value annuity factor of 3 years and divide the two. The figure that you will get is actually called as equivalent annualized criterion. This is the annualized NPV adjusted for your discounting factors, adjusted for your time value of money. So the respective NPV. So here, present value annuity factor of 12 years for 6 years you take, that's 12% for 6 years, it's 4.112. Here, it's going to be 12% for 3 years, it's going to be 2.402, right? So you divide the NPV with the present value annuity factors respectively, you get the equivalent annualized criterion. Now if you see per annum, the annualized NPV of project B is much more than that of project A. So you go for project B. Clear with this, guys? So when you have different projects with unequal lives, in this case, use the equivalent annualized criterion to actually arrive at a meaningful decision, compare the two, and based on that, you rank the projects. Clear with this, guys? Right? And literally with this, we have ideally covered this particular concept of your projects with unequal life also. Clear with this, guys? And literally with this, we have completed this entire chapter. One quick summary I've given here: decision criteria. So non-discounting techniques, if you're using payback period, so payback period, how will you use it for your decision making? If it's an independent project, or is it a mutually exclusive? Mutually exclusive means what? I'm comparing two projects and selection of one leads to rejection of another. Independent means what? I am not comparing anything, just like that. One project proposal has come, whether I should invest or not. Now, based on payback period, how will you do? The company might be having one policy. Generally, they invest in companies which has a payback period of definitely 3 years or less. Now, compare the actual payback period, right? If the actual payback period is less than the acceptable payback period, then you go for it. Lesser the payback period, better it is for the company, because quickly you will recover. Clear with this, guys? When the payback period is less than or equal to the maximum acceptable payback period for the company, then you accept, else you don't accept. Sir, between mutually exclusive projects, go for the one that has a lower payback period. Clear with this, guys? ARR. How will you use ARR, right? If the actual ARR is more than the company's required ARR, then you go for the project, else you do not go for it. Sir, in case of mutually exclusive projects, go for the one that has a higher or a maximum ARR. Clear with this, guys? Discounted techniques, NPV. Sir, independent projects, sir. If the NPV is positive, greater than 0, accept, less than 0, reject. Sir, in case of mutually exclusive projects, go for the one that has a highest positive NPV. Clear with this, guys? Sir, profitability index. How will I take the decision? If it is greater than 1, go for it. If it is less than 1, reject. Why? Profitability index is nothing but present value of cash inflow divided by present value of cash outflow. Clear with this, guys? If it is greater than 1, it means your NPV is positive. If it is less than 1, it means your NPV is negative. Clear with this, guys? Sir, if I'm comparing between multiple projects, basically I'm in the scenario of your mutually exclusive model. In that case, what will you do? Go for the one which has the highest profitability index. Clear with this, guys? Next, IRR. Sir, in case of independent proposals, how will you use IRR? Compare IRR with your cost of capital. If your IRR is greater than KO, go for the project. Less than KO, reject it. Clear with this, guys? Between multiple projects, mutually exclusive scenario, go for the one which has the maximum or the highest IRR. Clear with this, guys? And with this, we have properly completed this particular chapter of investment decisions. We have literally covered all the topics or all the major, not just the major, literally we have covered all the concepts. We have revised all the concepts involved in this particular chapter. Of course, in our classroom discussion, we would have done about 32 or 33 numerical problems with different complications and complexities. But this being a marathon, I've literally covered all the core fundamental topics that are involved, the concepts involved in this chapter. That too, wherever possible, we have also seen numerical problems and all. It's a perfect way of wrapping up this particular chapter. So with this, we have completed this particular chapter called as investment decisions or capital budgeting. So now let's move on to the next chapter. Now, let's start with the revision of the next chapter called as working capital management. Now, what is this chapter all about? Now, let's say I'm starting a company. This is the balance sheet, right? And I have raised money from different sources of finance, that is, namely equity share capital, your retained earnings, your preference share capital, your debentures, and so on, right? Now, having raised the money, I invested in the non-current assets, namely your fixed assets. And for this purpose, I actually took the investment decisions, the previous chapter that we did, using the capital budgeting techniques. I invested my amount in the right amount of, in the right, avenues of long-term assets, namely your factories, your plant and machinery, and all of that. Now you tell me, can I start the business? Absolutely not. Why? You have all the facilities, but of course, you cannot start the production without your investment in raw material. And of course, you also need to have some labor forces like workforce, right? For them, you need to pay some salary and you need to keep them. Only then they can convert the RM into FG. Right? And of course, apart from this, you also need to maintain some cash balance to, meet your day-to-day expenses. You might be having some overheads, that is all other expenses, operating expenses and all. For this amount, of course, for you to meet all these requirements, you definitely need some amount, right? So that is actually called as your working capital requirement. That is popularly your current assets minus current liabilities. But do not worry, what it is we will be seeing here. But understand first, right? So just an investment in your fixed asset alone is not sufficient for you to start your business. You need some money for your day-to-day operations, and that funding for your day-to-day operations is called as your working capital requirement. Now, in this particular subject, your financial management, we saw there are three objectives. One is your financing decisions, the other one is your investment decisions, and the third one is your dividend decisions. Now, this chapter, working capital management, right, goes on to achieve two objectives. One is your financing decision, the other one is your investment decision. How, sir? First, you need to calculate how much amount of working capital is required to meet your day-to-day operations. And having decided that, you will just see from which sources of finance you need to take this from. So it achieves both your investment decisions as well as your financing decisions. Now, first, before we get started here, you need to know what an operating cycle is, or in other words, your working capital cycle is. Now guys, basically what happens? Let us say before the start of operations, I need to bring in some cash. Using this cash, let us say I purchase raw material, right? And generally what happens, the moment I purchase raw materials, I keep it in my stores area for a span of 10 days, because I generally stock 10 days of raw material, so that in case of any contingencies, I will be able to meet it. So raw material will be there for 10 days in my stores area. So I need to actually I buy and keep 10 days equivalent consumption of raw material. Now, after this, what happens? This raw material will be issued to my production, and the conversion of raw material takes place, right? This process is called as WIP. Let us say, for example, it takes 5 days to convert my RM into FG. The WIP process takes 5 days. Now, after this process comes in, right, what will happen? It gets completed into FG, and let us say I need to store it for, let us say, one more 10 days. Sir, why do you need to store it for 10 days? immediately upon conversion of FG, you might not be able to sell it. You need to identify your customer and then sell it. So the stock basically spends 10 days in your godown, right? And only after that you will be able to sell it. Now, after this 10 days, what happens? You sell it to your customers, and now it becomes into a debtor. Clear with this, guys? Clear with this, guys? It becomes into a debtor. Let us say the debtor takes 20 days to make the payment, right? 20 days to make the payment, and after 20 days, what will happen? This debtor gets converted into cash. Clear with this, guys? This is an example I'm telling you. Now, I put in some cash into my business, right? For 10 days, right, it remained as a raw material stock. And after that, what has happened? For 5 days, the conversion process happened. And after that, for 10 more days, it was lying in my godown or warehouse as FG. And finally, upon that, did I realize the cash? No, it took me 20 more days for me to receive it back in cash. So 10 plus 5 plus 10 plus 20, it comes out to how much? 45 days. Literally, it took me 45 days, right, for my cash to get converted back into cash. And this time frame of cash to cash cycle is popularly called as operating cycle. Clear with this, guys? This is called as operating cycle. Now, let us say for one operating cycle, right? Let us say I need to bring a working capital investment of 100 crores. Just an example I'm saying of 100 crores. So only if I bring this 100 crores, what will happen? I will invest in stock of raw material, right? And then I will also invest some money on my conversion of RM into FG and all that, this WAP process. And then for some days it remains in my FG stock and all this debtors and all that. So overall, for my working capital day-to-day operations, first I bring in 100 crores. Now what happens with this 100 crores? This 100 crores gets invested into my business, and let us say at the end of 45 days, I get back this 100 crore rupees to me. So this 100 crores comes back to me because one operating cycle gets over. Are you clear with this, guys? Now, at the end of 45 days, if you notice, you will not get 100 crores, you will get slightly more than that. Let us say you get 105 crores. How, sir? Obviously, when you're investing, right, the cost will be invested, but when you get back, you will get back the amount with profit. No, the debtors, basically, it represents the sales figure. So you don't get back your cost, you will get it along with some profit. Clear with this, guys? Now, I invested 100 crores, right? And at the end of 45 days, I got back how much? 105 crores. Now, what will you do? Now, you will take this 105 crores and just run away? Absolutely not. Now, immediately at the end of 45th day, what will happen? The second cycle of your working capital will start. So what I will do, maybe I will take this 5 crores out as my profit, and once again, this 100 crores gets reinvested back into the second cycle. And at the end of the 45th day, what happens? This 105 crores comes up. I may take out 5 crores for my profit, and once again, I will reinvest 100 crores back into the third cycle. And like this, the cycle keeps on going till my business actually stops, till I shut down my business. Or in other words, what happens? The working capital, right, investment is required only for the first cycle. If you invest only for the first cycle, automatically at the end of the first cycle, cash will be released that can be reinvested back to the second cycle, and that can be reinvested back to the third cycle, and life goes on like this. Clear with this, guys? Or in other words, whenever I am saying I need to bring in working capital funding, you need to fund only one cycle, to the first cycle. The moment you do that, the cash released out of the first cycle will be reinvested to the second cycle. The cash released from the second cycle will be reinvested back to the third cycle, and life goes on like this. Clear with this, guys? So in our example, so we took 100 crores as the working capital requirement. Now this 100 crores, what I should do? This is the working capital investment required. Now I need to fund this, correct? Now where will I fund it? There are two options. One is your long-term sources of finance, and the other one is your short-term sources of finance. Long-term sources of finance, your equity share capital, your retained earnings, your preference share capital, your debentures, and so on. By the way, guys, This 100 crores, is it a short-term requirement? Absolutely not. Now, obviously, at the end of 45 days, you will not get it back. It gets reinvested back into the business and it remains in the business till it gets shut down. It's a long-term investment in general. Clear with this, guys? Now, what will I do? I can either go for a long-term sources or I can go for short-term sources. Example, creditors. Now I need to bring in this 100 crores, let's say, to purchase my raw materials. But my creditor is saying, do not worry. Do not worry. To some extent, I will first supply you raw material. You pay me after some time. Clear with this, guys? So in this case, what happens? My supplier is indirectly funding my working capital, but not in cash, but he's supplying me in kind. Clear with this, guys? So that is also an indirect way of funding. But if you notice, this creditor is naturally bundled in my normal course of operation. And this is the reason why we say working capital is current asset minus current liability. Why? Let's say my funding requirement was 100. In current asset investment was 100, but however, creditors are saying, look, to the extent of 20 crores, I will give you credit. So literally, only for this net current asset called as working capital, I need to go to my long-term sources of finance. Are you clear with this, guys? And this is the reason why working capital is called as current asset minus current liability, because current asset is a gross investment required in working capital. Out of that, a portion is naturally bundled in my course of operation that gets reduced to arrive at my net current asset, popularly called as your working capital. Clear with this, guys? And this is the amount for which you need to go to the long-term sources of finance for your funding. Clear with this, guys? And one more thing I told you, working capital is an investment, right? And it gets released at the end of one cycle, that gets reinvested back to the second cycle, and the life goes on like this. And at the end of the last cycle, suppose I'm shutting down the business, finally this working capital amount gets released, correct? This is also the reason why I told you in the previous chapter, your investment decision, that your working capital is an outflow initially and it will be released. It is treated as an inflow at the end of the life of the project. This is the reason for that. Clear with this, guys, right? So this is actually an introduction to this chapter called as working capital management. So working capital basically refers to current asset minus current liability, the net amount that I need to first bring in, right, to start my operations. And remember, I just need to fund my first cycle, because that will go on. The amount released from the first cycle will fund the second cycle, and that will release the third cycle. I mean, the amount released from the second cycle will fund the third cycle, and life goes on like this. Clear with this, guys, right? And this is a very, very important understanding when it comes to your working capital management. And of course, when you say working capital cycle, it means what? Your cash to cash cycle. Let us say my trade creditors give me a credit period of 15 days. So my net working capital cycle will be 45 days minus 15 days. It will only be 30 days. So 30 days equivalent, whatever is the cost that I consume for 30 days, that figure I need to first bring in to start my operations. That is going to be my working capital cycle. Clear with this, guys? So if I am getting a more trade credit, it means what? It means what? Then my working capital requirement will also reduce, and hence my funding will also be reduced. Clear with this, guys? Suppose I am being more liberal and I'm saying for my debtors, instead of 20 days, I'm giving 25 days, which means for 5 more days, my amount gets blocked into my business. Accordingly, I need to bring in more working capital amount. Are you all able to understand this? Yes. Now that's about your introduction to working capital management. Now look at this. In this chapter, we'll understand the meaning and need and importance of working capital, along with its components and methods of estimating it. Now, this chapter is broadly classified into 6 parts. This particular chapter is classified into 6 parts, right? The first one is called as Introduction to Working Capital Management. Then you have Treasury and Cash Management. The third part is your inventory management. Ideally, this gets covered in your costing area, so nothing is there in your FM area. Then you have receivables management. Then you've got payables management, and finally, you've got something called as financing of working capital. Now, guys, ideally, this chapter is a very big chapter, right, which we cover in detail in our both EVO Fast Track as well as in our regular courses. In this marathon, we will quickly recapitulate all the important areas in this particular chapter in such a manner that it will be a very good revision for you the day before your exam. So now let's get started here. Now, important terms or concepts used in working capital management. Now, before we start this chapter, you need to know the format of cost sheet, which we generally see in costing. So, what's the format of cost sheet? So, opening stock of raw material plus purchase minus closing stock of raw material gives you raw material consumed, to which you add your direct wages and direct expense. The subtotal is called as prime cost. Add your production overheads, that gives you your gross works cost. Add your opening WAP minus closing WAP, gives you your factory cost. It's also known as your cost of production. Add your opening FG minus your closing FG, gives you your cost of goods sold. To this, add your AOH and add your SOH, your admin and selling overheads. It's called as cost of sales. To this, add your profit. You will arrive at your sales figure. Literally, guys, this need not be mugged up. There is something called as flow of cost that will actually give you the logics for all this. This generally we covered it in costing area, and even in FM when we did our EVO fast track and a regular batch, I would have explained all this. So this is basically, since this being a marathon, I'm not getting into the logic behind the cost sheet, but trust me guys, it is all fully conceptual. Clear with this guys, right? And of course, AOH at times may also be treated as a product cost, which we have seen in costing area. Now, let's move on here. Let's move on here and see what is this. So quickly, we'll recapitulate here. First, meaning and concept of working capital, right? So, 1 second. Yes. Okay. So, in accounting terms, the working capital means refers to your difference between current asset and current liabilities. What it is we saw right now. The reason why current liabilities is reduced from your current asset, we saw it right now. Fine. And current asset, what do you mean by this? Simple, we all know. So, which is expected to be realized or intents to be sold or consumed in the normal operating cycle, right, of the entity or within 12 months. So basically, your current assets comprises of stock, debtors, your cash and prepaid expenses predominantly, or any other current assets that may include your short-term loans and advances. Current liability, anything that is expected to be settled within 12 months or the normal operating cycle. Operating cycle, we saw what it was. In our example, it was 45 days, right? If you're also having a creditor, we saw that example, we saw it was net of 30 days only. Clear with this, guys. Examples of current liabilities, your payables, outstanding payments, and all these things are an example of your current liabilities. So, working capital. Now, guys, should I maintain a high amount of working capital or a low amount of working capital? Both are actually not good for you. If you're maintaining high working capital, what happens? Which means you're bringing in more money, and every rupee raised has a cost associated with it. Here with this, guys. So if you're bringing more money and that is lying, idle with you, in that case, what happens? You will be incurring more cost. On the contrary, if you are bringing less amount as working capital, what happens? Suppose, let's say you are keeping lesser stock, but suppose a customer walks in with a more demand, you might not be able to honor it. So it will actually result in loss of profit. Clear with this, guys. So both are wrong. You need to maintain adequate amount of working capital, and hence this chapter is very important because fixing the right and adequate amount of working capital is one of the most primary decisions in your financial management area. So maintaining adequate working capital, that is managing the level of individual current assets and current liabilities, and first arriving at how much you need, and then talking about the financing part of it. So how am I going to get this money? That is also a subject matter of discussion in this chapter. That's why I said this chapter achieves twin objectives, both your financing decisions as well as your investment decisions. Clear with this, guys. That's what is being done. Now, working capital can be broadly classified on the basis of time and on the basis of value. On the basis of value, you can say working capital is a net working capital or a gross working capital. Simple. Gross working capital refers to investment in current assets. Net working capital means what? Current assets minus current liability. That is the net amount that you need to invest into the business. Right. On the basis of time, you have something called as a fluctuating working capital and a permanent working capital. What do you mean by this? Permanent working capital is the amount that you will generally need at any given point of time. Our example we saw, it was 100 crores and all, I told you, no, right? That is the minimum level of investment that you definitely need to carry at any given point of time. What do you mean by fluctuating working capital? Suddenly during season, over and above this 100 crores, maybe for 1 month alone, I need this 20 crores extra to run my operations, right? At the end of 1 month, right, this 20 crores alone will be released back. I can take it out of my business. So at any given point of time, I'll be maintaining 100 crores. Suddenly in between, over and above this 100 crores, I might need this 20 crores maybe for 1 month. And once again, at the end of 1 month, once again, I don't need this 20 crores. My overall investment will only be 100 crores. So during that temporary time, my total investment in my working capital will be 120 crores. That's only for a temporary period of time. So here, 100 crores is a permanent working capital, and then this 20 crores was a fluctuating or a temporary working capital. Here with this, guys, right? That's the example of here. Now, optimum working capital. So what is this? Obviously, your current assets should not exceed your current liabilities. Why? Now, this is very important because you may run into trouble if you're funding everything through the current liabilities. Then it's a very, very dangerous situation. Tomorrow, something happens and the current liabilities, you're asking back the money. Then how will you pay? That's a short-term liquidity issue. Very, very danger. Clear with this, guys? Because it might result in short-term obligations and eventually the company may lose its reputation and not many vendors would like to do business with them. Right? So current ratio is a very good indicator. So optimum current ratio is 2:1. So current asset upon current liability, generally a 2:1 ratio is very good. Your current asset should be 2 times your current liabilities. This is what they say. A higher ratio means what? Inefficient use of funds, which means you're having more current assets. That is also not good. And a lower amount means what? That is also not good, because in this case, you are more vulnerable to insolvency. Clear with this, guys? If you're having lesser current assets, that is also not good. We saw that, right? And of course, another indicator is also going to be your asset trust ratio or your liquid ratio. Clear with this, guys? Now, scope of working capital management. Right? In your scope of working capital management, you have two broad things. One is called as liquidity and profitability. The other one is called as investment and financing. Obviously, investment and financing, what it is we saw. So you need to arrive at how much amount of working capital is required. That's called as investment. Having decided that amount, right, where from you are going to source it, that's called as financing decision. Clear with this, guys? Now, the other one here is about liquidity and profitability. What is this? There is a trade-off between liquidity and profitability, right? Now, for uninterrupted and smooth functioning of day-to-day operations, I need to maintain liquidity of funds. Clear with this, guys? So I need to have some money with me, or I need to have a ready stock, or I need to invest more in my working capital. Now, there is always a trade-off between the two. What is it? Suppose if I'm having more working capital, what happens in this case, right? Liquidity will be there. Yes, at any given point of time, what will happen is I'll be having stocks, I'll be able to run my business smoothly. But what happens? Every rupee raised has a cost associated with it, but my profitability will be taken for a toss. My profitability will reduce. On the contrary, sir, I don't want to maintain more stocks and all. I don't want to have more working capital. I want to have only less working capital. In that case, liquidity will be an issue. You might not be able to honor all your commitments or all your sales, but however, profitability will be more. Why? You have borrowed only lesser amount. Your working capital requirement was lesser only. In that case, the cost was actually saved by you. Clear with this, guys? So which is good? You need to do a trade-off between liquidity and profitability. That's why they're saying a trade-off is required between liquidity and profitability. Clear with this, guys? So this is what I have tabulated here. Now we will do one example here. Do not worry about it. Right? So here, investment and financing. So working capital has two decisions. First is investment in working capital, deciding how much I need, right? And then the second one is financing. From where am I going to get it? Clear with this, guys? That's the predominant portion of this chapter. Now, there are approaches to working capital. One is an aggressive approach. Then you have a moderate approach. Then you have a conservative approach. What is an aggressive approach? Aggressive approach means I hold lower levels of inventory and etc. That is, my investment in working capital will be lesser. My investment in current assets is going to be lesser. Aggressive, risk taker, it's okay. Let me just see. Clear with this, guys? The advantages of this approach is that lower amount of fund is tied to my working capital, resulting in lower financial cost, because every amount borrowed has a cost associated with it. But the flip side is it could have a risk of stockouts, and that the organization could not grow, which leads to lower utilization of fixed asset and long-term debts. In the long run, the firm may stay behind the competitors. This approach would better suit a highly integrated organization with efficient processes. Now, what about conservative approach? In this case, I bring in more amount in my working capital investment, right? The company maintains higher level of investments in your, current assets and all that, right? The advantage here is that I'll be able to honor more commitments. I can increase my sales and all of that. But the disadvantage is that since I bring in more money as working capital, it will have increased cost of capital. Clear with this, guy? And since I'm investing more in inventory and all, there could be some inventory losses, obsolescence, high risk of bad debts. If I'm giving more credit period, which means more amount gets blocked in my debtors. So all these issues could be there. Clear with this, guys? And moderate is basically a balance between the two. Clear with this, guys? Yes. So now, how will you know whether a company is having a moderate, aggressive, or a conservative, current asset policy? I mean, your working capital policy. Now, one indicator is your current asset to fixed asset ratio. Clear with this, sir? So clear with this, guys? Yes. Sir, how will I know, sir? How will I know using this ratio? We will look at this with the help of one numerical example. So we will understand this with the help of one numerical example. Now, quickly, let's get started with this numerical example. This is the first question. Yes. Now look at this. A firm has the following data for the year ending 31st of March 20x2. Right? So now it has sales of how much? 1 lakh units, rate of 20, that's 20 lakh rupees. EBIT was 2 lakh rupees and fixed asset was how much? 5 lakh rupees. Now, there are three possible current asset holdings of the firm. So your working capital, gross working capital is nothing but investment in current assets. So what are the three alternatives? 5 lakhs, 4 lakhs and 3 lakhs, and it is assumed that the fixed asset level remains constant and the profit does not vary with the current asset level. Now analyze the effect of the three alternative current asset policy. Now in all the three cases, your current your sales level is going to be 20, 20 and 20. EBIT, it's given in the question, is continuing to it's going to continue to remain 2 lakh, 2 lakh and 2 lakh. Clear with this, guys? Now what is the current asset? First alternative 5 lakh, second alternative 4 lakh, third alternative 3 lakh. Yes, and fixed asset in all the cases is going to be 5 lakh rupees only. So what's the total assets, guys? Here it's 5 plus 5, that is current asset plus fixed asset, 10 lakh. Here it's 4 plus 5, 9 lakh. Here it's 3 plus 5, 8 lakh. Now, what's my return on total assets? EBIT divided by total assets. 2 lakh by 10 lakh, it's going to be 20% in conservative scenario. Moderate, it's going to be how much? 2 lakh by 9 lakh. I get the same 2 lakh, but here the investment was only 9 lakh. It's 22.22%. An aggressive policy. I earned 2 lakh, but I invested only 8 lakh. So what happens here? The return on total asset was 25%. Clear with this, guys? Right? Now, current asset as expressed as a percentage or as times of current assets expressed in proportion with fixed asset, that is current asset by fixed asset ratio. Here if you see, it is 5 by 5, 1. Here it's 4 by 5, 0.8, and here it's 3 by 5, it's 0.6. Clear with this, guys? Now, sir, with all these calculations, what can we conclude? Simple. Now, under the conservative policy, what happened? Now, you had a higher liquidity. Current asset expressed in relationship with fixed asset was what? More, which means you had more component of current asset. So you had more liquidity. Liquidity means what? You had ready cash or easily convertible into cash figures. Here with this, guys, there was more liquidity. But what happened to profitability? Of all the three situations, the profitability was the least. Here with this, guys, that's what we are saying. High liquidity, low profitability under conservative policy. Aggressive policy, look, your current assets was only 0.6 times your fixed asset, which means there was a low liquidity, but look at this, there was the highest ever profitability. Clear with this, guys? And a moderate had a balance of both. So moderate had a return that was higher than conservative but lower than aggressive. So now what will you do? In determining the optimum level of investment in current assets, the firm should balance liquidity and profitability parameters. Sir, which is a good one, sir? It's not like that. You need to balance the two. So this gives me the highest profitability. Today it might give you highest profitability, but what will happen tomorrow if you are resulting in, since your investment in your current assets is very less, tomorrow if some customers walk in with a demand and if you're not able to honor it, you will lose out on sales volume and this profitability will also vanish. Here with this, guys. So do not get misled by this. So as of now, it is like this. So what you need to do is you need to balance both your liquidity and profitability. That is the learning that we see here in this particular segment of your model, your approach to your working capital. Clear with this, guys? Now, how do you estimate your working capital needs? Very simple. What it is we will be seeing here. So basically, this is what I told you. Cash to cash cycle. First, cash gets invested, right, in your material, raw material, right, and then for some time it stays as raw material. Then I will incur labor, overheads and all, right, during the conversion process. It takes some 5 days. In our example, we saw raw material 10 days. Your WIP took 5 days, correct? And in your FG stock, it was remaining for 10 more days. And in your receivables, I think example, we took 20 days, if I'm not wrong. So I think, yes, I took 20 days here. So 20 days overall, when I put in cash, right, it takes 45 days to get back this cash. Clear with this, guys? And the moment I get it, once again, I put it back into the second cycle. So here, the cash to cash cycle is called as my operating cycle. Clear with this, guys? So here, for example, a company adds on material for an average of 60 days. The example they have given, it gets credit from supplier for 15 days. The production process needs 15 days. Your FG is held for 30 days and 30 days credit is extended. Add everything. Add your number of days blocked in each of the component, right? And subtract the trade credit that you got from your creditors. That is going to be your net working capital cycle. Clear with this, guys? Clear with this, guys? Yes. So here it's going to be what? Total of 120 days. That is 60 days raw material minus 15, the credit that I got from my creditors, right? And then they have given here 15 days production process, WIP, right? 30 days in FG and 30 days in debtors. If you add up everything, adjusting for your creditors, so the net 120 days in this example is your working capital cycle. Clear with this, guys? Cash to cash cycle. Clear with this, guys? Yes. So if you collect your debtors faster, what will happen? So cash will quickly get released from a working capital cycle. Clear with this, guys? Or in other words, the number of days for which my amount gets blocked in debtor will be less. So obviously my working capital requirement will also reduce. So if the debtor collection is slower, then it means what? You will soak up a lot of cash that needs to be brought in. Similar case for other things. Inventory. If my inventory shift happens far faster, the conversion happens faster, you free up cash very quickly. Or in other words, my stock value gets blocked only for a lesser number of days. Accordingly, what happens? My working capital funding will also be lesser, right? In case it moves slower, what happens is that you consume more cash, or if you're holding it for a long period of time, one cycle itself will take more time. Or in other words, you need to bring in more amount as the initial working capital requirement. Clear with this, guys? So working capital operating cycle is equal to R plus W plus F plus D minus C. That is raw material storage period plus WIP holding period plus FG holding period minus debtor plus debtor correction period minus creditor payment period. Clear with this, guys? Yes. So this is what we are seeing here. And let us say one cycle takes, let's say, 30 days, right? Which means like this in a year, how many cycles do I have? Can I say it's 360 days divided by 30 days? So how much is that going to be? 12 cycles. So if you want to know the number of cycles in a year, you can say 360 days divided by 30 days or divided by the operating cycle period gives you what? The number of cycles in a year. Clear with this, guys? Generally, lesser the operating cycle period, the period, if it is lesser, it means what? You only need a lesser amount of working capital funding. Clear with this, guys? It is good for the company generally in terms of arriving at the finance, that is in terms of funding your working capital. If it is lesser, the company is also beneficial because they need to borrow only lesser amount. Clear with this, guys? And lesser the operating cycle means more number of cycles in a year, so cash gets quickly rotated. Clear with this, guys? These are all some basic understandings that you need to have. Now, various components of operating cycle. Sir, raw material storage period, how do you arrive at it? So basically, how to do all these things, we will be seeing numerical problems, and similarly estimation of various components of your current assets. So we will be seeing some numerical problems right now. Now let's go and do one numerical problem with respect to your working capital cycle. Okay, now please take this question number 2. From the following information of XYZ Limited, you are required to calculate the net operating cycle period, that's your working capital cycle, and the number of operating cycles in a year. Fine. The raw material inventory consumed during the year. One full year, they consume how much raw material? Worth of raw material? 6 lakh rupees. And the average stock of raw material is how much? 50,000 rupees. Cost of production for the year? 5 lakh. Average WAP is going to be, inventory is going to be 30,000. Right? Then your cost of goods sold for the year is 8 lakh. Average FG stock held is 40,000. Average collection period from debtors 45 days. Credit period availed from creditors is 30 days. Number of days in a year is 360 days. Now, first, let us take raw material. In a year, the company consumes raw material worth how much? 6 lakh rupees. Which means per day, what is the raw material consumption? 6 lakhs divided by 360. How much does it come out to? Per day, they consume raw material worth 1666.666 or 1667. Now, what they are saying, for one cycle, average inventory, stock of raw material is how much? 50,000 rupees, which means what? When you are starting the first cycle, requires a funding, working capital, requires your raw material investment of how much? 50,000 rupees. So can you say how many days it takes for you to consume this entire 50,000? Simple. per day I am consuming raw material worth 1667, and if you are going to bring in an investment of 50,000 rupees in raw material, how long does it take for me to empty this stock of raw material? So I will say it's going to be 50,000 rupees divided by 1666.66666. So how much is that going to be? It's going to be 30 days. Clear with this, guys? Logically, you tell me. So the raw material storage period is what? Average stock of raw material, 50,000 rupees divided by my average cost of raw material consumption per day, 1667. Sir, why, sir? Because now this is the amount of working capital in your raw material that you need, correct? So I'm going to invest 50,000 rupees in working capital of a raw material, right? For raw material alone, this line item, the investment required is how much? 50,000 for the one cycle. I just need to fund my first cycle. Automatically, the cash released from the first cycle will fund my second cycle, and life goes on like this. So just worry about one cycle, right? So 50,000 rupees I need to bring in, right? Now per day, what is the raw material consumption? 1667, which means how long it takes for my entire raw material to get consumed. 50,000 divided by 1667, it's going to be 30 days. Clear with this, guys? Similarly, WIP, if you see, for the entire year, what is the cost of production? 5 lakh. Should I bring 5 lakh? No. I just need to fund my first cycle. In my first cycle, they are saying I just need, on an average, my WIP investment required is how much? 30,000 rupees. Now you tell me how long actually it takes for me to convert my RM into FG. So clearly, you know that the annual consumption is 5 lakh. So what is the consumption? I mean, the cost of production is 5 lakh. So what is the average cost of production per day? 1,389. So which means every day I produce goods, convert goods worth 1,389 rupees. If I need to bring in an investment of 30,000 rupees in my WIP, how long will it take for me to completely convert this 30,000 rupees worth of investment? 30,000 divided by 1,389, that's going to be 22 days. Or in other words, my WIP holding period is going to be average WIP divided by average cost of production per day. Clear with this, guys? Right? These are all some costing concepts included in your financial management. Next, how about your FG? Simple. In a year, I am able to actually have a production and sell amount to what the cost of goods sold is 8 lakh rupees, right? And on an average, I have an FG stock of how much? 40,000 rupees. Simple. So per day, what is the COGS? It's going to be 8 lakh by 360, 2,222. Now, if you look at this, I need to bring in an investment of on my FG to the extent of 40,000. So how long it takes for me to clear this entire FG stock and sell it? Sir, per day, I'm selling goods worth 2,222, which means for you to clear this entire 40,000 rupees worth of FG, it takes how many days? 40,000 divided by 2222 gives you 18 days. Or in other words, your FG holding period is going to be what? Your average stock of FG divided by average COGS, cost of goods sold per day. Clear with this, guys? That's about the formula. Now, what happens? So for a period of 30 days, right, my amount gets logged in my raw material. Then once again, for the next 22 days, my amount gets logged in WIP. Then for the next 18 days, it gets logged up in FG. And after that, for the next 45 days, it gets logged up in my receivables. Clear with this, guys, right? But wait, for a span of 30 days, my creditors are ready to fund me. So remove this 30 days. So net, how much you get? So 30 plus 22 plus 18 plus 45 minus 30 gives you how much? So here the calculation is there. It is 85 days. So the net operating cycle is going to be for 85 days. Clear with this, guys? Or in other words, when I put in cash, right? So after 85 days only, I'll get back the cash, of course, along with the profit. I'll take out the profit and reinvest back the original amount of working capital into the second cycle, and life goes on like this. Clear with this, guys? So it takes 85 days for one cycle. So in a year, how many cycles are there? So 360 divided by 85. So you will be having 4.23 cycles in every single year. Clear with this, guys, right? So this is how you compute your operating cycle when the data is given. Clear with this, guys? Yes. So now that's about computing your working capital cycle. Clear with this, guys? Now, how do you estimate your working capital requirement? So how do you compute your total working capital requirement? Sir, now the amount of requirement, I mean the amount of investment in your components of current asset was all given. Sir, how much you need to invest in RM? How much you need to invest in WIP? How much you need to invest in FG? It was all given. We reworked and calculated what? We reworked and calculated the number of days of holding. That is, we calculated the operating cycle. Sir, if suppose in the question they have asked us to compute the working capital estimation, so how much amount of working capital is required? How do you do that? For that, let's go to the next sum in this regard. So now let's quickly go to question number 3. Let's quickly go to question number 3. Now look at this. Prepare a working capital estimate to finance an activity level of 52,000 units a year, that is having 52 weeks, based on the following data. First, raw material is 400 rupees per unit, direct wages is 150 per unit, manufacturing overheads, production overheads is 200 rupees per unit, overhead selling and distribution SOH is 100 rupees per unit, selling price is 1000 rupees per unit. So your raw material and FG stock remain in, your raw material and FG remain in stock for a period of 4 weeks. WAP takes 4 weeks. Debtors are allowed 8 weeks for payment, whereas creditors allow us 4 weeks. These are all the data given here. And apart from this, the minimum cash balance expected is 50,000 rupees and the receivables are valued at selling price. Now, in this case, what they are asking you, prepare a working capital estimate is the asking of the question. Now, let's get started with the solution. Now, for you to do this, first, you need to prepare a cost sheet. Now, you guys tell me, the company has produced how many units a year? 52,000 units, right? And the raw material cost is 400 per unit. So, for one full year, what is the total value of raw material consumed? 52,000 into 400. That works out to 2 crore 8 lakh rupees. Fine. Now, next one. What is the direct wage cost for the entire year? 150 into 52,000. That works out to 78 lakh rupees. How about your manufacturing overheads? It is 200 into 52,000. That is going to be 1 crore 4 lakh rupees for the entire year. And selling and distribution is going to be 100 rupees per unit into 52,000. That works out to 52 lakh rupees per year. Now, if you add up everything, you get a total cost of sales of 4 crore 42 lakh. This is the total cost of sales incurred for the entire year. Now, out of this, what is the total sales figure? They have given in the question, the sale is going to be, selling price is 1,000 per unit and they've sold a total of 52,000 units. So that comes up with a total of 5.2 crores, right? So 5.2 crores total sales minus the total cost of sales of 4 crore 42 lakh gives you a balancing figure profit of 78 lakhs. Clear with this, guys? This is nothing but a format of cost sheet that you generally see in your costing area. Now, sir, why do you prepare this? Now, simple. Now, read the question. Read the question. Now, they've given raw material and FG stock remain in stock for a period of 4 weeks. Now, what do you mean by that? In every working capital cycle, raw material figure you take, 4 weeks, your raw material actually remains in stock. Or in other words, how much amount of raw material stock you need to have? 4 weeks equivalent consumption you need to have. Clear with this, guys? So 4 weeks, whatever I consume, so the consumption of raw material that I do for 4 weeks, generally I stock it initially. Clear with this, guys? I stock and keep it at any given point of time. Or in other words, in my first working capital cycle, I need to first bring in how much and keep 4 weeks equivalent consumption. Clear with this, guys? How will you calculate? Very simple. Raw material stock will be what? For one full year, I will consume 2 crore 8 lakh, right? If that is for 52 weeks, how much is the consumption that I do for 4 weeks? 2 crore 8 lakh divided by 52 into 4, you get 16 lakh rupees. So which means in the first cycle itself, I need to bring in and keep 16 lakh rupees worth of raw material stock. Clear with this, guys? So this 16 lakh rupees is the raw material investment required for the first cycle. Sir, only one cycle you will fund. Yes, you will not fund for the entire amount. No. Why? Because at the end of the first cycle, cash will get released, that will get reinvested back to the second cycle, and then life moves on like this. So only the first cycle needs to be funded. So for the first cycle, what is the raw material stock here required is 2 crore 8 lakh. That is for 52 weeks. How much is for 4 weeks? Clear with this, guys? It's going to be 16 lakh rupees. Fine. The next one. WIP stock. Now, basically, guys, WIP, fine. We will come to WIP later. First, let's do FG stock. Now, FG, what they are saying, the company keeps an FG stock of 4 weeks, right? They keep your FG remains in stock for 4 weeks. Now, what is the total cost that gets blocked in your FG? In your FG, it is not just the material cost. Your labor, overheads, everything goes into your FG. So, ideally, you will take this total figure of how much? 4 crore 42 lakhs. Clear with this, guys? Strictly speaking, it should only be material plus labor plus manufacturing overheads. Selling and distribution generally is not used for stock valuation. It's a costing area. But in this question, they have considered even 4 crore 42 lakhs, the entire amount. So now what do you do? 4 crore 42 lakhs, right, is the cost for the entire 52 weeks, right? So what will be the cost pertaining to 4 weeks? It's going to be 34 lakh, which means at the start itself, first cycle beginning itself, I need to bring in 34 lakh rupees worth of FG stock. Clear with this, guys? Yes. So only the first cycle needs to be funded. Why? Because the second and third cycle and all will be funded from the cash released using the through the previous cycle. Clear with this, guys? So only the first cycle needs to be funded here. So it's going to be 34 lakh. Now, how about WIP stock? Now, in your WIP, what happens? WIP is basically incomplete goods, right? Now, in your WIP, what happens, right? So this is the total value of WIP. That is what happens. It's a work in progress. So the entire raw material is fed at the initial level itself. So every single unit of WIP would have consumed the entire raw material, but your labor overheads alone, right, it is not fully complete. In the absence of information, you take it as 50% complete with respect to labor and overheads. So now your overall WIP will be valued at full cost of production. That is 2 crore 8 lakh, right, is going to be 2 crore 8 lakh. The entire raw material is fed, correct? Then your labor as well as your manufacturing overheads is required for the conversion of RM into FG. So 78 lakh plus your 1 crore 4 lakh, that will also go on to value your WIP. But wait, since it is a WIP, which means it's a work in progress, nothing is given in the question, we assume that it is only 50% complete with respect to the labor and your overhead component. So that alone divided by 2 you do. So this is going to be the total WIP value for the entire year. That is the total cost consumed by the WIP stocks the entire year. But if that is for 52 weeks, how much is for 4 weeks? So literally the amount that gets blocked in my WIP is going to be 23 lakh. That is, in one cycle, the amount that gets blocked in WIP is going to be 23 lakhs. So how you valued this? You took 100% of raw material, but labor and overheads only take 50% complete because it's an WIP. It's an incomplete product, right? So that if it was for 52 weeks, how much is for 4 weeks? You do the computation, you get what? 23 lakh rupees as the figure of your WIP investment. Finally, your receivables, how much is it? They have given in the question, receivables is valued at sales. Strictly speaking, receivables should only be valued at cost of sales, because now look at this. First, let's do the calculation here. What is this going to be? 5 crore 2 lakhs. If 5 crore 2 lakhs is for 52 weeks, how much amount is the sale value for a period of 8 weeks? So for a period of 8 weeks, 8 weeks is the amount that is given. Debtors are allowed 8 weeks collection period. So basically, what is the amount that gets blocked for a period of 8 weeks? It's going to be 5 crore 20 lakhs. Divided by 52 into 8, you get 80 lakh rupees. So literally in the first cycle, I need to bring in 80 lakh rupees worth of funding. Why? Because this is the amount that gets blocked for a period of 8 weeks. Now guys, there's one small thing here. Now, they have specifically given in the question, receivables are valued at selling price. If nothing is given, ideally speaking, receivables should be valued only at cost of sales. Why? Because the profit amount is not invested into the business. What you invest is only the cost in respect of sales. Cost of sales, only that amount gets blocked into my business. So ideally speaking, in the absence of information, you should have valued your debtors only using cost of sales. But in this question, since they have actually given your it is valued at selling price, hence we took the sales value as the base to compute. So, and apart from this, they said that the company requires to maintain a cash balance of 50,000 rupees. So overall, for one cycle, what is it? Gross working capital requirement, it's a current asset requirement, 1 crore 53 lakh and 50,000. Clear with this, guys? So now I need to bring this amount. Yes, but wait, there are some creditors. They are saying creditors will give me 4 weeks. So how do you compute this? Now in a year, I make purchase of raw material worth 2 crore 8 lakhs, correct? So if 2 crore 8 lakh is the total purchases made for 52 weeks, how much is it for 4 weeks? So it's going to be 16 lakh rupees, which means in one working capital cycle, your creditors are funding you to the extent of 16 lakh rupees. So to the extent of 16 lakh rupees, you need not bring this amount by yourself because it is getting funded indirectly by your creditors, not in cash, but they actually supply in kind and accept the payment later on. Clear with this, guys? So if you reduce this, your net working capital requirement is going to be 1 crore 37 lakh and 50,000. So this is going to be your overall working capital requirement. Clear with this, guys? So literally speaking, here in this marathon itself, we have seen how to compute the operating cycle. We have also seen how to estimate your working capital, and that is about the first part of this particular chapter, which is introduction to your working capital management. So this is broadly the most important aspect in this particular chapter. This is the more lengthier aspect also of this particular chapter. Clear with this, guys? So this is what they have given as formulas. In this case, we have done numerical problems itself, and with that, it's completed. completely done. Clear with this, guys? The format and all is given. So how do you estimate your working capital? Your raw material, WAP, FG, receivables, prepaid expense, minimum cash and all, minus your trade liabilities, trade creditors. You get, your current liabilities, you get your net working capital. In case in the question they have given over and above this, add some safety margin of 10%, add that, you get your net working capital requirement. Clear with this, guys, right? There's also something called as net working capital requirement based on cash cost. So what do you mean by cash cost? So this is what I have mentioned here. Now look at this. Look at this. Just now I explained, no, data should not be valued at your sales value. It should be valued at overall cost. This is one more conservative way of valuing all your data. What is this? If we have a sundry debtors worth 1 lakh and our cost of sales is 75,000, the actual amount of funds blocked in sundry debtors is only 75,000. So the cost of sundry debtors, the rest 25,000 rupees is profit that is not getting blocked, because you don't invest your profit. Profit gets received. Again, some of the cost items. So what is the amount that gets blocked? 75,000. Once again, further if you deep dive, some of the items of this cost are also non-cash items. For example, depreciation. Now, suppose out of the 75,000 rupees is your cost, 5,000 rupees is depreciation. You tell me, do you invest depreciation? Do you actually incur some cost? No, with respect to depreciation, it need not be paid in cash. Clear with this, guys? So then it is obvious that the actual funds blocked in terms of sundry debtors totaling 1 lakh rupees. Sundry debtors worth 1 lakh, if you see, actually the funds blocked is only 70,000. Not even 75, because depreciation is also not getting blocked here. Clear with this, guys, right? In other words, 70,000 rupees is the amount of funds required to finance sundry debtors worth of 1 lakh rupees. Clear with this, guys? Similar case for FG. So even in FG, if you're valuing it at full cost, you remove all the non-cash items, right? Depreciation and all. So literally you use only the cash cost, right, to arrive at the value of FG, that is called as cash cost basis. Clear with this, guys? And there is one more question on double shift working in your working capital requirements. There's only one sum in the study material, which we generally cover in our fast track and regular lectures, right? So it actually is a lengthy discussion that's not done in our marathon, but that's a one-off discussion, a very unique problem, which we generally do in our fast track and our regular lectures. Clear with this, guys? But broadly, this is about the part 1. That is your introduction to working capital management, wherein we have seen how to calculate the operating cycle, your working capital cycle, and how to estimate the components of working capital. And along with that, we saw the different policies like conservative, aggressive, and your moderate policy. And of course, we learned what we mean by working capital. Here with this, guys. With that, we have completed the first segment of this particular chapter. Now, let's move on to the second part of this chapter called as treasury and cash management. Now, guys, in this particular segment, at most what we'll be seeing is, we'll be seeing two components. One is preparation of cash budget, right? It's very logical, it's common sense driven. And the second one is finding out what should be the optimum amount of cash balance a company needs to maintain at any given point of time, right? So to calculate the optimum level of cash balance the company needs to maintain, right, there are two models. One is called as the William J. Baumol model, and the other one is called as the Miller-Orr model. What are those two models? We'll be seeing during the requisite amount of time. But right now, first, this predominant portion of this segment deals with preparation of cash budgets, right? So now basically when you mean your cash and treasury management, it involves handling the hard cash, that is your cash and bank balances. Clear with this, guys? So right, of course it needs to be properly handled. That's why you have cash management, currency management in case the company deals in forex and all this forex transactions, that also needs to be done. Overall fund needs to be managed, the inflows and outflows, your short term, medium term, long term, all these things, right? And the banking day-to-day transaction, all of this are also being taken care of by the treasury department. And apart from that, overall corporate finance related decisions or corporate finance related activities are handled by this treasury team. Clear with this, guys? Now what we will do is predominant portion of this segment, as I told you, deals in your cash budget, right? So quickly, let's catch up one numerical problem with respect to cash budget. Now, of course, they have given all this format of cash budget and all, right? Opening balance, collection, and all these things. Now, you can actually do it very, very logically. Now, let's go and pick one numerical problem, and with the help of that numerical problem, we'll be doing this concept of your cash budget. Now, let's get started here. One second. Now, let's take this question number 9, right? So prepare a monthly cash budget for 6 months beginning from April 2022 on the basis of the following information. Estimated monthly sales are as follow. So you need to prepare from what? April, for a period of 6 months. For each of the month you need to prepare. So April, May, June, July, August and September, right? So up to September you need to prepare. Now what have they given? Monthly sales starting from Jan to October. For 10 months, month-wise sales figure is given. Then wages and salaries are estimated as follows. So month-wise they have given the wages and salaries. Now of the sales, 80% is on credit and 20% is for cash, right? And 75% of the credit sale, right, are collected within 1 month after the sale and the balance in 2 months. So what they are saying, if you're selling worth 100, right, they are saying that 80 is on credit, 20 is on cash. Cash, you will receive it that month itself, immediate. Now out of this, right, the credit portion, what are they saying? Right, 75% of the credit sale, which means 75% of 80, right, will be received within 1 month. The balance 25% of 80 will be received within 2 months. This is what they have given, and there are no bad debts losses. Clear with this, guys, right? So this is just for understanding sake that I mentioned this. Next one. The purchases amount to 80% of the sales and are made on credit and paid for in the month preceding the sale, which means what? Which means what? For purchases is equal to next month's sale into 80%. It will be paid this month. Or in other words, April month purchases will be May month figure of sale into 80%. It's paid preceding the month of sale. Clear with this, guys. Next, the firm has a 10% debenture of 1,20,000. Right, and so the interest is going to be how much? It's going to be 12,000 per annum, and interest on these has to be paid quarterly in Jan, April, and so on. So be careful here. So quarterly once it gets paid. So basically your 12,000 rupees divided by 4, 3,000 rupees gets paid per quarter. So during our 6-month tenure, whatever installment comes, we need to account for that also. The next one. The firm is to make an advance payment of tax to the extent of 5,000 rupees in July. So that will also be a cash outflow. And then the firm had a cash balance of 20,000 rupees on 1st of April, which is the minimum desired level of balance. Any cash surplus or deficit above or below the level is made up by a temporary investment or liquidation of temporary investment, right, or temporary borrowings at the end of each month. Interest on these should be ignored. What they are saying, at any given point of time, the company should maintain only a cash balance of 20,000. In case they're having more than 20,000, difference amount, you park it in investment. So suppose in a month the overall balance falls less than 20,000, you actually sell those investments and bring up for the difference. Make sure that your cash balance is always maintained at 20,000 rupees. This is what they have given. Now in this case, how do you prepare a cash budget? Guys, this doesn't require any financial management knowledge. It requires some common sense, and that's about it. Now first, before that, we need to arrive at the collection from data. Let's have the workings here. Now no doubt, our statement, that is our budget period, starts only from April and ends at September, but they have given collection maximum can go up to what? It can go up to 2 months and all is given, right? So now what do? From Feb, just pick up the sales figure. It's a copy paste from the given question. It's already given. So from Feb, whatever is the sales figure, you just pick it up and put it here. Now what have they given? 80% of the total sales is going to be the credit sales, correct? So 80% on 1.2 lakh is 96,000. 96,000 is the total credit sales made in the month of Feb. Similarly, 1,12,000 is the total credit sales made in the month of March, 64,000 in April, 48,000 in May, 64,000 in June, 80,000 in July, 64,000 in August, and 48,000 in September. These are all the total credit sales. Now, what have they given? Now we need to calculate the collections. Now, read the question. What have they given? What have they given? Now, 75% of the credit sales are collected within 1 month and the balance 25% within 2 months, which means what? 75% of this is going to be collected. That is 75%, 0.75 into 96,000 will be collected when? In the month of March, correct? So 72,000. Then what happens? The remaining 25% of 96,000 gets collected when? In the month of April. So the remaining 25% gets collected in the month of April. Clear with this, guys? The same case happens even for March. For March, what will happen? 75% of 1,12,000 gets collected in the month, 1 month later, in the month of April, and obviously here the remaining 25% of 1,12,000 gets collected in the month of May. Clear with this, guys? Similarly, 0.75 into 64,000 will be collected in May, right? And that's 0.75 into 64,000 gets collected in the month of May, and 0.25 into 64,000 gets collected in the month of June. So for every month, what you need to do, 75% of that month's credit sale, right, will be received in the immediate next month, and 75 and the balance 25%, basically. So 75% of that month's sale gets collected in the next month. The remaining 25% gets collected in the 2 months later. That is the month succeeding the next month. That is 2 months from now. Clear with this, guys? For example, 64,000 you take. So 64,000 into, right, 0.75. If you put, you get 48,000. That gets collected in July itself, right? And the remaining 25%, 16,000, gets collected in the month of August, and so on. Clear with this, guys? So month wise, you need to arrive at the collection schedule. So now you will be getting month wise what is the total amount you get. Add it up, you will get the total collections month wise. For example, in the month of April, you have 84,000 plus 24,000, that comes out to 1,08,000. So similarly, for each of the 6 months, you need to arrive with the total amount of collections made. Clear with this, guys? Now let's start with the monthly cash budget. Now, first, you start up with an opening balance in the month of April. Only that opening balance is given. How much is that? 20,000 rupees. Now, cash sales for that month, how much is it? Simple. That month sale, what is that? April, it's 80,000, right? And they have given 20% of sales are made in cash. So 20% on 80,000 comes out to how much? 16,000 rupees. It is collected in that month itself, 16,000 rupees, right? The next month, what is the sales figure? It is 60,000 rupees. So 20% on 60,000 rupees comes out to how much? 12,000 rupees. So 12,000 will be the cash sales of the next month. So simply respective month into 20%, if you put, you will arrive at the cash sales, right? Now, what will be the collection from debtors? We are not preparing P&L. We are preparing the receipts and payments account, basically, but in a statement format. That's called as a cash budget. So each of the month, what is the total collection from debtors? We have a statement above. Just plug the figures here. So now what will you get? So opening balance plus cash sales plus collection from debtors, you will get the total cash balance. Clear with this, guys? So this is something that you will be getting for all the months you will be getting. But of course, wait for the opening balance, because the closing balance of April will become the opening balance of May, and so on. Clear with this, guys? Now, how about the payments? First, you need to pay for your purchases, right? So how do you pay for your purchases? Simple. So on your purchases, basically they have given that 80% of the sales are made on credit and for paid for in the month preceding the sale, which means you take the next month's sale. I told you, right? On that apply 80%. For example, in the month of April, what will be the amount paid for purchases? Take the next month's sale, 60,000 into 80%. How much you get? So you get 48,000. So 48,000 will be the amount you pay in the month of April. Similarly, takes the next month's sale, on that you apply 80%. You get the month-wise purchase figure. That is the amount paid for purchases. Next one, wages and salary. Wages and salary, I think it's directly given month-wise. It's just a copy paste from this particular dabba given here. So you just take and do a copy paste here. Next one, interest on debentures. Now look at this, interest on debentures. What are they given? So it's a 10% debenture. So annual interest is going to be how much? 12,000 rupees, right? Annual interest is going to be 12,000 rupees. So it's paid quarterly, which means divided by 4, it's going to be how much? 3,000 rupees per quarter, right? And they're saying it's paid for in Jan, April, and so on. So Jan, you pay it once, right? Then in April, you'll be paying. So Jan, Feb, March, right? One quarter is over. Then April, May, June, right? Another quarter is over. Now our thing starts on April, correct? So in April, you'll be paying April, May, June. Then July, once again, you will be paying July, August, September. So literally, you'll be paying 2 times in our budget period. One is in April, right? So April, May, June, and once again in July. So in April and July, you'll be paying this 3,000 and 3,000. Clear with this, guys? And apart from that, there is also a tax payment made in the month of July to the extent of 5,000. You capture everything and total up all your payments. So you call that as B. Clear with this, guys? Right. Now, what have they given in the question? At any given point of time, the company needs to maintain a cash balance of 20,000 rupees. So clearly, it's going to be 20,000 rupees. It's always going to be my closing balance. Clear with this, guys? So now, what is the total cash needed? See, I will say, I need cash to make my total payment of 60,000 plus to maintain a balance of 20,000. So what is the total cash needed? It is going to be 80,000 rupees. Correct? Right? But what is the total cash available? Opening balance plus whatever amount I received during the period. I have 1,44,000, but I need a total of how much? Only 80,000. That is 60,000 payment plus 20,000 rupees is going to be my balance. So literally I have a surplus of how much? A minus C. That is 1,44,000 minus 80,000. I have a surplus of 64,000. What will I do with this? I will immediately remove it from my bank cash balance and I will park it in my investments. So investment temporarily I will do to the extent of how much? 64,000. So if I reduce the 64,000 here right now, what happens? The closing cash balance available is how much? First, the total cash available 1,44,000. From that, remove the 64,000 that you're going to make as an investment, and from that also remove the actual cash payments that you're making 60,000. So literally your closing balance is going to be total cash available, right, minus the investment made, right? So in case you are running in a deficit, you will get this investment. It can be a positive or a negative figure. So minus your investment made plus minus your investment made, then minus your payments actually made. So here you will have 1,44,000. That's the total amount, total cash available, right? Out of that, what am I doing? Minus 64,000. I'm investing it right now. So it goes out of. So investment is actually an outflow for me, right? And minus the actual payments made. How much is that? 60,000. If you do exactly, you will land up with a cash balance of 20,000. So that becomes an opening balance for the next period, and the same calculation goes on. Now, I will take one example here where there is a deficit, right? Now, if you look at this, okay, you look at this June month, what has happened? Opening balance plus all the collections put together, you have how much? 88,000 rupees. But you made a total payment of 90,000 plus you need a balance of 20,000. So what is the total cash needed? It's 1,10,000, right? So you have with you 88, but you need a total cash of how much? 1,10,000, which means there is a deficit of 22,000. What will you do? You will sell your investments and bring this money right now, 22,000. So what will be the closing balance? You need to make it equivalent to how much? 20,000. Simple. So 88,000 is the cash balance available plus, so 88,000, one second, 88,000, yes, plus now what happens here? I am bringing in 22,000 rupees into my business by selling my investments, minus what is the total payable? It's going to be 90,000. If you do this, you get an exact closing balance of how much? Exact closing balance of 20,000. That becomes the opening balance for the next year. Or in other words, the closing cash balance is going to be A plus D minus B, where A stands for your total cash available. D stands for, it could either be you're making an investment or selling an investment. That's why it's given as positive, but it could be a positive or a negative figure. Actually, it should be plus or minus D, right? And minus B. B is the actual payments made. If you do this, you'll arrive at the closing cash balance. Clear with this, guys? This is one normal way of preparing your cash budget. Clear with this, guys? So similarly, there are different variants in which you can prepare a cash budget based on the data given in the question. So that is what this segment predominantly deals with. Clear with this, guys? Now let's go on to the next type of questions in this particular area that talks about the optimum cash balance. Determining the optimum cash balance, there are two models in this particular segment. One is called as William J. Baumel's model. So William J. Baumel's model, what does this particular method say? This particular method says that the optimum cash balance can be arrived by using this particular formula. This is similar to the EOQ, the economic order quantity formula that we see in our costing, material cost area. The formula he says is root of 2 UP by S, right? Where C is equal to root of 2 UP by S, where C stands for the optimum cash balance, U stands for the annual cash disbursement, P stands for fixed cost per transaction, and S stands for opportunity cost of 1 rupee per annum, right? So what is this? We will see with the help of one numerical problem here in our solved question bank. So now let's get started. One second, the page is loading. Yes. So now let's take this question number 13. A firm maintains a separate account for cash disbursement. The total disbursement are rupees 1,05,000 per month or rupees 12,60,000 per year. The admin and transaction cost of transferring, right, the cash to disbursement account is rupees 20 per transfer, and the marketable securities yield 8% per annum. So determine your optimum cash balance according to William J. Baumer model. So what is your formula here? Root of 2 UP by S, right? So root of 2 UP by S, where U is your annual cash disbursement, that is 12,60,000, right? So P is actually the transaction cost, right? That's going to be 20, and S stands for the opportunity cost here. So had I not, if I'm not having this money as cash, like I could have parked it somewhere in marketable securities that will yield me how much? 8%. It's going to be 0.08. So if you calculate this, it's going to be 2 into 12,60,000, right, into 20 divided by 0.08. If you do it, you get some 6.3 crores and all that. You take a square root of that, you get 25,099.800. They can round it off to what? 25,100 rupees. So as per this model, the optimum cash balance we maintain is how much? 25,100. It's a direct formula application, and the logic for this is exactly same as your EOQ, the economic order quantity formula that we actually see in our costing area. Now let's move on to the next model called as your Miller-Orr model. Miller-Orr, actually, he clearly gives a model. He says there is no standard formula and all that. He says according to this model, the net cash flow is completely, so he says it is stochastic, right? So stochastic means what? You need to determine it based on the actual scenario. There is no one specific formula that says this is the amount of cash balance which is optimum. No. When changes in cash balance occur randomly, the application of the control theory, right, serves a useful purpose. The Miller-Orr model is one such control limits. Now what he says is, right, this model is designed to determine the time and size of transfers between an investment account and a cash account, right? So what they are saying is you keep a limit, right? When the cash balance reaches the upper limit, right? You have an upper limit and a lower limit. When the cash balance reaches an upper limit, transfer the cash equivalent to that excess amount, you just transfer it. So always have one normal cash balance, right? Now let your cash balance pile up. If it reaches the upper limit, what will you do? Right, that excess amount as compared to the normal, you immediately remove it and park it under your marketable securities. This is similar to the sum that we saw. No, if you're having excess, right, so you maintain 20,000 at any given point of time. Any excess you have, you remove it and park it in marketable securities, right? Now, so you can also have a lower limit. Suppose it touches the lower limit, immediately sell it from the marketable securities and bring the cash during your account. Clear with this, guys? So this is what this particular method says. So he literally says, so here for all your cash balances, you have one basic level. Right? That is a normal level that you need to hold, right? That's a normal level that you need to hold, right? Have a normal amount, right? Now, the moment your cash balance have an upper limit and lower limit, if your cash balance touches the upper limit, what you need to do, the difference between this, you will remove it from your bank account, park it in marketable securities. Now, your cash balance can also go down. In case it goes down, it touches the lower limit, what you need to do, the difference between this, you need to sell your marketable securities and make sure that once again your cash balance reaches to the normal level. So if you goes up, bring it to the normal level. If it comes down, you bring it to the normal level. At any given point of time, you fix a normal level based on your requirement and always try to maintain it. And you need to take actions only if it touches the higher limit or the lower limit. This is what Miller-Orr model says. Clear with this, guys? Right? And that's about this particular segment. Beyond that, in your cash and treasury management, nothing great is that in this particular segment, you have different varieties of cash budgets, right? There are different ways in which you can prepare cash budgets based on the wordings given in the question. And of course, there is one more thing called as calculating the optimum cash balance. So that can be calculated under either of the two methods. One is called as your Baumol model. The other one is called as your Miller-Orr model. Clear with this, guys? Right? With that, we have completed the second segment of this chapter called as your cash and treasury management. Now let's move on to the third segment of this chapter, which is called as management of inventory. Now guys, here management of inventory is basically, look, they have clearly given, these are the wordings of study material. They have given inventory management has been discussed in detail in the material cost chapter of paper 4, cost and management accounting, and students are advised to refer the same. So literally there is not even a single question or concept in your FM study material with respect to inventory management. So literally that is covered there. In your inventory management, you'll be seeing concepts like EOQ, you'll be seeing concepts like stock levels, right? You'll be seeing concepts like stock levels. Stock levels basically have maximum stock, minimum stock, reorder level, all of that. And then you'll also be seeing something called as ABC analysis, right? Wherein it's called as a selective inventory control system. So all these things are actually coming under management of inventory. It comes under your costing area. Clear with this, guys? So that's about the discussion of inventory management. Nothing great is there here in this particular discussion in your financial management. With this, let's move on to the next segment. Now, the next segment is actually called as management of receivables. Now, in this segment, there are basically two different types of numerical problems. First, the first type of numerical problem deals with what should be the ideal credit policy of the company. That is, should the company give a credit period of, example, 30 days to the customers, or should they give 40 days, or should they give 50 days, or so on. There will be different credit periods. We need to evaluate which credit period is going to be better for the company. But remember one thing, more the credit period, which means what? For more period of time, your funds are getting blocked into the business, or in other words, it means more is the investment in your receivables. So your working capital amount to the extent of your receivables will increase. Accordingly, on that, your opportunity cost, or on that, your financing cost will also increase. But what is the advantage of this? If you increase more, what will happen? If you're liberal, if you're being liberal in your credit period, you will be getting more sales. Because of that, you can also achieve some profit. Clear with this, guys? There is always a trade-off between the two. Clear with this, guys? Yes. And of course, if you're being more liberal, if you're giving more time, there is also a risk of bad debt involved. So all these things should be considered for each of the alternative, and you need to arrive the net benefit in each of the case. And if the benefits for whichever alternative, the benefit is the high, that is your basically expected profit, we need to compute for each and every alternative, and for whichever alternative the expected profit is high, you will say that is actually the ideal and the best credit policy for the company. Clear with this, guys? This is one type of numerical problem. Then there is another type of numerical problem with respect to a concept called as factoring. What it is, we will be seeing at the requisite point of time. Clear with this, guys? Yes. So now that is the predominant portion of discussion in this particular segment. I've just simplified it, and I'm telling you that there are only two types of numerical problems involved here, right? So now in your in your receivables management, there are basically approaches to evaluate your credit policy. As I just told you, you need to calculate the expected profit from each of the alternatives, arrive at the net benefits, right? And whichever alternative gives you the maximum amount of, whichever alternative gives you the maximum amount of net benefit, you will go for that particular alternative. Clear with this, guys? What are these? How do you compute? We will just do it with the help of one numerical problem. Now, let's take this question number 15. A trader whose current sales are in the region of 6 lakh rupees per annum and an average collection period of 30 days wants to pursue a more liberal policy to improve his sales. A study made by a management consultant reveals the following information. So at present, what is the credit period that he allows? 30 days, right? And at 30 days, if he's allowing a 30-day credit period, his total sales per annum is 6 lakh rupees. Right? Now he says he wants to pursue a more liberal credit policy. Now, what does he say? Now, credit policy A, increase in the collection period by 10 days, which means what? 30 plus 10, it's going to be 40 days. Plan B, it's going to be increased by 20 days, so 60 days. Plan C, increase it by 30 days, so it's 30 plus 30, it's going to be how much? Sorry, here it's 50 days, right? So it's going to be 30 plus 20 is going to be 50. Right, here it's going to be 50 days, here it's going to be 60 days, and here it's going to be 75 days. So he's saying, so there are four different alternatives that he's considering, right? Increase the credit period by 10, 20, 30 and 45 days respectively. In that case, what happens? His sales will increase by 30,000, 48,000, 75,000 and 90,000 respectively. But what will happen as you're being more liberal in your credit period, the risk of default, bad debts will also increase. At present, the selling price is 3 rupees per unit and the average cost per unit is 2.25 and the variable cost per unit is 2 rupees, which means what? Variable cost is 2 and the average cost per unit is 2.25, which means what? The 0.25 is the fixed component that will remain constant across your all the sales volume. So you need to arrive at the fixed cost in total value and you need to arrive at that fixed cost figure, right? How to do that? We will be seeing it's ideally a costing calculation. Then the current bad debts loss is 1%, right? At present, it's 1%, right? And for the different levels of credit policy, they have given the bad debt loss. The required rate of return on the additional investment is 20%. That is, cost of capital is 20%. Assume 360 days a year. Analyze which of the above policy would you recommend for adoption. Now, guys, the first thing that you need to do here is set up all the different alternatives, present policy 30 days, policy A 40 days, policy B 50 days, policy C 60 days, and policy D 75 days. And what is the credit sales? The total figure at present it's 60,000. In policy A, it will increase by 30, they have given, which means it's going to be 6,30,000. Policy B, it will increase by 48,000, so 648. Policy C, increase by 75, it's going to be 675,000. And policy D, it will increase by 90,000, it's going to be 6.9 lakhs. Clear with this, guys? Now, the first thing that I would do is, they've given the selling price as 3 rupees per unit, which means how many units have been sold? 6 lakhs divided by 3, that gives you how much? It's going to be 2 lakh units. So here, they have sold 2 lakh units. Here, 6,30,000 divided by 3 rupees. That's going to be your sales divided by selling price, gives you the number of units. It's going to be 2,10,000 units. Right here, the company has sold how much? 6,48,000 divided by 3. That gives you how much? 2,16,000 units. Right here, the company has sold 6,75,000 divided by 3. That gives you how much? 2,25,000 units. And finally, here is going to be 6,90,000 divided by 3. That gives you how much? 2,30,000 units. This is the total number of units the company has sold. Why do we need this? They have given 2.25 is the average cost per unit, right? Out of this, 2 rupees is my variable cost. So 0.25 is my fixed cost at the present level. What is the present level? So it's going to be 2 lakh units. So 0.25 into 2 lakh. So 0.25 into 2 lakh, if you do, how much you get? 50,000 rupees. So clearly, I know that 50,000 rupees is my fixed cost at all the levels. This will not change. But what is going to be my variable cost? 2 rupees per unit. Multiply this with the respective units. You will arrive at the total variable cost. So 2 into 2 lakh, 4 lakh. 2 into 2 lakh 10,000, 4 lakh 20,000, 2 into 2 lakh 16 gives you 4 lakh 32, 2 into 2 lakh 25,000 gives you 4 lakh 50, and 2 into 2 lakh 30,000 gives you 4 lakh 60,000. Clear with this, guys? So for each of the alternatives, you have the total credit sales minus the total cost, that is variable and fixed if you reduce, right? So what is the total cost here in each of the alternatives per annum? So here it's 4 lakh, that is variable, plus fixed 50,000, 4 lakh 50. Similarly, for each of the alternatives, you have the variable cost and the fixed cost. Add up, you get the total cost involved here. Here with this, guys. Yes. Now, what is the bad debts? At present, the bad debts is going to be 1%. So apply this 1% on the sales figure. So 1% on 6 lakh gives you 6,000. Similarly, in your second alternative, that's or proposal A, the bad debts is going to be 1.5%. So apply the respective bad debts percentage on the respective sales figure. You will arrive at the bad debts for each of the alternatives. Clear with this, guys? So what is going to be your expected profit? Sales minus your total cost, right? Minus your bad debts, right? You will be getting your expected profit. Clear with this, guys? But remember one thing, this is not the only cost. This is not the only thing that you get. This is actually the benefit you will be getting under each of the alternative. But wait, there will be a cost here. Sir, what is the cost? Of course, for each of these alternatives, you have a different amount of credit policy, right? So there is a different amount that gets blocked in your debtors. Calculate the amount that gets blocked in a debtor. On that amount blocked, you will be incurring a finance cost. It's called as an opportunity cost. Guys, clear with this? That also needs to be considered. So now, sir, how will we compute that? Very simple, very simple. Now, at the present policy, you tell me, what is the total cost that you incur in a year? It's going to be 4,50,000. That is the total cost with respect to the debtors. Correct? No, the cost of sales, as we call it, right? This 4,50,000 is a cost incurred for a period of 360 days. What is the cost pertaining to one cycle of 30 days? It's going to be 4,50,000 divided by 360 into 30. So how much is that going to be? So 4,50,000 into 30 divided by 360. If you do, literally speaking, so 37,500 rupees is the amount that gets blocked in debtor for the first cycle. I just need to fund for the first cycle because the cash release from the first cycle will fund my second cycle and life goes on for that. This is the amount invested in the first cycle, one working capital cycle. That is the amount that I need to bring as a working capital investment for my debtors, right? On this, what is the cost? It's going to be 20%. So this into 0.2 gives you what? 7,500. So 7,500 rupees is going to be the financing cost, the cost for financing your debtors under the first alternative. So you put 7,500 here. Clear with this, guys? Or in other words, how do you compute this figure? Simple. Total cost, that is for 1 year. So divided by 360 into the respective collection period, you will get the fund blocked in debtors in this particular alternative, that into 20% you will do, you get your actual finance cost that is you will be incurring for the amount that gets blocked in your receivables. Similar calculation you do for all the cases. So the respective cost divided by 360 into the respective credit period, right? That gets that if you do this, you will arrive at the amount that gets blocked. Multiply that with 20%, you will get what? You will get the respective amount. You will get the respective amount of your opportunity cost or your financing cost. Now you consider that also. Now what you will do, the expected profit minus the opportunity cost you do, you will get the net benefits. Now if you see of all the alternatives, which one gives you the maximum net benefits? This proposal A. Clear with this, guys? So the proposed policy A, that is increasing in the collection period by 10 days, right, or a total period of 40 days, should be adopted, since the net benefit under this policy are higher as compared to other policies. Here with this, guys. So this is how you will be computing. This is basically nothing but calculation of your cost benefit analysis for every alternative, and going for that alternative that gives you the maximum net benefit. Clear with this, guys, right? And there's also one more thing that you need to know in this particular segment of receivables management. Suppose if they give you the following figures, if they give you this 2 by 10 net 30, what is the meaning of this? It means generally you need to, generally the debtor, right, the person, your customer, needs to pay within 30 days. However, if he pays within 10 days, he is eligible for a cash discount of 2%. Clear with this, guys? So 2 by 10 net 30 means what? The credit policy is 30 days. If he pays within 10 days, he is eligible for a cash discount of 2%. It can also be 1 by 15 net 45. It can be anything, right? If this is what they are mentioning, it means what? 45 days here is a credit policy. But if the payment is made within 15 days, the customer is eligible for a 1% cash discount. Clear with this, guys? These are some jargons that you need to understand. Clear with this, guys? Now, that is one aspect of this particular segment, that is called as evaluation of credit policies. Now, the second type of numerical problems in this particular segment is regarding factoring. What it is, what is it, we will be seeing with the help of one numerical example. Now, let's move on to the next segment of discussion in this receivables management segment. It's called as factoring. Now, what do you mean by a factoring? Now, let's say we have a firm, right, a company, right? Now, let's say they are giving a credit period of 30 days to their customers. Right? Now, why do they give this? Only if they give this, people will be willing to buy it from the company. They need some credit period. But now, if they are giving credit period, what happens? The company needs to bring in this 30 days equivalent amount of debtor value as a working capital investment. Correct? Now, the company does not want to do all of that, but still it wants to provide the credit facility of 30 days. Is it possible? Yes. How is it possible? Now, what they will do is, they will make this credit sale, right? So the amount will be received only after 30 days, right? But now what they will do is, with this debtor, they will go to another guy called as a factor. Now what this factor will do is, right, he will accept this debtors, right? And today itself, he will pay the full money, adjusting for his commission and all of that, reserve and all what it is, we will be seeing in a numerical problem. Right? And then he will pay today itself. So literally what happens, there is no amount that gets blocked for me. I make a credit sale, and immediately I submit the bills to my factor. He will pay me today itself, and at the end of 30th day, now the customer will go and collect it from the factor. Clear with this, guys? So literally the factor funds my business. So indirectly, instead of providing me the finance directly, what he does, I make the sale and submit the bills to him, and he makes me the payment today itself. So literally, what is the advantage of this? There are two advantages. One, I need not block, or I need not park my funds for the purpose of my debtors. And number two, for me to recover back the money from my debtors and all, I need to have a team, that needs to make some telephone calls and all these things. The credit administration cost can be saved. And on top of that, factors are of two types. One is called as a recourse factor. The other one is called a non-recourse factors. A non-recourse factor will also accept the risk of bad debts. Suppose the end of 30th day, the customer is not making the payment. Now the factor will say he's ready to bear the bad debts. Sir, why will he do that? He will charge more commission in that case. If he's accepting the bad debts, the commission rate will also increase. Clear with this, guys? So how do you compute? Sir, whether should I go for factoring or not? This decision once again needs to be done based on cost benefit analysis. How do we do that? We will take up a numerical problem and see this. Now, Question number 19 on page number 330. A factoring firm has a credit sales of 360 lakhs. That's an annual credit sale. And its average collection period is 30 days. So it collects on an average within 30 days. The finance controller estimates that bad debts losses are around 2% of the credit sales. So bad debts is going to be 2%. If I go for a factor, he will accept it. Clear with this, guys. The firm spends 1,40,000 annually on debtors administration. This can be saved. So this cost comprises of telephone and fax bills along with salaries of staff members, and these are avoidable costs in case I go for a factoring arrangement. A factoring firm is offered to buy the firm's receivable. The factor will charge a 1% commission and will pay an advance against receivables on an interest of 15%. Apart from the commission, he will also charge me an interest. Why? He's indirectly funding me. Clear with this, guys. After withholding 10% as reserve, what is it? We will be seeing it. Analyze what the firm should do. Assume 360 days in a year. Now, first, guys, 360 lakhs is the sales for one full year. At any given point of time, what is my debtor? If 360 lakhs is for 360 days, my debtor is only for 30 days. So how much is it for 30 days? 30 lakh rupees. So at any given point of time, I will go to my factor only with a 30 lakh rupee worth of bill. So he will fund me only for 30 lakh rupees. Clear with this, guys? Yes. Now, on this 30 lakh, he's going to charge me a commission of 1%. That's 30,000. And there is a reserve of 10% on 30 lakh. This 3 lakh rupees. So 30,000 plus 3 lakh you add, how much you get? 3 lakh 30,000. This 3 lakh 30,000 he will withhold, he will not pay you right now. Don't worry, this 3 lakh rupees is not a cost. It is an amount he is keeping for safety purpose. He will release it at the end of 30th day. Don't worry. But this 30,000 is a cost for you that he will, at the beginning itself, he will retain. He will not pay you for that. Clear with this, guys. So on the debtor value, he will reduce all this figure and only the balance he will pay. Clear with this, guys. So the amount available for advance is going to be how much? So on 30 lakh minus 3 lakh, so 30 lakh minus 3 lakh 30,000, the amount available for advancing, he will give you an advance right now only for how much? 26 lakh 70,000. So this is the amount he is funding you, correct? Right? On that, what is going to be the interest? The interest is going to be 15%. So 15% on 26 lakh 70,000, right? But wait, that is for one full year, but he's going to fund only for 30 days. Sir, how, sir? Because the end of 30th day, he is going to receive it from the debtor himself. So clearly, the funding happens only for a period of 30 days. Are you clear with this, guys? So 15% on 26 lakh 70,000 into 330 by 360. What is the interest amount? 33,375. You need to pay him. So you will say, sir, I will pay after 30 days. So only then it is due. He will not accept that. Today, that amount also he will reduce, and net amount he will give you as an advance is only 26 lakh 36,625. So literally from this 30 lakh rupees of receivables, his commission 30,000 will be removed. His reserve 3 lakh will be removed, and the interest that you need to pay him, that amount will also be removed. Out of this 30,000 and 33,375, these two are the cost for you. This 3 lakh rupees is just advance amount he's withholding. At the end of 30th day, he will give it back to you. Nothing to worry about it. Clear with this, guys? Yes. So literally the amount he will pay you today in cash is only going to be how much? 26 lakh 36,625 after adjusting for 3 items: commission, reserve, and your interest. Clear with this, guys? Now, let's evaluate the factoring proposal. First, what is the savings or benefit to the firm? Number one, if I go for this factoring, annually I'll save how much? 1,40,000 rupees on what? This is on all your credit administration like fax, telephone bills and all that, right? You have your salary, staff and all that. Number two, you can also save on your bad debts, right? 2% on the annual sales, 360 lakh. So 7 lakh 20,000 you'll be able to save. So what is the total amount of savings? It's going to be 8 lakh 60,000. But wait, because we're going for factoring, what are the two costs? One is your factoring commission, the other one is your interest. Clear with this, guys? Yes. So what is your factoring commission? Factoring commission is going to be, it's going to be how much? It's going to be 30,000. But wait, this 30,000 is a cost that you pay once in 30 days. It is for one cycle of debtors. Clear with this, guys? So how much will it be for 360 days? So 30,000 divided by 30 into 360. It's going to be how much? 3,60,000. Why? Once in 30 days, I will be visiting the factor with a new bill. Clear with this, guys? So this 30,000 is a cost for 30 days. How much is it? Is it going to be for 360? Literally, every cycle once, I will just go to him. Clear with this, guys? So if this is the cost for 30 days, how much is it for 360 days? The commission total cost, annualized commission cost is going to be 3,60,000. Similarly, interest charges. 33,375 is an interest for 30 days. Sir, after 30 days, that's all. Tata, bye-bye. No. No, one more debtor will come. For that, once again, for the next 30 days, he will charge. Like that, literally, throughout the year, you will be paying him interest on different receivables. Clear with this, guys? So, 33,375 is the interest cost for 30 days. How much is it for 360 days? If you compute, you get 4 lakh and 500. Clear with this, guys? So, what is the total cost you incur here? 7,60,500. What is the total savings that you get? 8,60,000. Reduce the two. So, the net benefit to the firm is going to be 99,500 rupees. So, now you have a positive benefit. Yes, since the savings the firm exceeds the cost, now the company can go for factoring. It is beneficial for them. Suppose if the net benefits is a negative, then you should not go for factoring. Clear with this, guys? And that's about this entire segment. So in this segment, you have only two things. One is about evaluating your different credit proposals, and the other one, the credit policies. The other one is with respect to your factoring of receivables, which we just saw right now using your cost benefit analysis. As simple as that, guys. Right? With this, we have completed this particular segment as well, called as management of receivables. Now, let's move on to the next segment called as management of payables, right? Now, in this segment, there is only one calculation that is called as computation of cost of payables. Now there are two formulas given here. T by 100 minus D into 365 days by T. This is a simple interest calculation. And here you have a compound interest formula, 100 by 100 minus D to the power 365 by T minus 1. This is a compound interest formula. So what is this, sir? So complicated and all. Do not worry, it's very simple, right? So we will understand this with the help of one numerical example. I'll derive this and show, and with that, this particular segment will be completely over. Now, let's take this question number 21. Suppose ABC Limited has been offered a credit terms from its major supplier of 2 by 10 net 45. My supplier is giving me this option 2 by 10 net 45. What is the meaning? You need to pay within 45 days. However, if you pay it within 10 days, you are eligible for a cash discount of 2%. This is the meaning, right? Hence, the company has a choice of paying rupees 10 per 100 or to invest 98 for an additional 35 days and eventually pay the supplier 100 per 100. The decision as to whether the discount should be accepted or not depends on the opportunity cost of investing 98 for 35 days, unless what the company should do. Sir, we didn't understand a single word, sir. What should be done? Now, I will just decode this for you and put it up here. Now, what have they given? What have they given? If you look at this on T0 today, right? I made a credit purchase, let's say, with an invoice value of 100 rupees. Okay, with an invoice value of 100 rupees, right? Now, they are saying if you make the payment on the 10th day, right? Now, it is enough if you pay 98 rupees. However, if you use the full credit term of 45 days, you need to pay how much? Rupees 100. This is what the question says. Now, literally, this cash discount, why is this guy giving? Now, if you are paying him 35 days in advance, so how did I get this 35 days? Right, I am just erasing off whatever is there at the top, right? So how did I get this 35 days? This is nothing but 45 days minus 10 days, right? So time gap 35 days. If I pay him 35 days in advance, he's giving me a discount of 2 rupees. Or in other words, if I pay on 10th day, you need to pay only 98. If you pay on 45th day, you need to pay more. How much? 100 rupees. So effectively, if you are paying on the 45th day, literally speaking, there is some amount he's charging you as an interest. He's actually charging you something more. Yes, what is that? Expressed as a percentage. That is called as cost of payable. How will you do it? Simple. Use your time value of money technique. We know that future value is equal to present value into 1 plus r the whole power n. That is compound interest formula. Here the future value is what? 100 rupees is equal to present value is what? 98 into 1 plus r. R we need to find out the whole power n. N here is what? It is actually a cost that you are incurring for a period of how much? Your interest is actually pertaining to a period of how much? 35 days. Can I say this is nothing but 35 divided by 365? Here with this, guys. Yes. So now here, can I say 100 divided by 98 is going to be equal to 1 plus r to the power 35 divided by 365, right? Now this power, if it goes to the other side, it becomes inverse of it. So can I say 100 divided by 98 to the power 365 divided by 35 is going to be equal to 1 plus r. Guys, clear with this, guys? Or in other words, r is equal to 100 divided by 98, the whole power 365 divided by 35 minus 1. This 1 goes to the other side, it becomes minus 1. This is actually the formula that they have given. Now, if you go and look at this, the formula that is being mentioned here, if you go and look at this, 1 second. Yes. So if you go and look at the formula mentioned here, what have they given? The compound interest formula. So it's going to be 100 divided by 100 minus d. Look at this, 100 divided by 100 minus discount. So 98 is nothing but 100 minus 2, discount. Correct? Yes. So the whole power 365 by t. T represents the difference in time, right? So 365 divided by 35, the minus 1. Clear with this, guys? Generally, this power and all, the figure, the answer will be given in the question. So here it's 100 by 98 to the power 365 by 35. What it is, you can't do it in a normal calculator. They will give you the figures. Do not worry, but you need to know the application of this formula. So now this is logically derivable, guys. So this is all it says. So the formula here is going to be 100 divided by 100 minus d, the whole power 365 divided by your number of days t minus 1. This is going to be your effective cost of payable. Clear with this, guys, right? So this is actually how the formula gets derived here. So effectively, if you are paying him after a span of 35 days, what happens is that, so you are actually incurring a cost of so much. Clear with this, guys? This is all your calculation. So I just used that example question to derive this formula. Now, so there is a simple interest formula, simple. So how do you compute that? So now, literally in this case, can I say, what is my effective rate of interest? So this is a compound interest formula. This is how you derive. So if you want to use a simple interest formula, can I say I am paying 2 rupees more, right, for an investment of 98. Had I paid this today, it is only costing me 98. But since I am paying it later, I am actually incurring 2 rupees more. So the effective cost, can I say, the interest is 2 by 98, guys, correct? 2 by 98. If 2 by 98 is actually the interest rate for 35 days, how much is the annualized interest for 365 days? This calculation is nothing but a simple interest formula. 2 by 98, if you do 2 by 98 is nothing but how much? It's coming out to 2.04%. If 2.04% is the interest rate for 35 days, how much is it for 365 days? This calculation, or in other words, if you do this, this is nothing but 2 by 98, right, into 365 divided by 35. Correct? Right? This is exactly what this particular formula says. So d by 100 minus d. D stands for what? Your discount, divided by 100 minus d. That's nothing but your 98 into 365 divided by t. T stands for the number of days here. Clear with this, guys? This is a simple interest formula. So basically, there are two ways of calculating the cost, effective cost of payable. One is your compound interest formula. The other one is your simple interest formula. With this, you can compute the cost of payables. Clear with this, guys? This calculation, I hope you understood the logic. Now, you need not mug this up. As simple as that. This is all this particular method says. Clear with this, guys? With this particular concept of your cost of payables is also over. The entire segment is over. Clear with this, guys? Now, finally, you have a part called as financing of working capital. It's fully a practical theory part. So they will just tell you what are the different sources that are available for financing your working capital, your trade credit, bills payable, your accrued expenses. Now, you can also go for some commercial papers, or you can also go for some other sources of financing like public deposits, bills discounting, and all these things. Factoring is also one of the methods of funding and all of that. This is a core theory area, and with this, literally we have completed all the segments of this particular chapter called as working capital management. So guys, generally this chapter is actually a big chapter. Of all the chapters is going to be the big chapters, right? But just see, in a span of about 1 hour 40 minutes or 1 hour 45 minutes approximately, we have literally touched upon the major concepts covered across this particular chapter. Of course, there are a lot of other rich varieties of numerical problems. Using that, there are a lot of other concepts, but broadly for revision purpose, this is actually a good coverage wherein we have literally seen all the important aspects of this particular chapter as well. And with this, we have completed this particular chapter called as your working capital management. So guys, I hope you found this marathon or revision video useful. Now, I just want to share one very important message before I sign off in this particular revision marathon. Now, guys, whether you are watching this video the day before your exam, or 1 week before your exam, or even 1 month before your exam, the most important thing that you need to have in your mind is that never have the fear of your exam preparation, never have the fear of failure. Right now, you are doing your level best. Trust me, you guys are putting all your efforts. If not for you, who will pass? Right? So have this one thing in your mind. Whatever you are doing, just focus on the process and forget about the results. And trust me, if you are dedicated and if you are working so much on the process, automatically the universe will work in your favor. And trust me, you will only get the best desired output and the best desired result. So never worry about the result, because that's not in your control. The only thing that's in your control right now is your preparation, right? And guys, you guys have done a very good job, so do not worry about it. And in this marathon itself, I proved to you how in a span of just around 7 hours, right, all the main chapters, right, can be quickly recapitulated. So even if you're watching this the day before your exam, you can prepare along and you can clearly complete the significant component of your FM syllabus in a span of just 7 hours. And as simple as that, 6.5, 7 hours, you can complete all the components of your FM preparation. Now guys, this is about the subject. You need not have to worry about that. Of course, if you have attended my lectures, so it's always better to have the library of adjustments, and of course all the numerical discussions that we made in the classroom, whichever you have written in your own running notes or in your own handwriting, have that with you, right? And that will enable you to step up your preparation, and that's about it. So you guys are so dedicated and so sincere. If not for you, who else will pass? So have this thing in your mind. Never fear, never worry about the results. And right now, it's your duty to just prepare. And I think you guys are doing one really good job, right? So on that note, I'm signing off in this video. I will meet you all in CA finals. Bye-bye.